Hello everyone. Good morning, good evening, good afternoon, whenever you're seeing the video. So, May 2022 CA final, 6 papers done. I know you guys must be terribly tired, terribly exhausted, but then hey, just 2 more papers to go. So, don't just let your foot off the accelerator. It's time to just finish off our race, finish off the last stage of our battle, paper 7 and paper 8. So, before I get into uh, the revision of topics, I am making this video so that I'm going to revise certain topics with you. In a minute or so, I'll just talk about the revision and then we'll straight away dive into it. Before I start the revision, this is one small thing that I want to discuss with you. You have 1.5 day for your study of paper number 7, a vast paper, direct tax and international taxation, many topics to study. What should you study when so that you can cover the maximum amount of topics in this 1.5 day? This is just a suggestive list. You can plan something from this on your own as well. It's going to be stressful, but then please ensure okay, you have about 5 to 6 hours of sleep even in this 1.5 day. It's necessary. You need to be very alert. You need to be very calm, composed, awake in your examination time. So you need that, your body needs that rest of 5 to 6 hours. When you'll finish paper number 6, 2 o'clock to 5 o'clock will be your paper timings. Paper number 6 will be 2 o'clock to 6 o'clock. So maybe at 7 o'clock or 7:30 when you start studying paper 7, first thing, it's not a suggestion, I would honestly strongly recommend this. Please study paper number 7 only from the summary book. From whichever faculty you've taken the coaching for paper number 7, whether it's me or anybody else, please use their summary book only. Paper 7 is very vast. Do not use the main notes. Please study from the summary book. On the day when you finish your paper 6, 25th of May, that is, maybe let's say not exactly 6:30, but then I think by just a second. Yeah, maybe not 6:30, but let's say 7 o'clock or so. You can devote that day for international taxation, 30 marks. Small chapters, yet important chapters to study in international taxation. So that day up to 12:30, give your time to studying the 30 marks of international tax. That means on the next day, 26th of May, you have the entire day available with you. And now you can study with your domestic time. Now you can start with your revision of domestic taxation. I've divided the day into 3 parts. 7 o'clock, probably, let's say you begin studying 7 to 1:30. That is the first big chunk. You study PGBP, IFOS, Charitable Trust, MAT, AMT. Lengthy chapters. PGBP is lengthy, Trust is lengthy, MAT is also a bit lengthy. Then from 2:30 to 6:30, the second slot, it's the afternoon slot, a 4 hour session. Study capital gains, TDS, deduction, set off carry forward. All these chapters are going to help you to solve your compulsory question, also solve your individual questions as well. Then in the third slot of the day, in the evening, 7:30 or maybe let's say 8 o'clock, you study that part of your syllabus which is talking of assessment, appeals, revision, rectification, and the chapter of penalties, something that is important as far as penalty chapter goes. It's something that regularly comes up in the paper, so please ensure you study penalties properly. On the day of your exam, you will still have time up to 1 o'clock. Then you can study small topics like alternative investment fund, business trust. Please ensure that you definitely solve your RTP, definitely go through your RTP. I'm pretty sure you would have practiced some MCQs, if not all, some MCQs from your ICI booklet. Whichever MCQs you found that they were difficult, they were important, just go through them once. From the previous day, 26th May and 25th May, if any topics are left over, then you have time on the day of exam also, you can cover them up also. And please ensure that you study the amendments. are there are many amendments for May 2022, and we can reasonably predict okay, yes, they will be part of the paper. Not all, so some of them will definitely be part of the paper. So please ensure you go through the amendments also. It's just a suggestive list, and you can modify this as per your comfort, but please ensure you try to study as much as possible. Now, in this revision video, in this marathon video, what I'm going to do is I'm going to revise certain topics with you. PGBP, which carries a weightage of 14 marks, which is your compulsory question. You also have in your paper on a regular basis the chapter of trusts, which carries a weightage of about 8 marks. Like trusts, even TDS chapter on a regular basis comes up in your paper, having a weightage of 8 marks. In international taxation, I will be covering transfer pricing with you in this video. Transfer pricing roughly has a weightage of about 10 marks. At times it comes up for 12 marks also. And knowing the amendments that we have, this attempt, I'm sure all of you students also and us faculties also, we are expecting capital gains to be in your paper roughly 6 to 8 marks. So in all, on a rough basis, I am trying to cover around 48 to 50 marks using this in this revision video. I'm trying to be as precise as possible, as quick as possible. So let's get into it. Whatever material you are seeing on the screen, in the description of the video you will find a PDF link. You'll find a link to this PDF, so if you feel you can use the video and download this also. It's part of my summary book, so students who are using my summary book, it's the same thing that you already have. But in case if you are not using the summary book and you find this useful, you can download it from the Google Drive link. It will be there in the description. Chalo, let's get into it. When you say income tax is calculated on income. And what income? So income means we are talking about total income. What is the meaning of total income? Total income means the income computed as per section 5, and the manner of computation, the method of computation is given in the act. So section 5 tells you scope of income, section 5 tells you which incomes are taxable for the assessee, and the computation manner is this manner of computation. What is section 5 telling you? Section 5 in turn depends on your residential status. Sometime later in the video we will also be studying the residential status, because that also comes up in your paper. So you roughly have a 4 or 6 mark question on residential status also. We'll revise that as well. Broadly speaking, we have 3 residential statuses: resident and ordinarily resident, resident but not ordinarily resident, and non-resident. Any income which is accruing in India, deemed to accrue in India, received in India, deemed to be received in India, these incomes are taxable. Whatever be your residential status, it is either accrued in India or received in India, it is taxable. If you are earning income from a business activity, but the business or profession is controlled or set up in India, then it is taxable for you if you are a resident. If you are a non-resident, it is not subject to tax. But if you are earning income from business or profession, it is controlled outside India. Let me rephrase it quickly. Income is accruing or arising outside India. That is the thing common. Income is accruing or arising outside India. But if you are a resident, then business profession is controlled in India, therefore it is taxable. If you are a non-resident, accruing or arising outside India is anyways not taxable for you. But then if income accrues or arises outside India from a business controlled also outside India, then it is taxable only if you are a resident and ordinarily resident. For the other two cases, this income is not taxable. And other than business or profession activity, if you earn other incomes like salary, house property, other sources, then it's the same thing. Resident but not ordinarily resident, non-resident, you're not going to pay tax. Only if you are a resident and ordinarily resident, then global income is taxable, and that's what will become taxable. Even this income will be taxable for you. Computation manner, you have income divided into 5 heads. Obviously, when we do the calculation of income under these 5 heads, Section 10 incomes are excluded. Incomes which are exempt from tax, incomes which do not form part of total income, they are excluded. Also, when we calculate income under these heads and total them up, we give effect to the provisions of clubbing of income. We give effect to the provisions of set off and carry forward. Brought forward losses will be set off. Current year losses will be set off against current year income subject to the regulations. Otherwise, you'll carry forward them. That will give you gross total income. Then you have deductions arising in Chapter 6A, that is section 80C to 80U, payment based deduction, income based deductions, other deductions. You take all those deductions and you get your total income. This is the amount that is going to be taxable. Your compulsory question number 1 will be a question on total income, where 75% of the question will be PGBP. Most probably you will get a question, mostly you will get a question based on company assessee. PGBP will comprise of 70 to 75% of the sum. You will have one adjustment or two adjustments of Chapter 6A deduction, one of capital gains, one of other sources. So question 1 is broadly going to be PGBP. After you compute your total income, tax calculation, so quickly going through the tax rates, individuals will pay tax according to slab rate. An individual who is a resident and whose total income is up to 5 lakh rupees will be allowed a maximum rebate of 12,500. But then, if your tax is tax under section 112A, that is long term capital gain, 10% without indexation in excess of 1 lakh, then no rebate is available towards this tax. When we revise capital gains, we'll see that also. So total income has to be up with up to 5 lakh rupees, then rebate will be available. Maximum rebate is 12,500. Surcharge, we'll see that in a minute. Health education cess of 4% is applicable. What are my slab rates? So if you pay tax according to budget, 3 lakh rupees is your basic exemption limit. If you are a resident individual who is 60 years or more but less than 80 years, if you are 80 years or more and a resident individual, super senior citizen, then 5 lakh rupees is your basic exemption limit. And in all other cases, your basic exemption limit is 2,50,000. Then you have a percentage, then you have a 5% tax rate, 20% tax rate, and 30%. 3 lakhs to 5 lakhs, 5 lakhs to 10 lakhs, about 10 lakhs. So people who are super senior citizen, they will only pay tax at 20% and 30%. These are your slab rates applicable with reference to the budget. But then if you pay tax according to 115 BAC, then it's an optional section, it's a concessional tax rate, but then various deductions and exemptions in salary, in house property, in PGBP, in IFOS, Chapter 6A deduction, they are all not permitted. There are many restrictions on set off and carry forward of losses also. Additional depreciation is not allowed, 3580 deduction is not allowed, scientific research contributions are not allowed to you, salary in the head of salary, HRA exemption is not given, not allowed. Chapter 6A major deductions are not available. So income computed under 115 BAC will be on the higher side, and the slab rates are concessional. Each slab is 2.5 lakh rupees, and you have tax rates of 0, 5, 10, 15, 20, 25, 30. So your percentages keep on increasing by 5%, and your slab keeps on increasing by 2.5 lakh rupees. Income above 15 lakhs is taxed at 30%. So it's in a way very easy to remember, 2.5 lakh ka slab and 5% ka increase in tax rates. These are your slab rates. When it comes to surcharge, no surcharge up to a total income of 50 lakhs. Surcharge begins only when your total income exceeds 50 lakhs, but up to 1 crore, 10% surcharge. Above 1 crore but up to 2 crore, 15% surcharge. Above 2 crore but up to 5 crore, 25% surcharge. And if your total income is above 5 crore, then you have a surcharge of 37%. These are the normal rates of surcharge. But if your income includes, and this concept can come up as an MCQ, as a small MCQ, you can have this. If your total income includes dividend income, short-term capital gain under 111A, or long-term capital gain under 112A, then up to 2 crore rupees, the surcharge rates are same. Greater than 50 lakhs but up to 1 crore, 10%. Greater than 1 crore but up to 2 crores, 15%. The rate of surcharge is same. Now, the tax on those three incomes, short-term under 111A, long-term under 112A, and dividend, on that tax, surcharge will be 15% flat, mandatory 15% surcharge. Excluding these three incomes, if your total income is about 2 crores, excluding these three incomes, if your total income is about 2 crores but up to 5 crores, then the tax on that balance income will suffer a surcharge of 25%. But the tax on these three incomes will suffer a surcharge of 15% only. If you exclude these three incomes, and despite excluding these three incomes, your total income is greater than 5 crores, then on that income, the tax that you calculate will be at the rate of, will be suffering a surcharge of 37%. The surcharge rate on these three taxes will be maximum 15%. And suppose you exclude those three incomes, and excluding those three incomes, your total income falls below 2 crores. So those three incomes included, it went above 2 crores, but those three incomes excluded, the total balance income is below 2 crores. Then you will pay a 15% surcharge on all your taxes. So then there is no need to bifurcate anything, it is flat 15%. Dividend income does not have any special tax rate. Dividend income is taxed according to slab rates only. So how do you calculate tax on dividend income? Because that's going to suffer a surcharge of 15% only. How do you calculate tax on dividend income? This tax on dividend income is calculated on an average basis. So calculate your tax on total income excluding these three, which means calculate your tax as per slab rate, divide that by your total income which suffers tax as per slab rate. So obviously you will include dividend income in it, multiplied by dividend income. So on an average basis, you will get tax on dividend income, and on this tax you will pay surcharge at the rate of 15%. If your total income is about 2 crore rupees, and we just studied that maximum surcharge of 15% will apply. HUF pays tax according to slab rate 2,50,000 का basic exemption limit. Surcharge provisions are the same that we studied. No rebate is available. Health education cess of 4%. Artificial juridical person also pays tax according to slab rate. Firm and local authority pay tax according to a flat rate of 30%. Firm will pay surcharge only if the total income is above 1 crore. Surcharge is at the rate of 12%. 4% health education cess will always apply. Firm ka tax rate is the simplest. Firm will cover LLP also. Firm will cover partnership firm as per 1932 wala act. For a company, gets divided into two parts: domestic company, foreign company. For domestic company, if your turnover 2 years ago, that is 1920, was up to 400 crores, then today on your total income of 21-22, you will pay tax at the rate of 25%. In all other cases, it will be 30%. Surcharge if the income exceeds 1 crore but does not exceed 10 crore, 7%. So no surcharge up to an income of 1 crore. If it exceeds 1 crore, the surcharge will apply 7%. But if your income exceeds 10 crore, the surcharge will be 12%. 4% health education cess will apply. Foreign company, flat 40%. No need to check the turnover, etc. 40%. Surcharge criteria is still the same. Above 1 crore, you pay surcharge at 2%. About 10 crores, you pay surcharge at 5%. 4% health education cess will always apply. If this domestic company decides to pay tax under the concessional rates, so under 115 BAA, the concessional tax rate is 22%. Under 115 BAB, it is further reduced to 15%. You will have a mandatory surcharge of 10% applicable in each case. Whatever be your total income does not matter. Health and education cess will apply at the rate of 4%. Even if your total income is below 1 crore, if you are opting to pay tax under these concessional sections, so you will pay surcharge at the rate of 10%. So these are your tax rates. Now let's get into the first head of income, capital gains. Generally, capital gains is kind of absent in your paper, not regular. But this attempt, we are expecting a lot of capital gains to come up in your paper. What is capital gains? It is profit arising from the transfer of a capital asset. Capital asset is defined in 2 clause number 14. Transfer is defined in 2 clause number 47. Profits and gains are computed according to section number 48. The default year of taxability will be the year in which transfer took place. It should be a capital asset and there should be transfer. Only then the head of income will apply. What all things are included in capital asset? Property of any kind held by the assessee. It could be held for business purposes, personal purposes. It could be tangible, intangible, movable, immovable, does not matter. If it's held by the assessee, it has some inherent value. It is included in the definition of capital asset. But to make the definition more accurate, there are some exclusions provided. Stock in trade will not be treated as a capital asset. Income will be taxable under PGBP. Personal effects will not be treated as capital asset. What is personal effects? Personal effect means that it should be movable property and it should be held for personal use of the assessee and family members. Then they are called as personal effects, and if they are personal effects, so they are not called as a capital asset. Rural agricultural land situated in India. If it's outside India, it is a capital asset. If it is in India but it's a non-agricultural land, it is a capital asset. If it is in India and an agricultural land but in urban area, it is a capital asset. It must be located in rural area, it must be an agricultural land situated in India, then it is not a capital asset. Gold deposit certificates issued under the gold monetization scheme are not a capital asset. In personal effects, certain things are excluded. Personal effects itself are excluded, but in personal effects ka meaning certain things are excluded, which means all these items, jewelry, work of art, sculpture, drawing, painting, they all are considered as a capital asset, and when these will be transferred, capital gains will be taxable. Property of any kind held by the assessee, first part is a capital asset. Securities held by a foreign institutional investor, FII, they are always treated as a capital asset. In books of account, they will show it as stock in trade, does not matter. Securities held by foreign institutional investor will be treated as a capital asset. And because they are treated as a capital asset, for them, tax rates specially applicable will be, there is a separate section created 115 AD for it, which you will study in international tax. So for them, long-term, short-term capital gain will be covered by 115 AD. The amendment that is introduced as per our budget, first of the four amendments in this chapter, amendment number 1, we will discuss all the amendments together at the end. Unit linked insurance policies. Generally, unit linked insurance policies are exempted, 1010D, but certain high value unit linked insurance policies are now selected by the act, and if they are uh, the if they are giving you maturity benefits, then they will be treated as a capital asset. Capital gains will be taxable. We'll study this amendment when we finish the entire revision of capital gains. At the end, we'll look into it. If this is the definition of capital asset. Capital asset will have to be divided into two parts, short term or long term, for which you have to follow the concept of holding period. There are three criteria of holding period: 12 months, 24 months, 36 months. So shares which are listed, bonds listed, debentures listed, all listed securities, units of equity oriented mutual fund and zero coupon bond, up to 12 months short term, greater than 12 months long term. If shares are not listed on a recognized stock exchange in India, shares of a private limited company, shares listed outside India, the criteria is 24 months. Up to 24 months short term, greater than 24 months long term. Any capital and land, building, immovable property is also covered by the criteria of 24 months. Any other capital asset, then the criteria will be 36 months. Up to 36 months short term, greater than 36 months long term. Capital gain computation, you start with full value of consideration, transfer expenses are subtracted, cost of acquisition, cost of improvement is subtracted. Again, this is also an amendment. This is amendment number 2, reconstitution of partnership form, and because of that, this thing is to be subtracted in section 48. So full value of consideration, cost of acquisition, cost of improvement, transfer expenses will give you your capital gain before exemption. 54 to 54 GB, you are allowed certain exemptions, you take those exemptions, and then balance capital gain is taxable. Section 48 has these 7 provisos to study. Proviso number 1, if you are a non-resident and if you are acquiring shares or debentures of an Indian company using foreign currency, then your computation will be done in the same foreign currency that you had utilized at the time of purchase. All the items of computation will be converted into foreign currency. Full value of consideration and transfer expenses will be converted into telegraphic transfer buying rate, telegraphic transfer selling rate ka average, These are the rates of exchange existing on the date of transfer, the ones that are adopted by State Bank of India. Cost of acquisition will be converted using the buying rate and selling rate as on the date of acquisition. Final capital gain will be converted back into Indian rupees for calculating income tax. It will be converted back into Indian rupees. Telegraphic transfer buying rate on the date of transfer. If the first proviso applies, then the second proviso of indexation is not applicable. Computation is done in foreign currency, so no benefit of indexation will apply. You will have to calculate cost of acquisition only, no indexation. Similarly, if you are covered by section number 112A, then first proviso is not applicable, then your computation has to be done in Indian currency only. And if you are having unlisted shares and debentures, then section 112 tells you that you will pay tax at the rate of 10% and the computation will be done in Indian currency. The first proviso will not apply. First proviso is applicable only for shares and debentures, so mutual fund units, other capital assets, etc. are not covered. Foreign institutional investor is not covered. They are going to pay tax under 115 AD and the first proviso will not be applicable to them. So this is the first proviso which asks you to do computation in foreign currency first and then reconvert it back into Indian currency for imposing tax. Second proviso, it talks about long-term capital gains. So we are talking about a long-term capital asset. Then you will do indexation, index cost of acquisition, index cost of improvement will be deducted. Index cost of acquisition, index cost of improvement. Related to index cost of acquisition, we have to study, I'm sure you know this, Manjula J. Shah wala case law, which said that indexation will be allowed from the time the previous owner held the capital asset. It will be assumed that the assessee today is deemed to be the owner from the date the previous owner held the asset. So you will get indexation benefit for the entire holding period. And then there is index cost of improvement also. For long term, you have to subtract this. Third proviso says that if you are covered by section number 112A, the first and the second proviso will not apply. No indexation available if you are paying tax under 112A. For bonds and debentures also, indexation benefit is not allowed. But if it is sovereign gold bonds, indexation benefit is available. Other bonds and debentures, no indexation benefit. If you are a non-resident, fifth proviso, and you've invested into rupee denominated bonds. Now when those bonds are being redeemed, by chance if rupee has appreciated, then whatever profit, whatever gain arises due to rupee appreciation, you will have to ignore that while you compute full value of consideration. Fifth proviso is only talking about rupee appreciation. If rupee depreciates, it's absolutely fine. But if rupee appreciates and it results into a profit at the time of redemption, that much profit has to be ignored from full value of consideration. Obviously, it means you don't have to pay tax on that much of capital gain. Sixth proviso, if ESOP shares are gifted or transferred through an irrevocable trust, gifted or transferred through an irrevocable trust, then fair market value on the date of such gift will be treated as your FVC, capital gains will be taxable. Exemption of gift is not available to you because it is ESOP securities. If ESOP are transferred through will, then it is still non-taxable. And so, but obviously, the question of applying the sixth proviso will not be there only. Sixth proviso will only apply for gift and irrevocable trust. Seventh proviso talks of securities transaction tax. Seller cannot subtract securities transaction tax as transfer expense. Buyer cannot include STT as part of his cost of acquisition. STT is not to be deducted anywhere under the head of capital gains. Now, this was your section 48, which just gave you what the formula is. After that, Income Tax Act has created detailed provisions for each and every item in the formula. Full value of consideration, cost of acquisition, cost of improvement. So for computation aspects, for computation purposes, we'll have to study that also. Full value of consideration, a section which quite frequently comes up in your exams, 50C. 50C applies only in case of land, building or both held as a capital asset. It should be held as a capital asset, then 50C will apply. If it is held as stock in trade, so it is covered under the head PGBP. And in PGBP, there is a corresponding section 43CA created. 43CA and 50C are ditto identical to each other. 43CA in the current year has a slight bit of amendment, but in 50C there is no amendment. 50C simply says one thing, 50C will apply if your consideration is less than the stamp duty value. Then 50C tells you take the stamp duty value as your full value of consideration. But a small relaxation is given that if your stamp duty value is up to 110% of consideration, then full value of consideration will be the actual consideration only and not SDV. That means the basic provision is if your consideration is lower than SDV, you should take SDV. But if SDV is up to 110%, there's a 10% margin given, then you take your actual consideration, which means if your stamp duty value exceeds 110%, then you will take stamp duty value. If it is up to 10%, then you will take consideration. Now there is a possibility that your date of agreement and date of registration are not the same. So you will have two stamp duty values, one on the date of agreement, one on the date of registration. If the seller has received full or part of the consideration through these prescribed modes of payment, then you will take stamp duty value on the date of agreement. If your case does not fall here, if the prescribed modes of payment are not used, if it has not been received on or before the date of agreement, it should be on or before the date of agreement. If your case does not fall in point A, then you will take stamp duty value on the date of registration. During assessment, if by chance the seller assessee argues that the stamp duty value is not properly calculated, the assessing officer can make a reference to the valuation officer. And if the valuation officer gives you a value which is greater than stamp duty value, then you have to consider the stamp duty value only and not the value of the valuation officer. If the valuation officer gives you a value which is lower than stamp duty value, then the value taken by valuation officer can be taken. Later on, if stamp duty value is revised, then it will impact the seller's computation. So if stamp duty value is revised, so your capital gains will also be recomputed. How to do that? That recomputation will be done by passing a rectification order under section 155(5). Assessing officer gets a time limit of 4 years. The stamp duty value has been revised in appeal or revision. So the financial year in which the stamp duty value was revised, from the end of that financial year, 4 years ka time limit is given for the assessing officer of the seller to change the computation, reduce the capital gain if reduction is there, and give refund of tax. So stamp duty value changes, seller ka computation is also going to change. If date of agreement and date of registration are different, we just saw that earlier. Full or part consideration is received on or before the date of agreement through the prescribed modes, then you take stamp duty value on the date of agreement. Through any other mode, you take stamp duty value on the date of registration. If full or part consideration is received after the date of agreement, then straight away take stamp duty value on the date of registration. Prescribed modes of payment, these are used at multiple places in the Income Tax Act. So once and for all, just remember this: credit card, debit card, net banking, NEFT, RTGS, IMPS, wallet payments, bean payments. So basically, all the payments where eventually there will be an entry in the bank account for the payer also, for the receiver also. These are all electronic modes of payment. We'll find this in PGBP also. We find this in deductions chapter also. It's at multiple places. For section 50C was applicable only to land and building held as capital asset. Now, other provisions, all related to full value of consideration. If we are talking about unlisted shares of a company, what should be taken as full value of consideration? Fair market value should be taken as full value of consideration. If your consideration is lower than FMV, then you should take FMV. Certain exceptions are provided in Rule 11 UAD. One exception is provided. If a company was suffering from operation and mismanagement and the company law tribunal has suspended the board of directors, then the seller, when he sells his unlisted shares, he can take the actual consideration and not the fair market value. Otherwise, the general rule is that if the consideration is lower than fair market value, then you have to take fair market value for computation. Due to any reason, if your consideration cannot be determined, is indeterminate, cannot be ascertained in numeric terms, you take the FMV of such asset. If you get insurance claim for damage or destruction of the asset, then whatever assets you are getting, its fair market value will be taken. If you are getting money, so money will be taken as FVC. ULIP wala amendment, we will discuss it towards the end. If capital asset is converted into stock in trade, you will take the fair market value of the capital asset on the date of conversion as your FVC. Capital gains will not be taxable when it is converted. Capital gains will be taxable when the stock in trade is eventually sold. Indexation will be done only up to the year of conversion. When a partner transfers an asset to the firm, 45(3), when a partner will transfer an asset to the firm, when a member will transfer an asset to AOP, it will be taxable for the member, it will be taxable for the partner. Whatever is the amount recorded in your capital account will be your full value of consideration. 45(4), again an amendment, we'll discuss it towards the end. If compulsory acquisition happens, 45 subsection 5, you will pay tax not when compulsory acquisition happens, but when you receive initial compensation for the first time. Whether you receive it fully or whether you receive it in installments, the first time when you receive initial compensation, that is the time when you will pay tax. Capital gains will be taxable in that year. Initial compensation, the full amount of compensation has to be taken for computation from full value of consideration. That means from the full compensation, reduce the full cost of acquisition, full cost of improvement, you will get capital gain, capital loss, short term, long term, depending on holding period. If you find initial compensation is less and you have asked for enhanced compensation, so enhanced compensation will be available, will be taxable for you only in the year of actual receipt. Whatever amount is received, only that much will be taken as your FVC. Cost of acquisition, cost of improvement, we've already adjusted from the initial compensation. So your cost of acquisition, cost of improvement will be zero. Transfer expenses will be there, legal expenses incurred will be subtracted, and the resulting will be capital gain taxable. Due to any reason, if this initial compensation or enhanced compensation is reduced by the court, then your capital gain shall be recomputed by taking the reduced compensation. 155 subsection 16 tells the assessing officer that he has to pass a rectification order within 4 years from the end of the financial year in which this compensation was reduced. 45 subsection 5a, if you are facing a situation of redevelopment, your capital asset is being redeveloped, so you can get money, and in the new property you will get some share in the new property, some space. So whatever is the stamp duty value of the land or building that you've got plus the monetary amount will be taken as your full value of consideration. This is applicable, this provision is created for individuals and HUF only. It will not be taxable when you surrender your capital asset to the builder, but when the certificate of completion of the project is received, in that year capital gain will be taxable. This is your full value of consideration. Now, transfer expenses, the second item, is nothing great to study. Brokerage, commission, legal expenses will be allowed as a deduction. STT will not be allowed. Coming to cost of acquisition. 49(1), very famous, very commonly studied. If capital asset became your property because of partition of HUF, gift, will, irrevocable trust, then all these transactions for the previous owner, capital gain was not taxable. So now whatever was the cost incurred by the previous owner will be taken as cost of acquisition for the assessee who is currently going to pay tax. Partition of HUF, gift, will, irrevocable trust, amalgamation, demerger, holding company transferring an asset to subsidiary company, or subsidiary transferring an asset to holding company. For the seller, for the transferor, if capital gain was exempt, that person becomes the previous owner. Then the assessee who is today selling the capital asset is going to pay tax. What will you take as cost? Cost to the previous owner. As a shareholder, when amalgamation happens, you will surrender your shares in the amalgamating company and you will receive shares of the amalgamated company. This transaction is exempt for the shareholder. Now when you will sell your shares of amalgamated company, Indian company, which is an amalgamated company, you've not paid anything for the cost of those shares, but whatever was the cost of shares for you in the amalgamating company will now be taken as your cost of acquisition. When debentures are converted into shares, partly convertible debentures, fully convertible debentures, whatever is the cost of debenture will now become cost of share. If it is partly converted, so based on the proportion converted. If it is fully converted, the full cost of debenture will be cost of share. If shares are given to you through ESOP, then as a perquisite it was taxable for you under salaries chapter. Then whatever was the fair market value taken for computation of perquisite at the time when you received the ESOP, what was the fair market value, that will now become your cost of acquisition. When global depository receipts are converted, redeemed, GDR are redeemed, and you get shares. So on that day, whatever was the market value of the share existing, that will become the cost of acquisition of the shares. You are getting shares by redeeming global depository receipts. Then market value of the share will be the cost price of share now. If 47A has been attracted, so here we are talking about holding company transferring an asset to subsidiary company or subsidiary transferring an asset to holding company. Capital gain is exempt. Just one second, please. Capital gain is exempt for the transferor company if you satisfy certain conditions. The seller company, the holding company should have 100% shares, and whichever company is the buyer company should be an Indian company. Then the seller company will enjoy exemption. But then for the next 8 years, transferee company should not convert the capital asset into stock in trade. And the holding company ka shareholding should not fall below 100%. If any one of these two events happen, if the transferee company converts the capital asset into stock in trade, if the holding company ka voting power falls below 100%, then the exemption that was given will become taxable. Taxable for the seller company. So what about the buyer company? What about the transferee company? They had paid something for the capital asset. Whatever was the actual cost that was paid will now become your cost of acquisition. If your capital gain remained exempt, then cost to previous owner will apply. But for the previous owner, if capital gain became taxable because your exemption was withdrawn, then for this buyer company, the actual cost will become cost of acquisition. Similarly, if for the receiver, 56 to 10 gets attracted, per share asset purchase for no asset purchase for inadequate consideration, asset acquired for no consideration, and under IFRS you've paid tax on the fair market value, you've paid tax on the stamp duty value, then you've already paid tax on that amount. That fair market value, that stamp duty value will now be taken as your cost of acquisition. Now in this case 49.1 will not apply, 49.4 will apply. So if 56 to 10 became taxable, if 56 to 10 became taxable for the receiver of asset, then cost of acquisition for that person will be the FMV, the SDV. If 56 to 10 did not become taxable for the receiver of asset, then we will look at the previous owner's cost and that will be taken as cost as per 49.1. In a redevelopment project, you've received some capital asset, you've already paid tax on that by taking SDV as your FVC. Now in future when you will sell that asset, that land or building, whatever was the stamp duty value which had earlier become taxable for you, this will now become your cost of acquisition. As a charitable trust, if tax has been paid on accreted income, then the person who received the capital asset from the charitable trust, the fair market value of that asset will be taken as cost because that fair market value has become taxable for that charitable trust. If stock in trade is converted into capital asset, the cost of that capital asset will be fair market value on the date of conversion. Reverse is also true. When capital asset is converted into stock in trade, for stock in trade purposes PGBP, we will take the FMV as cost price, purchase price. When stock is converted into capital asset for capital gain purposes, we will take the FMV as our cost of acquisition. Block of asset, block turns negative, so all assets are not sold, but sale value is much more than the total value of the block. Block of assets ceases to exist. That means all assets are sold. In both cases, the formula is the same. Cost will be opening WDV plus actual cost of assets acquired during the year. Opening WDV of the block plus actual cost of assets acquired. Capital gain in this case will always be short term in nature. Your block of asset may be a long-term capital asset or maybe a short-term capital asset, but in either case the capital gain arising from both will be short-term in nature. There is a case law, a Supreme Court judgment, VS Dempo and Company 2016, it was delivered. It said okay, the block can be a long-term capital asset because of the holding period, but the gain will always be considered as short-term capital gain. The amendment in block of asset is goodwill has been removed from the definition of block. Goodwill is no longer part of the block of asset. Goodwill is still a capital asset. There is no problem with that. But goodwill, just a second please. Goodwill is no longer part of my block of asset. So I need to remove goodwill from the block. What do I do to remove goodwill from the block? This amendment is applicable effective previous year 2021. So all the adjustments have to be done on 1st April 2020. Find out the opening WDV of the block of intangible asset, the entire block. Any asset that you acquire during the year 2021, but obviously goodwill cannot be added. So any other intangible asset, you add that cost of intangible asset. Find out the WDV of goodwill, assuming it is the only asset in the block, and subtract this WDV. Now, after subtracting this WDV, if you still have a positive amount remaining, that means A plus B is greater than C. Even after subtracting C, you still have a positive amount. It means WDV of goodwill has been removed from the block. Now the balance amount is the WDV of other intangible assets in the block. So you will take those amount, that balance amount, and you will calculate depreciation on it for the year 2021. But by chance, after subtracting C amount, the answer becomes negative. That means A plus B is lower than C. WDV of goodwill is much more than opening WDV plus actual cost of asset acquired. This means now the difference C minus A plus B, this difference will be short-term capital gain and will be chargeable to tax. The block of intangible asset will no longer exist, and it will be a short-term capital gain that will be taxable for the year 2021. Block A goodwill is still part of capital asset. Goodwill is still a capital asset. So cost of acquisition of goodwill, it is not included in the block, but cost of acquisition of goodwill as a capital asset is very simple. This is the WDV as on 1st of April 2020. This will be treated as cost. Under section 55 subsection 2, a corresponding amendment has been introduced. So you will remove goodwill from the block. After removing goodwill from the block, if the value still remains positive, that is a balanced WDV of intangible asset depreciated. If it's becoming negative, that negative amount is a short-term capital gain. Remember, this is our budget ka amendment, 2021 budget, but it is applicable previous year 2021 with retrospective effect. Chalo, moving ahead. If you have claimed a depreciation on actual cost basis, then cost of acquisition of that block of asset will be the actual cost and not the WDV. Advance money forfeited, if it is forfeited before 1st April 2014, then it will be reduced from the cost. If it is forfeited on or after 1st April 2014, the forfeited amount is taxable as IFRS. You will not make any adjustment in the cost. Goodwill, if self-generated, zero cost. If you've paid something for goodwill, then the actual price that you have paid. Goodwill, trademark, right to manufacture, right to carry on business profession, tenancy rights. Self-generated, zero. But if you've actually paid something, then the actual cost that you have paid will be taken as your cost of acquisition. If the previous owner had purchased these assets and transferred it to you, then for you the cost will be the cost paid by the previous owner. If depreciation was calculated on goodwill up to 1920 and effective 2021 we are removing goodwill from the block of asset, then whatever was the purchase price of such goodwill minus depreciation claimed up to the year 1920. That means this will be nothing but opening WDV of your goodwill as on 1st April 2020. This will be treated as your cost of acquisition now. You have an option. If you acquire the capital asset before 1st April 2001, then you can take your actual cost or fair market value on 1st April 2001. Whichever is higher of the two will be taken as your cost. This is an option, it's not compulsory, but this option is available only if your asset is acquired before 1st April 2001. This option is also available in cases of previous owner. So if the previous owner has acquired the asset before 1/4/2001 and the assessee is today selling it, he can compare cost of the previous owner with the FMV of the capital asset on 1/4/2001. If your capital asset is land or building and by chance this FMV wala figure exceeds the SDV, then you will not take the FMV, then you will take the SDV only. In simple terms, you can remember that if it is land or building, then you will take your cost and you will compare it with stamp duty value on 1/4/2001. In cases of all other capital assets, you can take fair market value, but for land and building, it will be stamp duty value. So, applying this provision, if you have original shares acquired before 1/4/2001, you have the option available. Consider the FMV, compare it with the cost, whichever is higher. If your original shares are acquired after 1/4/2001, the actual cost. If bonus shares were given to you before 1/4/2001, cost for bonus shares is zero. But since they were given before 1/4/2001, those shares will have some positive market value on 1/4/2001. So that will become your cost. If bonus shares are given after 1/4/2001, cost paid is zero. FMV ka option is not available. So cost of acquisition will be zero. If you get a right from the company, and if you surrender that right to someone, right ka cost is zero. Whatever money you receive for surrender will be your short-term capital gain. If you exercise the right, then you will get right share. Then that the cost of share that you have paid will be your cost. If you've paid something to get the right, then the cost of right will also be added. These are your provisions relating to cost of acquisition. Manjula Jesha, Bombay High Court judgment. Wherever previous owner concept applies, wherever section 49(1) applies, holding period will always include the holding period of the previous owner also. No controversy relating to it. That is fixed provision of Income Tax Act. Holding period of previous owner plus holding period of assessee is total holding period. Now when it comes to indexation, Bombay High Court has given a judgment that indexation will be allowed not only for the assessee's own exclusive period but also for the holding period of the previous owner. So you will take indexation for the entire holding period if you are following Manjula Jesha case law. Whenever this concept comes up in exams, what the institute does is it presents two solutions. One solution following Bombay High Court judgment, doing indexation for the entire holding period. Second solution, where it just says that if indexation is not done for the full period, if indexation is done only for the exclusive period of the assessee, then index cost of acquisition will change, long-term capital gain will change, and that is how a small note is written. Following Bombay High Court judgment is absolutely correct. There is nothing wrong. You can do indexation for the entire period. You can also present two solutions. One, a full-fledged solution, and second, a small note for it, where the second alternative is presented. Now, cost of improvement. Way too simple, way too easy. If improvement is done before 1st April 2001, no need to consider it in the working of capital gains. If improvement is done on or after 1st April 2001, then you have to take it as cost of improvement in the working of capital gains. Who does the improvement is irrelevant. Previous owner has done it, assessee has done it, does not matter. Before 1/4/2001, ignore. After 1/4/2001, consider it. And if it is long term, so you do indexation on cost of improvement. Now coming to tax rates. We've discussed full value of consideration, cost of acquisition, cost of improvement. Now coming to our tax rate discussion. Pretty simple. Some important things to remember. You can get them as MCQs, you can get them in a full-fledged question also. So you need to be alert when you think of tax rate. Short-term capital gain, there is one section, 111A. It applies to equity shares, units of equity-oriented mutual fund, units of business trust. If these are your capital assets and they are sold through a recognized stock exchange, you will pay STT. Then the income tax rate will be 15%. Standard, a special tax rate of 15% will apply. If your stock exchange is located in IFSC, that is in Gujarat, if it is located in IFSC, then you don't have to pay STT if the consideration is received in foreign currency, but 111A will still apply. You will still pay tax at a 15%. This is applicable to all assessees, whether you are an individual, whether you are a company, does not matter. 15% rate will apply. If your short-term capital gain is not covered by 111A, then it is treated like any other normal income and regular tax rates will apply. So for individual HUF, it will be slab rates. For company partnership firm, it will be flat rate. This is treated like any other normal income. For your short-term capital gain under 111A, no Chapter 6A deduction. You get a benefit of unabsorbed exemption limit. If your total income, excluding this 111A, is less than the basic exemption limit, then you have some spare exemption limit remaining. You can take that spare exemption limit, adjust it against this short-term capital gain under 111A. Only the balance short-term capital gain will be taxed at 15%. This is applicable only for resident individuals and resident HUF. Resident, if you are a non-resident, this concept does not apply. the unabsorbed amount is gone, it's finished. You will have to pay tax on the full short-term capital gain under 111A. Long-term capital gain. Budget rates are never applicable to long-term capital gain. Long-term capital gain will be either covered by section 112A, which is a specific section, or I should say a more specific section, and 112, which is a less specific section. 112A will apply if we are talking about securities. Securities means the same securities that we saw in 111A, but the difference here is 112A is long term and 111A is short term. If 112A applies, then the condition that you got to satisfy is STT has to be paid at the time of acquisition and sale both for equity shares. For units of equity oriented mutual fund, units of business trust, STT has to be paid only at the time of sale. If this happens, you will get an exemption of 1 lakh, and on the excess capital gain, you will pay tax at the rate of 10%. It is this long term capital gain which will be included in gross total income, the one without the exemption of 1 lakh rupees. You will include the full amount in GTI. Tax calculation के time पे you will subtract 1 lakh as exempt. This long-term gain is calculated without applying the benefit of indexation. We saw it in the provisos. Third proviso says that if 112A applies, indexation will not apply. 112A applies, so even the first proviso, conversion, reconversion method will not apply. Your computation will be done in Indian currency without giving any indexation benefit. If these securities that we are talking, they are acquired before 1st February 2018, then you have a special section 55 AC which will help you to determine cost of acquisition. Obviously, there is no indexation. This is what is popularly called as grandfathering. Start with your full value of consideration, compare it with fair market value on 31st January 2018, whichever is lower of the two. Take that lower amount, compare it with your actual cost, whichever is higher. This is treated as your final cost of acquisition. In the institute's MCQ booklet, there are 1 or 2 MCQs based clearly on 55 AC, and then the question is asking you, giving you 4 options. What are the amount of capital gain taxable? FVC or FMV on 31st Jan 2018, whichever is lower amount or cost, whichever is higher. That becomes your cost of acquisition. No indexation, subtracted from FVC, reduce transfer expenses. If you still have any long-term capital gain, that will be included in GTI as taxable. And at the time of tax calculation, you will subtract 1 lakh. Balance amount will be taxed at the rate of 10%. In some cases, now, what is the meaning of FMV as on 31st Jan 2018? If it is listed, so you take the highest price on that day. If trading did not happen on 31st Jan, the immediately preceding date, whenever trading happened, whatever was the highest price on that immediately preceding date. If the unit of mutual fund, unit of business trust was not listed, find its NAV as on 31st January 2018. Suppose the equity share was not listed on 31st Jan 2018, but subsequently got listed on the stock exchange. Then take your cost and do indexation up to the year 1718. It was not listed on 31st Jan 2018, so we can't look at the stock market. So indirectly what is said is, okay, indexed value up to 1718, that is means index value up to 31st Jan 2018 is considered as your fair market value, and then you will compare this with full value of consideration. Very less chance that the institute might test you on this. If the examiner wants to make it tough, he might give you so much of detail. Otherwise, you can simply remember this basic formula, full value of consideration or FMV on 31st Jan 2018, whichever is lower or actual cost, whichever is higher. A notification which says that if we are talking about equity shares, there is a relaxation given. If STT was not paid at the time of acquisition, still 112A will apply. Bonus shares, right shares, ESOP securities, shares acquired in amalgamation or demerger, shares acquired as per Supreme Court judgment, High Court judgment, shares acquired before 2004, that is when STT was introduced. So before 2004, if you have acquired the shares, you've never paid STT. So these are certain transactions highlighted where STT payment is practically not possible only. So we are saying no problem, you've not paid STT, it's absolutely fine for us. When you pay STT on sale, we will give you the benefit of 112A and you can pay tax at the rate of 10%. Chapter 6A deduction will not be allowed. Rebate under 87A will not be allowed. Unabsorbed exemption limit benefit is available for 112A also. Ha, if you are located in IFSC stock exchange, then that same concept which was there in 111A is also applicable here, that you need not pay STT, but 112A benefit will be available to you if the securities are sold in a recognized stock exchange located in IFSC and the sale consideration was received in foreign currency. 112A very specific, you have to satisfy conditions and then 112A will apply. If 112A is not applicable, then 112 will apply. Tax rate is 20% with indexation. But for certain listed assets, you have a second option of paying tax at 10% without indexation. So either do indexation and pay tax at 20%, or don't do indexation, reduce only your cost of acquisition and then pay tax at the rate of 10%. This is available only if the securities are listed shares. This option is not available to units of mutual fund, units of business trust. It is only for shares, debentures, and bonds and securities. If you are a non-resident, for unlisted shares and securities, you will compulsorily pay tax at 10% without applying the first proviso and without allowing indexation. So as a non-resident, if it is listed, you can go for this. If it is unlisted, it is mandatory for you to pay tax at the rate of 10% without indexation. Again, Chapter 6 deduction not available. Against this tax, you can claim a rebate of 87A. Concept of unabsorbed exemption limit is also available. So broadly speaking, for your tax rates, you have three sections. One is 111A, one is 112A, and one is 112. 111A 15% short term, 112A 10% long term, but you get an exemption of 1 lakh rupees. 112 20% long term, but in certain cases you have a concept of 10%. Against these all three incomes, no Chapter 6A deduction. Against all three incomes, you have the concept of unabsorbed exemption limit. All three will be included in the GTI and taxed at special rates. Now, two special provisions relating to capital gains. One, buyback. Hardly comes up in the paper, but in your MCQ booklet, there are 2-3 questions based on this. So I'll just spend 2 minutes on it. If buyback is done by a domestic company, then whether the shares are listed or unlisted, equity or preference does not matter. If it is domestic company will pay additional tax similar to what we had earlier as DDT. 20%, mandatory surcharge of 12%, health education cess of 4%. This will give you 23.296%. Fixed amount. Domestic company will pay tax, so shareholder will enjoy exemption 1034A. If it is not a domestic company, so this concept will not apply. Then it will be taxable as capital gains for that shareholder. If it's a foreign company, for example, if it's a domestic company but they are not shares, they are other securities like bonds and debentures, then also 46A will apply and capital gains will be taxable for that debenture holder, for that security holder. Then comes an important thing, slump sale. You can expect a question based on slump sale. Many people are speculating that slump sale ka question will be there. Because of the nature of amendment, you can have slump sale. First amendment, it is no longer restricted to sale. All methods of transfer are covered. It's a lump sum transaction. An entire business unit is transferred on a going concern basis. Consideration is decided on a lump sum basis. Now it is no longer a sale. Even other methods of transfer are covered. Individual assets and liabilities are not given values when the sale consideration was being decided. The capital asset is the unit or division or part of business, so held for 3 years or less than that, short term, more than 3 years, 36 months, more than 36 months, long term. Even though it is long term, no benefit of indexation will be available for slump sale. FVC, transfer expense, cost of acquisition, cost of improvement, short term or long term, no indexation will be allowed. Computation will be done ignoring revaluation of assets. What is to be taken as cost of acquisition? Net worth. What is your net worth? Assets minus liabilities. If an asset is covered by 35AD, you've already taken the deduction in PGBP, cost is 0. If it is part of block of asset, so you take opening WDV plus actual cost, assuming that those assets of the unit that is sold were the only assets in the block. Find the opening WDV actual cost of assets acquired for that particular business, that will be your cost of acquisition, part of net worth calculation. Any other asset like bank balance, cash balance, debt or stock in trade, you will take the book value. When you calculate the value of assets, we've already seen this, revaluation of the assets that you would have done will have to be ignored. Asset minus liability is net worth. This net worth will be your cost of acquisition and cost of improvement. The first amendment in slump sale is that every type of transfer is covered. The second amendment, if every type of transfer is covered, the buyer can pay to you something in cash also and something in kind also. So full value of consideration is FMV number 1 or FMV number 2, whichever is higher. FMV number 1 means the market value of assets and liabilities that you are transferring to the buyer. A plus B plus C plus D, these are your value of assets minus liabilities. What is B? If you are transferring jewelry and artistic work, to open market price. If you are transferring shares and securities as part of slump sale, it's fair market value. If you are transferring immovable property, it's stamp duty value. And apart from these assets, apart from jewelry, artistic work, shares, security, immovable property, if you are transferring any other asset, stock in trade, debtors, cash balance, plant and machinery, furniture, then whatever is the book value will be taken as FMV. Income tax paid on our deferred revenue expense, these are the assets to be excluded. Truly speaking, they are not assets as such. Liabilities, book value of all the liabilities has to be subtracted. Paid up capital, reserves and surplus, provision for contingent liabilities, uncertain liabilities, provision for tax, amounts set aside for dividend payments, they are all to be excluded as liabilities. So, creditors, bills payable, bank loan, unsecured loan, debentures, they are all your liabilities, you will take them. All the assets and all the liabilities that you are transferring in a slump sale, that is FMV number 1. FMV number 2 is the buyer is paying to you money plus other assets. So what you are receiving as consideration, that is FMV number 2. E plus F plus G plus H. E means your monetary consideration. F means if you get jewelry, to open market price. If you get archaeological collections, work of art, drawings, paintings, open market price. If you get quoted shares and securities which are listed on the stock exchange, lowest price of the share or securities will be taken. If it is unquoted equity share, you will find the market value of the unquoted unlisted equity share by doing valuation of the company. You do valuation of that private company which has issued the shares, asset minus liabilities, divided by total paid up value multiplied by your paid up value of shares, that will be the market value of the unquoted equity shares that you are having. Any other unquoted securities, open market price. If the buyer has paid to you these assets, then this is to be taken as market value. If the buyer has paid to you some assets in kind which are not covered in point F, which are not covered in point H also, then they are covered in point G, open market price once again. Point H is covering immovable property, you will take SDV. So for computation of capital gains, the first item that you need to take is full value of consideration. FMV1 or FMV2, whichever is higher. What is FMV1? Assets and liabilities that you have transferred, uska market value. What is FMV2? Assets that you have received from the buyer in cash, in kind. Out of the two, whichever is higher will be taken as your full value of consideration. In your revision test paper, RTP, you have one question based on slump sale which covers the amendment. Please ensure that you go through that question. You might get something on similar lines. Now coming to the last part of the chapter, exemptions from capital gains. Sections that are very popularly asked: 54, 54 EC, 54 F, 54 GB. 54 talks about selling residential property and investing into a residential house property. You have to invest into one residential house property. Either you can purchase or you can construct. If you purchase 1 year prior to the date of transfer, 2 years after the date of transfer, this is your time limit. If you go for the option of construction, construction should be completed within 3 years from the date of transfer. capital gain or your long-term capital gain is only covered here, short-term is not covered. Long-term capital gain or the cost of your new asset, whichever is lower, will be your exemption. When you are filing a return of income, at that point of time, you are going to claim the exemption. So by the time you are filing a return, if you have not invested into the new asset, you can open a bank account under the capital gain account scheme CGAS, transfer some money there. Whatever amount is transferred will be taken as cost of the new asset. That will be compared with your capital gain and exemption will be calculated and it will be given to you in the return of income. Now the amount is in that special bank account. You have to withdraw the amount and invest the amount into the new asset, new residential house property. If you don't, whatever amount remains unused will become taxable as your long-term capital gain. The new asset on the basis of which you are taking the exemption, indirectly the act is telling you to keep it for 3 years. If you transfer it within 3 years, then the cost of the new asset will be reduced by the amount of exemption that you have taken. So cost of the new asset will be reduced by subtracting the exemption allowed under section 54. No problems if you transfer the new asset after 3 years. After 3 years, if you transfer it, actual cost will be taken. You have to keep the asset, indirectly speaking, for 3 years. Don't transfer it within 3 years. If you do it, your cost will reduce. 54 EC, sorry, 54, one last point. You have a one-time option that you can invest into 2 residential house properties and take the cost of both as exemption. This is a once in a lifetime option, and the only condition that you got to satisfy is that your long-term capital gain for which you are taking the exemption should be up to 2 crore rupees. If it is up to 2 crore rupees, then you can invest into 2 properties and you will get exemption. Very old Karnataka High Court judgment, Ananda Basappa, and Andhra Pradesh High Court judgment, Sayyid Ali Adil, which says that if two properties are purchased or 3 properties are purchased and they are merged into one, they are merged together into one property, then it will be treated as a single house property and you can claim the cost of all these as exemption. In the past, there have been some questions based on this, a very simple case law, just go through it once. Then comes 54 EC. 54 EC is telling you that if you are selling land or building or both held as long term, 54 EC is a section which applies to all assessees, companies, firms, everyone. 54 is applicable only to individual HUF. 54 EC is applicable to land, building or both, not all capital assets, but every assessee is covered here. You have to invest into bonds issued by National Highway Authority of India, Rural Electrification Corporation Limited, Power Finance Corporation, Indian Railways Finance Corporation. Time limit is only 6 months from the date of transfer of new asset. So capital gain account scheme, special bank account is not available to you here. You have to invest it within 6 months. If you invest more than 50 lakh rupees into these bonds, for exemption purposes, only 50 lakhs is eligible. Your investment in the current financial year when transfer has taken place and in the next financial year should not exceed 50 lakhs. If it exceeds 50 lakhs, for exemption calculation, it is to be taken as 50 lakhs only. So in simple terms, the max to max exemption available to you is 50 lakh rupees. You must not convert these bonds into money. You must not sell these bonds. You must not mortgage these bonds. You must not convert it into money. If you do this, then whatever exemption was allowed to you under 54 EC will become taxable for you. If you have invested into these bonds, but there is a delay on the side of NHAI, RECL in allotment of the bonds, but you have made the payment within 6 months, then you are entitled to exemption, Hindustan Unilever ka case law. Then coming to our next section, 54F. 54F is 80% identical to 54. Your original asset should be any long-term capital asset other than residential house property. But you must invest into a new asset only, which is a residential house property. Same time limit applies. 1 year prior to the date of transfer, 2 years after the date of transfer. Within this gap, you must purchase. If you are going for the option of construction, you have to construct it within 3 years from the date of transfer. You have to invest your net consideration Your residential house property should be in India. Time limit to invest is the same time limit as we saw in section number 54, but you have to invest net consideration here. Capital gain will be exempted only if you invest net consideration. So your exemption is calculated on a proportionate basis. Long-term capital gain divided by net consideration into cost of new asset. This is your amount exempt. If this formula gives you more than the capital gain because you've invested more money into cost of asset, then the exemption is restricted to the amount of long-term capital gain. Here also, it is told that you have to keep the new asset within up to 3 years. If you sell the new asset, if you transfer the new asset, new residential house property that you invested into within 3 years, whatever 54F exemption was given to you will become taxable for you. If you transfer it after 3 years, no problem. If there is some money in the special bank account which remains unutilized, then because exemption was given to you on a proportionate basis, even the unused amount will be taxable on a proportionate basis only. For 54F, there are these two extra conditions. Number one, when you are transferring the original asset, you must not have more than one residential house property. On the date of transfer of your original asset, you must have 0 residential properties or 1 residential property, but not more than 1. New asset should be excluded from this counting. If you have more than 1, so 54F is not applicable only to you, you will not get the exemption. From the date of transfer, condition 2, from the date of transfer of the original asset, in the next 2 years, if you purchase another residential property, if you invest into another residential property by purchasing it or by constructing it within 3 years, then whatever 54F exemption was given to you will become taxable for you. So you cannot purchase another residential property, you cannot construct another residential property for the next 2 years, for the next 3 years. This will ensure that 54F is valid for you. The concept of two residential properties which was there in 54 is not there in 54F. In 54F, you are allowed to invest into one property only. Coming to 54GB, again, exemption available only to individual HUF. Long-term capital asset has to be a house or a plot of land. You have to invest the net consideration into a company. Company is an eligible startup company. This company is subsequently investing the money into plant and machinery. So your new asset is plant and machinery. Long-term capital gain will be exempt if the net consideration is invested into shares which is subsequently invested into plant and machinery. Capital gain account scheme concept is available here, definitely, but into that special bank account, the company will have to deposit the money on or before the date of filing return. Exemption will be available to that individual or HUF assessee. Individual HUF, the assessee is told, you have to purchase shares, you have to subscribe to shares before the date of filing return. Company has to invest into plant and machinery within 1 year from the date of actual subscription of the shares. Plant and machinery should be brand new, cannot be second hand plant and machinery. You have to keep the plant and machinery for a span of 5 years. But this is an eligible startup company, it will invest heavily into computers also. For computers, the lock-in period is 3 years only. The individual HUF has to invest into equity shares. The voting power should be minimum 25%. And those shares have a lock-in period of 5 years. If you sell the shares within 5 years, 54GB wala amount will become taxable. If the company sells the plant and machinery within 5 years, then the 54GB amount will become taxable for the assessee. If the equity shares are sold after 5 years, if the plant and machinery is sold after 5 years, your 54GB exemption will remain intact, will remain valid, absolutely fine, no problem. Chalo. Now coming to the amendments. Goodwill amendment we have already discussed. Now coming to the next amendment, the amendment of unit linked insurance plan, ULIP. This amendment is applicable to any unit linked insurance plan issued on or after 1st day of February 2021. In your RTP, there is no question created on ULIP. So my gut feeling is that because there is no question created in the RTP, you might directly get a question in your paper. 1010D ka exemption is not available in respect of any ULIP which is issued on or after 1st February 2021 if the premium paid for any year exceeds 2,50,000 rupees. This is called a high value ULIP. Yearly premium exceeds 2,50,000, then such a ULIP exemption will not be available. If an assessee has multiple ULIPs, where each ULIP the premium is below 2,50,000, but the aggregate premium is about 2,50,000, then all those policies where the premium is up to 2,50,000 exemption is available. But the other policies, the exemption will not be available, the maturity amount will become taxable for you. All these are, of course, for all the ULIPs which are issued on or after 1st day of February 2021. So you got to take care about this. The examiner may give you an example of a ULIP. Premium is about 2,50,000 but issued before 1st February 2021. This amendment does not apply. You will get exemption without any problem. This amendment, the taxability is only for ULIP issued on or after 1st February 2021. Single ULIP about 2,50,000 ka premium taxable. Multiple ULIPs where each ULIP the premium is below 2,50,000 but the aggregate goes above 2,50,000. Then all those ULIPs where it is up to 2.5 lakhs, you will get the exemption. Balance ULIPs, it will become taxable. Such a ULIP, such a policy which is getting covered by the 4th proviso and 5th proviso is included in the definition of capital asset now. Capital asset definition has been amended. Even if it's a ULIP where the premium is about 2,50,000, but if you receive the money on the death of a person, then the amount is exempt. Amount is taxable. 4th and the 5th proviso are making it taxable if you are going to receive the money on maturity of unit linked insurance policy. It is to be treated as a capital asset. That means capital gains will be taxable. Full value of consideration will be whatever is the amount received, including the amount allocated by way of bonus. Whatever is the amount received, the received amount will be treated as a full value of consideration. It will be taxable in the previous year in which such amount was received. Such a ULIP can also be an equity oriented ULIP. I will pay premium, my money will be invested into equity shares, I will get units for the premium. So it could be a equity oriented ULIP. Then even 112A has been amended and an equity oriented ULIP will be covered by 112A. Correspondingly, it means if this equity oriented ULIP is a short term capital asset, so even 111A will be applicable. If it is a long term capital asset, so 112A ka benefit will also be available. So these are your amendments relating to ULIP. Second amendment, 99%, all of us, all faculties are 99% sure that there will be a question based on this: reconstitution or dissolution of specified entity. Specified entity means partnership firm and AOP. There is somebody called a specified person, which means if I am talking about a firm, specified person means partner. If I am talking about an AOP, it means I am talking about a member. We are talking of a situation where specified entity is giving to specified person either money or capital asset or stock in trade as a combination. Two out of these three things, or any one could also be given. Two sections to study. First 9B, second 45.4. After that 48 clause number 3. Along with 45.4, you will also study rule number 8AA and rule number 8AB. Government came out with a circular and that circular has given examples, and so according to the circular, this is the sequence. First 9B, then 45.4 and then 48.3. So we'll go in this sequence only. 9B applies in case of dissolution and reconstitution. Either in case of dissolution or reconstitution, the firm, the entity is transferring capital asset or stock in trade. If it is capital asset, capital gains will be taxable. If it is stock in trade, PGBP will be taxable. Who will pay tax? The entity will pay tax. The year in which it is received by that partner or member, that is the year in which it will be taxable. For income tax calculation, you have to take fair market value for computation purposes. This is 9B. Now, after applying 9B, you have to first do the computation as per 9b. Now if there is dissolution happening, it's over, the form, the AOP is getting dissolved, finished, matter over. But if it's a case of reconstitution, now what do I mean by reconstitution? Where there is retirement of a partner, death of a partner, ceases to be a partner, when there is admission of a partner, or where there is no change in the partners but their profit sharing ratio is changing, then these are considered as cases of reconstitution. If reconstitution happens, then 9b will apply, and along with 9b 45.4 will apply. In 45.4, we are only talking about capital asset and money. Either capital asset is given or money is given or both are given. Who will pay tax? Again, the entity will pay tax. Capital gain will be the head because it's capital asset. Taxable amount A is B plus C minus D. Now what is B? B is the amount of money. C is the FMV of the capital asset. D is the balance in the capital account of that partner who is receiving it. Money plus FMV of capital asset minus the capital account balance will be A. If this A is negative, then it will be treated as 0. So you cannot compute a loss as per this section. It will be negative where you are giving money plus stock in trade. Then there is a possibility that this becomes negative. Or you are giving capital asset plus stock in trade, then there is a possibility it can become negative. So if the answer is negative, you will consider it as 0. If there is reconstitution, 45.4 will apply. In addition to 9b, they have expressly mentioned it. This A amount that you are getting is taxable under capital gains. So is it taxable as short term or is it taxable as long term? So then what the act is doing is, it is saying income tax rules will tell you this. Whatever are the balance capital assets, we will classify these balance capital assets into either short-term capital asset or long-term capital asset. Then we will do revaluation of these balance capital assets. So we will take their income tax value, income tax book value, or income tax cost of acquisition, or income tax WDV. We will do revaluation on the basis of the registered revaluation report, and whatever is the revaluation, in that ratio, in the ratio of the revaluation done, the 45.4 amount will be allocated. And if it is allocated to those remaining assets which are short term, that much amount will be short term capital gain. Allocated to the remaining assets which are long term, that much amount will be treated as long term capital gain. This short term and this long term capital gain is that A rupees. A amount is divided into these two categories. So how much of it is short term and how much of it is long term is going to be decided on the basis of the balance capital assets. Now, to prevent double taxation, although double taxation is currently happening in 9b and 45.4, but to prevent double taxation further, there is an amendment that has been introduced in 48.3. In 48.3, we are saying that whatever amount is taxable under 45.4 will be attributed to the remaining capital assets. The amount attributed to remaining capital assets. And the same way in which we found it as short term or long term, same thing will be done. Remaining capital assets revaluation will be done, and based on that revaluation, certain amount, for each amount an allocation will be done. So when those remaining capital assets will be sold in future, keep your eyes on the screen for a minute. In future, when we do computation of capital gains, we will reduce from the full value of consideration this amount, which has become taxable today under 45.4. In future, that amount will not be taxable. So, some time ago when we were revising the formula under section 48, we had seen this. Amount taxable under section 45.4 attributable to the remaining capital assets, we will reduce this amount. So that implies that to that extent we are going to pay lesser tax in future. So today you are paying tax under 9b as well as 45.4, but for remaining capital assets the capital gain amount will be slightly lower. This is your amendment relating to reconstitution and dissolution. Remember, If it is dissolution, then there is no need to go to 48.3. If it is dissolution, the entity is getting dissolved, matter is over. Only if it is reconstitution, that is where you will have problems. RTP question number 1, MCQ number 1, I should say. You have a question based entirely on this reconstitution dissolution. I am 1000% sure you would have solved it. Just telling you, when you go for your exams, just go through that MCQ once. This is a small table that I've put up. Okay, when will 45.4 apply? When will 9B apply? When will both apply? So if it's dissolution, it is only 9B everywhere, capital gain or PGBP. If it's reconstitution, then 9B can apply, 45.4 can apply, only anyone can apply, both can apply. So just a combined effect of thinking of various possibilities. This brings us to the end of capital gains. There are 4 amendments in capital gains: ULIP amendment, reconstitution, dissolution of specified entity; third, the amendment relating to goodwill; and fourth, the amendment relating to slump sale. Capital gain revision gets over. Now we will proceed to revision of our major head of income, PGBP. So, next head of income to revise, your compulsory question of 14 marks: profits and gains of business profession. Now we all know how the computation is done. You start with net profit, expenses which are to be disallowed are added, incomes which are taxable as PGBP but not credited to the P&L account are to be added, expenses which are debited to the P&L account, expenses which are not debited to the P&L but they are going to be allowed as a deduction, will be deducted, will be reduced, and incomes which are taxable under other heads, incomes which are taxable not at all exempt, they will be reduced. And then you'll get your taxable PGBP. This is to be included in your gross total income. If at the end of this computation you have this as a negative answer, it means this is your loss under the head PGBP, which you will use for set off and carry forward. Expenses allowed, disallowed, incomes taxable, not taxable will be as per your ICDS provisions, as per the sections of Income Tax Act, as per various case laws, various judgments. So computation format, the way in which we are going to present our solution, pretty obvious. I'm sure everybody knows this from CA intermediate actually. Charging section 28 gives you a list of incomes which is taxable as PGBP. Just one reading needed, nothing great. Any business, any profession carried on during the year, profits or gains arising will be taxable as PGBP income. If you have a contract relating to business and in that contract there is any termination, there is any modification of the terms and conditions, and because of that you are getting any compensation, that is your PGBP income. If a trade association, professional association is providing specific services to its members and deriving some income, that will be taxable. Generally, their incomes are exempt based on the doctrine of mutuality. But if you provide specific services to members, it will become taxable. Export incentives like cash compensatory support, duty free replenishment certificate, duty entitlement passbook scheme, duty drawback. All these are export incentives that are related to PGBP. They are taxable. In fact, related to export incentives, in the chapter of deductions, you might remember studying this. Okay, chapter 6A, part C, deduction, income based deductions, and deduction under section 10AA are not available towards export incentives. Liberty India Supreme Court judgment says that if you want export incentives, it is definitely taxable as PGBP, but it will not be entitled, not be eligible for your profit based deduction. Any benefit, any perquisite arising in the course of business or profession, this talks about a non-monetary benefit, but since it is related to business or profession activity, it will be taxable for you. As a partner, when you receive interest, when you receive remuneration, salary, commission, etc., these are the incomes that are taxable. As a partner, when you get share of profit, that share of profit is not covered under section 28. That share of profit is exempt from tax for the partner. For in the partner, it's only interest, it's only the salary which is taxable. Whatever will be disallowed to the firm, that shall not be taxable under section 28. What will be taxable under section 28 is only the amount that is allowed as a deduction to the firm. partner will pay tax only on that much interest, that much salary. If you receive any type of non-compete fees, not doing any activity, not sharing any patent, trademark, copyright, then those non-compete fees are taxable as PGBP. But if the amount received is of a capital nature, not doing any business profession activity, not doing any manufacturing, then it is going to be taxable under capital gains. So therefore, PGBP ka charging section will not apply. When stock in trade is converted into capital asset, the fair market value of this stock in trade on the date of conversion will be taken for your PGBP computation. Keyman insurance policy, if any amount is received by way of Keyman insurance policy, then that amount, if received by employer, will be taxable under the head PGBP. If received by employee, will be taxable as income from salary. If received by any other person, it will be taxable as income from other sources. In terms of a Keyman insurance policy, the exemption under section 1010D is not available, and therefore when you get money from a Keyman insurance policy, TDS provisions are applicable. TDS under section 194DA will apply. When we revise TDS, we will see this also. TDS under 194DA will apply. Tax will be deducted at source by the insurance company. If you have taken a deduction under section 35AD for a particular fixed asset, and then now you are selling that fixed asset, you are discarding it, it is destroyed, and for that you are getting some income, then that sale proceeds are taxable as your PGBP income. This cost was fully allowed as a deduction, so the sale amount is fully going to be taxable. Speculation will be treated differently because of the nature of speculation. कि भाई speculation loss can be set off against speculation profits only. You can carry forward the loss only for a span of 4 years. In future also, it will be set off against speculation profits only. Some simple case laws relating to PGBP. Very old case law, quite famous, Lakshmi Vilas Bank. If margin money is taken by the bank and forfeited by the bank for defaulting customers, that margin money will be treated as PGBP income and it will be taxable. Next two case laws, Chennai Properties and Investment and Rayala Corporation. The crux of both the case laws is that if you earn rent income from property and this is your main business activity, earning rental income by giving properties on rent, then this will be taxable as PGBP. Rental income will also be taxable as house property, so you cannot have a thumb rule. It depends on the facts and circumstances of each case. So rental income, if pursued as a business activity, is PGBP. Otherwise, it will be taxable as house property. Like see this Calcutta High Court judgment, where for a builder, flats are held as stock in trade. So the profit by selling the flats will be PGBP. But if the builder earns rental income, then this rental income is house property. He did not construct the flats to be given on rent. He constructed the flats to sell it, but now he's earning this rental income, which is an ancillary extra income, which is not his PGBP income. It will be taxable as house property. Another recent Supreme Court judgment, Henkel Speak India Limited, when the company receives allotment money, when the company receives application money, and on that application money, there is some interest income accrued, then this interest income that is accrued cannot be treated as income the moment it accrues. It will be treated as income of the year in which the allotment process is completed. So when the final allotment process is completed, excess money has been refunded back and money has been retained by the company for all those applicants to whom shares are allotted. That is when the company will be able to say, okay, yes, this is my money, and therefore only in that year you can recognize the interest income as income of that year. Another Supreme Court judgment, it was there in your 2018 judicial update of given by Institute, Venkatesh Premises Cooperative Society. Certain incomes like transfer charges that a society gets when a flat is sold, uh, incomes like non-occupancy charges. If the owner does not occupy the property himself and gives it on rent, the society takes non-occupancy charges, NOC. Then, if repairs were to be done, and a fund is maintained, and every month some contribution is made to that fund. All these incomes are for the benefit of all the members. The contributors are the members, the beneficiaries are also members. So based on the principle of mutuality, all these incomes will be exempt. The benefit is derived by all those guys who are contributing. So I am only contributing and I am only getting the benefit of my contribution. So society will not pay tax on any surplus. So these incomes are also exempted. And then uh, last case law, which finds place in your study material. Uh, the supplier of plant and machinery could not supply the plant and machinery, and therefore, so because the supplier was not able to give plant and machinery, then he paid certain amount as compensation, he paid certain amount as damages. Now these damages are related to plant and machinery, so it means it is damages relating to a capital asset, something that is capital in nature. So it cannot be treated as a revenue income, it is treated as a capital receipt, and a capital receipt which is not subject to tax, which is not taxable for the assessee who is receiving the compensation. 145, something very simple. 145 subsection 1 says PGBP and IFOS will be calculated according to cash or mercantile system, whatever is regularly followed. The central government also has the power to notify ICDS, and every assessee will have to follow the ICDS. If method of accounting is not regularly followed, if ICDS are not followed, if the accounts are not correct, if the accounts are not complete, assessing officer has the power to do best judgment assessment as given in section 144. 145A tells you that when you do valuation of purchases, sales, closing stock, opening stock, any tax, any duty, any cess that you are paying on those goods and services will be part of your opening closing stock, will be part of your purchase and sale. Everything will be computed. P&L account will be prepared in an inclusive manner. If they are listed securities, you have to do the valuation as cost or NRV, whichever is lower. If they are unlisted securities, you have to recognize them as at cost. Any other item held as inventory, cost or NRV, whichever is lower. This applies to opening stock also and closing stock also. Listed securities, you have to do it on a category wise basis. Otherwise, you have to do it in the normal course. 145B, taxability of certain income. This section tells you when a particular income will be chargeable to tax, in which year. If you get any interest on compensation or enhanced compensation, it is taxable in the year in which it is received. If there is a claim for price escalation, or if there is export incentive, taxable in the year in which reasonable certainty is received. Yes, you will have that income. It is sure, or it is accrued in your favor. If it is subsidy income, then if not taxed in earlier previous year on accrual basis, then now it will be taxed on receipt basis. If you get subsidy towards cost of fixed assets, it is not your income because it will be reduced from the cost of the fixed asset, so you will not pay tax on that income. If an institution established by the central or the state government, any subsidy that a central or a state government institution receives from central government, which is meant to be part of the corpus of the trust, that is also not recognized as income, and therefore you will not pay any tax. If it is not for corpus, if it is not for fixed asset, then it is your income. If you are not a central state government institution, but somebody else, then it is treated as your income. If the giver of the subsidy is not central government but any other government or any other agency, then it is treated as your income. Now, coming to the expenditure part, major section, section 32. Now here though, we'll go through it very quickly. Two types of depreciation: normal depreciation, additional depreciation. Normal depreciation is allowed to all assessees who are in the generation of power business or business of generation and distribution of power. Generation of power or generation and distribution of power. They are entitled to, or they have an option of claiming depreciation on actual cost basis, or they can be claiming depreciation on WDV basis. Switching is not possible. The first return of income that they file, they have to choose any one option and then accordingly follow it. All other assessees will always claim depreciation on WDV basis. Four blocks of tangible asset: machinery, plant, furniture, building, One block of intangible asset. Intangible asset will include patent, trademark, copyright, license, franchisee, but goodwill of a business, goodwill of a profession will not be included as per the amendment. Block is always prepared on 31st March of the year. As on 31st March of the year, after taking into account all the assets sold, assets acquired, if there is positive value in the block, if there are positive assets in the block, you will depreciate. If block turns negative, if the value of the block becomes negative, you will calculate short-term capital gain. If block ceases to exist because all the assets are sold and as on 31st March you have nothing in the block, then there will be short-term capital gain or short-term capital loss depending on the sale amount and the WDV. Depreciation, if it remains unabsorbed, it will be carried forward under section 32 subsection 2. You can set it off against any income. You can set it off against all incomes, including salary income, including winnings income. It can be carried forward without any maximum time limit. There is no compulsion to file a return of income under 139(3). You can not file a return and still carry forward unabsorbed depreciation without any problem. Additional depreciation. Additional depreciation is allowed only to certain assessees. Number one, you must be into manufacturing. Number two, you are into generation of power or generation and distribution of power. But as this assessee, if you are claiming normal depreciation on actual cost basis, then additional depreciation will not be allowed to you. Additional depreciation will be allowed only to that assessee who claims normal depreciation on WDV basis. Additional depreciation is calculated at 20% of the actual cost. Actual cost means actual cost as defined in 43 subsection 1. Both normal depreciation and additional depreciation will be allowed at half the rate if the asset is acquired during the year and put to use for less than 180 days. Put to use means active use is also covered, passive use is also covered. The asset should be acquired during the year and put to use for less than 180 days, so it is half rate. For opening WDV, if you want to depreciate, full rate. Asset acquired during the year and put to use for exact 180 days, full rate. Greater than 180 days, full rate. Less than 180 days, half rate. If an asset is partly used for business and partly used for personal purposes, then as per section number 38, assessing officer has the power to determine how much proportion is personal element and that much depreciation will get disallowed because it is personal in nature. If additional depreciation is allowed at half the rate, then balance half of additional depreciation will be allowed as a deduction in the next year. This is only for additional depreciation and not for normal depreciation. Normal depreciation, if it is allowed as half, then it is allowed as half only. For claiming the benefit of additional depreciation, the block of asset should be machinery or plant. It should be brand new. It should not have been used anywhere else in India or outside India. It should not be office appliances. It should not be road transport vehicles. It should not be installed in office. It should not be installed in guest houses and residential premises. It should be an asset which is assisting you in manufacturing, assisting you in generation, distribution of power. Only then you are entitled to claim additional depreciation on it. Accounting depreciation will be debited in the P&L account, that will have to be disallowed. Normal depreciation and additional depreciation both will have to be allowed as a deduction. If in your accounting books profit on sale of fixed assets or loss on sale of fixed assets is recorded in the P&L, they are accounting profit, accounting losses, tax does not recognize them, so accounting loss will have to be disallowed, accounting profit will have to be reduced from the net profit. During the financial year, if there has been business reorganization, partnership firm is converted into company, sole proprietor is converted into company, private company or an unlisted public company is converted into LLP. If there is amalgamation, if there is demerger, if there is succession of business otherwise than by death, example slum sale or example normal sale of business, then you will calculate depreciation, normal depreciation, additional depreciation both as if the event never took place. Then whatever amount you have calculated, block amount, will be allocated in the ratio of number of days. Allocation is done. Calculation is never done in number of days. Calculation will be done at full rate or at half rate. It will be allocated in the ratio of number of days between the predecessor and the successor. These are the events for which depreciation will be allocated. If the domestic company decides to pay tax at a concessional rate of 115BAA, which is 22%, 115BAB, which is 15%, 115BAC, we saw concessional slab rates at the start of this video, or a cooperative society decides to pay tax at a concessional rate of 22%. Then additional depreciation ka benefit is not allowed. What will be allowed as a deduction to these assessees is only the normal depreciation. Brought forward unabsorbed depreciation will have to be analyzed, and if the unabsorbed depreciation pertains to the additional depreciation of the past years, then that additional depreciation cannot be carried forward and set off. If the brought forward unabsorbed depreciation comprises of normal depreciation of past year, that much you can carry forward, that much you can set off. Current year, you cannot claim additional depreciation, you can claim normal depreciation only. For motor cars, this is one small thing that you got to remember. If the motor car was acquired between 23rd of, in the year 1920, but put to use between 23rd August 2019 and 31st March 2020, 2 years ago ka provision, but government had increased the rates from 15% to 30%, from 30% to 45%. So, in your institute booklet of MCQ, there is one specific MCQ relating to this where they have said that motor car has been acquired in this year 1920. So, that is where a student has to remember that this is one situation where if it is acquired in 1920 and put to use in 1920 after 20 on or after 23rd August 2019, but up to March 2020, 30% for a normal motor car, 45% if it is in the business of hiring. We've already studied this provision of capital gains. Block turns negative, block ceases to exist. Cost will always be opening WDV plus actual cost. Gain will always be short-term capital gain. If you are claiming depreciation on actual cost basis, power generation and distribution, then cost of acquisition will be actual cost. Capital gain will always be considered as short-term VS Dempo ka case law. If you are claiming depreciation on actual cost basis, and now you're selling the block and the sale value is below WDV, then whatever is the deficit is called as terminal depreciation and will be fully allowed as a deduction in that year of sale. If your sale value is greater than WDV, there are two further possibilities. Greater than WDV but less than actual cost, or greater than WDV and greater than actual cost also. So, find the sale value, subtract the WDV, this can be understood as your surplus. Compare it with actual cost minus WDV. Actual cost minus WDV means the total depreciation that has been allowed till date. So whatever is the surplus that you are getting or the total depreciation allowed on actual cost basis till date, out of the two, whichever is lower, is treated as PGBP income. If you sell the block not only greater than WDV but also greater than actual cost, so this PGBP income under 41.2 will definitely be there, but the money that you are getting above the actual cost will be treated as capital gains. Cost of acquisition will be as per section 50A actual cost, and this will be your short-term capital gain that will be taxable. Actual cost. Actual cost is the amount that is added into the block whenever an asset is acquired during the year. Actual cost is the amount which is taken as the base for calculating your additional depreciation. Actual cost means actual cost of the assets to the assessee reduced by any amount that has been met directly or indirectly by any other person or authority. In relation to this, there is a very old judgment, Steel Authority of India Limited, where Karnataka High Court gave the judgment that central government had repaid the loan taken by Steel Authority of India. So there was a loan waiver. Loan was taken for purchasing fixed asset. Then Steel Authority of India ran into some financial problems. The loan was waived off because the government directly paid it. That means it was part of the cost of the asset was met by government. So that much loan which was waived off will be reduced from the cost of the asset. Only the net amount will be taken as your cost. If you are capitalizing anything into the block and the amount is greater than 10,000, then you have to ensure that you make a payment through account pay check, account pay bank draft, electronic clearing system, or such other electronic modes as may be prescribed. This is our rule 6ABBA. We saw this in the chapter of capital gains revision. All those internet banking, credit card, debit card, RTGS, NEFT modes of payment. If the cost of your fixed asset is greater than 10,000 and you are making a payment on a single day through the prescribed modes, absolutely no problem. You can capitalize the full amount. But if you do not use these prescribed modes, otherwise than by account pay check. Just an example, what do I mean by otherwise than by account pay check? You could be making a payment by cash, you could be making a payment by bearer check, you could be making a payment by crossed check. Then all these modes of payments are not permitted. If you make a payment through these modes of payment and the amount is greater than 10,000, that much amount will not be allowed to be capitalized. Then in 43 clause number 1 there are these explanations. If an asset was used for scientific research, you have already taken a deduction for that cost of asset. You've already taken a deduction for the cost of that asset which is used for scientific research. By chance, if some amount could not be taken as a cost, just a second. By chance, if some amount could not be taken as a deduction under section 35, yeah, whatever deduction was allowed to you under section 35, you have to deduct that amount here. Only the balance amount remaining will be your actual cost. This amount could be zero or could be something positive. It could be positive provided you were unable to take the full deduction under section 35, then some cost will remain. Then you can take that cost, add it into the block and thereafter depreciate it. If stock in trade is converted into capital asset, the fair market value of stock in trade will be taken as your actual cost. If asset is acquired by gift or inheritance, take the cost to the previous owner and whatever depreciation was allowed to the previous owner, deduct that amount. So in other words, find the WDV in the hands of the previous owner and that will become your actual cost. When holding company is transferring a capital asset to subsidiary company, if, if these two conditions are satisfied, full share capital is held by holding company, whichever company is the transferee company is an Indian company, then for the seller company, capital gain is fully exempt. Then whatever was the opening WDV plus actual cost for the transferor company, this will become the actual cost now for the transferee company. Seller company has enjoyed exemption in the chapter of capital gains. Buyer company will take that cost only, which is the cost for the seller company. Same concept applies in case of amalgamation. If amalgamating company transfers a block of asset to amalgamated company, and if the amalgamated company is an Indian company, so amalgamating company is going to enjoy capital gain exemption, and whatever is a WDV and actual cost for amalgamating company will be now taken as cost of this asset, actual cost for the amalgamated company. Same thing for demerged company also. Demerged company का opening WDV and actual cost of assets acquired during the year will now become the actual cost for the resulting company. Many a times this comes up in your MCQs, very simple. If you have taken a loan for acquiring a asset, a fixed asset, then up to the date it is put to use, up to that date, you can include it into actual cost, and after that date, it will be treated as a revenue expense which you will be entitled to take as a deduction under 3613. If you had taken a loan and that surplus loan was deposited in the bank and on that deposit some interest income is received, then that interest income will be taxable as income from other sources. The interest that you are paying on borrowed funds will be capitalized, paid, and the interest income you are free to use wherever you want to use that. So it will not be reduced from the cost interest income. Interest income will be separately taxed as income from other sources. When you acquire a fixed asset and if you are taking, for example, a GST input tax credit, then you cannot take that GST component, add it into the cost. There is a reverse provision existing in GST law also, that if you are capitalizing the GST component, you cannot take an input tax credit. So both of them are not possible. You got to do any one thing only. Either you capitalize the GST component, then don't take input tax credit, or if you are taking input tax credit, explanation number 9 is saying you cannot add that GST component into the cost of the asset. If you get any subsidy, grant or reimbursement for a fixed asset, if it is towards a specific fixed asset, directly reduce the subsidy from the cost of that fixed asset. If it is towards a group of fixed assets, it is generally given to you not for a specific asset but 4 or 5 assets. Then in the proportion of their cost, you will reduce the subsidy. The net amount remaining will be taken as your actual cost. If there is an asset for which 3580 deduction has been claimed, and now you are introducing that into the block, for example, its cost is going to be zero only. But 3580 has a lock-in period of 8 years. And in these 8 years, if you start using this fixed asset not for a specified business, but for example, you start using it for a normal business, then what was the actual cost of the assessee? This is the amount for which you had taken 100% deduction earlier. Start with that amount. The amount of depreciation that had been that would have been allowable if the asset was used in business and part of the block, that you will deduct. And this amount that you get, this net amount will be taken as actual cost. When we do this in 35D, we'll see this once again. The concept is that if your asset is part of is in the specified business, you are supposed to use it in the specified business for 8 years. If you withdraw it from specified business and start using it somewhere else, actual cost minus notional depreciation, net amount is treated as your income taxable, and you have to pay tax on that income as income of the specified business. Now that the asset is in normal business, this net amount will be added into the block of asset for this normal business and it will be further depreciated. If all of this happens after 8 years, there is absolutely no problem. After 8 years, if you withdraw the fixed asset from specified business and use it into normal business, the cost will be taken as zero only. So this was your section 32 revision of depreciation. Towards the end of PGBP, we will still be left with one small provision which will touch this fixed asset wala thing, foreign currency fluctuation. When we come to that section, we'll see what it is. Moving ahead, 35D, amortization of preliminary expenses. Some recent case laws. Concept is very simple. If there is a possibility you might have an MCQ on it, chances are very less. The deduction is allowed if you are a resident person or an Indian company. Preliminary expenses are amortized over a span of 5 years. Preliminary expenses are incurred before the commencement of business, or if you have already commenced the business, but you have expanded your business, you have started a new undertaking, and relating to that new undertaking, relating to that extension, that expansion, you are incurring certain expenses which are preliminary expenses, then this deduction will be allowed. The full amount of preliminary expenses will not be allowed. Preliminary expenses will be compared with a certain maximum limit. Then we will find an eligible amount. That eligible amount will be spread over 5 years. What is that maximum limit? For an assessee other than Indian company, 5% of cost of project. For an Indian company, take the cost of project, compare it with capital employed, take the higher of the two, 5% of the higher amount or preliminary expenses incurred, whichever is lower, is eligible amount. So there are two terms that we need to study: cost of project, capital employed. Cost of project means land, building, leasehold, plant, machinery, furniture, fittings, railway sidings. That means in simple terms, this is land plus our tangible block of fixed asset. Land is never part of block of asset, so I write down land plus tangible block. Find the actual cost of this land plus tangible block as defined in 43.1 as on the last day of the previous year when the business is commencing, or when that extension that we are done is ready. When that extension is over and you are starting the new undertaking, when that new undertaking starts business activity, 31st March of that year. That is cost of project. Capital employed will obviously be only in case of Indian company. Aggregate of issued share capital, debentures and long-term borrowings, again to be taken on 31st March of the year. There was a very small case law relating to this. Once or twice it had come up in your paper. Issued share capital does not include share premium. Share premium is something separate. Issued share capital means we have to take the face value only. See this. Share premium collected by the assessee is not part of capital employed. Berger Paints India Supreme Court judgment. Second judgment. Again something important. The share application money that is deposited with the bank is not to earn an extra income. It is because of Companies Act that you have to separately deposit it. So the interest that you are getting is not liable to be taxed as income from other sources. We have already studied in Henkel's Pick case law that the previous year for which it is to be treated as income is the year in which the allotment process is completed. Now in Sri Ram Multitech we are seeing it is not taxable. It is eligible to be set off against public issue expenses. Public issue expenses are covered by 35D as preliminary expenses. So related to this public issue of shares, if there is some interest income that you are getting, you will not pay tax on it. You will reduce it from the public issue expenses. Now, combinedly, what you need to think is, see, Henkel's Pick told us it will be treated as income of the year in which allotment is completed. Sri Ram Multitech is telling us it is not taxable as IFOS, but it is to be set off against public issue expenses. Now there is another case law covered under 37(1) which said that Brook Bond India Supreme Court judgment, share issue expenses are capital in nature, so you can't claim it as a revenue deduction. If it is possible to claim it as a deduction, you can take it under 35D only. That means putting all three together, if you have incurred share issue expenses for before commencement of business or in connection with extension, then this is covered under 35D. Then share issue expenses will be amortized over 5 years, but any interest income that is accrued will be reduced, only the net amount will be amortized. Suppose your interest income is greater than the share issue expense, then there is no expenditure to amortize, only the net amount will be covered under 35D if there is a net expense. But if there is a net income, this income is a capital receipt and not liable to tax. We have already seen it is not taxable as other sources, Sri Ram Multitech. If there is any other case, so if it is, let's say, a normal issue of shares, not normal issue of shares where the company just wants to raise capital from its shareholders, but there is no commencement concept, there is no extension, then 35D does not apply. Then share issue expenses are capital, therefore not allowed as deduction. Logically, interest accrued is a capital receipt which is not taxable. Capital expenditure is not allowed as deduction and capital receipt is not taxable. The only possibility of taking it is 35D, but if 35D does not apply and it's a normal issue of shares, then expenses on share issue not allowed as deduction and interest income is not taxable. Going ahead, 35AD specified business. Once just read this list of specified businesses, because many a times the examiner gives you the business in the question but does not tell you that it's a specified business. He may give you some other hint, but he will not directly mention it's a specified business. Then a student is expected to know that these businesses are specified. 35AD says capital expenditure will be given 100% deduction, but cost of land, cost of goodwill and financial instruments will not be covered by this section. Land is anyways not allowed as a deduction under any section, land ka cost. Goodwill used to be covered in the block, used to be covered as block of assets and we used to depreciate it. Because of the amendment, goodwill will no longer be part of block also. So section 32 also does not apply. Goodwill is not covered under 35AD also. Financial instruments, shares, debentures, mutual fund units, bonds, they cannot be treated as capital expenditure on specified business. They are a capital asset by themselves, and under capital gains we will do the calculation. Cost will be subtracted there, not from PGBP. Even here, the concept of that 10,000 rupees is applicable. That if a particular fixed asset is purchased and you want to take it as a deduction under 35AD and the amount is greater than 10,000, on a single day when you make the payment, use the prescribed modes, you will get the deduction. use cash, bearer check, cross check, prohibited modes, you will not get a deduction. 35 AD now is optional for you. As an assessee, if you want, you can take a deduction of 35 AD. You can take a 100% deduction of the cost of fixed asset. After that, if there is a profit, you pay tax. After that, if there is a loss, that loss can be carried forward, section number 73A, without any maximum time limit. You can easily carry forward it indefinitely. But this loss will be set off against profits of specified business only. And if you want to carry forward this loss, you have to follow 139.3 and file your return of income on or before the applicable due date. Only then the carry forward will be allowed. 35 AD is an optional deduction now. So what does this mean? If an assessee decides not to go for 35 AD, then all those fixed assets which he has installed during the year, he can classify them into the relevant block and claim depreciation under section 32 for those fixed assets. Earlier 35 AD was compulsory, now it is optional for you. If you are an assessee who is paying tax as per concessional rates, 115 BAA, 115 BAB for domestic companies, 115 BAC for individual, 115 BAD for cooperative societies. If you are paying tax as per the concessional tax rates, then 35 AD cut deduction will not be allowed to you. You can classify all those fixed assets into block, but because you are paying tax under those concessional sections, even in block, only normal depreciation will be allowed, additional depreciation will not be permitted. Coming back, if you are taking a deduction under 35 AD and you're talking about plant and machinery as your asset, it should be brand new. It should not be second hand in nature. But a small relaxation is given here that in a specified business, up to 20% of the total value of plant and machinery. And what is the meaning of total value? Total value will include new value also and old value also. The old machine can be up to 20% of the total. If old machine is up to 20% of the total machine, then that old will be deemed to be new. It means condition is satisfied. It means 35 AD is available. If the old component in the total value of plant and machinery is more than 20%, then 35 AD as a section does not apply only. Then you will have to take the entire deduction of all the fixed assets by putting them under the relevant block and claiming depreciation under section 32. If you are doing a specified business, but that specified business is in a special economic zone SEZ, which means you are entitled to 10 AA, or you are entitled to chapter 6A part C deduction, then either you can take 35 AD deduction of fixed asset cost, or you can take a deduction of these profits, but you can't take both. And you can't keep on switching the choice from one year to another. So it is either 35 AD or these profit based deductions, but you won't get both. Please remember, it is not the entire chapter 6A which has become ineligible. Chapter 6A part C cannot be claimed. Chapter 6A part B, life insurance premium, medical insurance premium, donation given, political party donation given, ATC, ATD, all those sections you can take a deduction. ATTTA, ATTTB, those deductions can be claimed. Only income based deductions cannot be claimed by the assessee who is taking a deduction under 35 AD. Then we already saw two of these aspects earlier, 20 minutes ago. If a fixed asset is covered by 35 AD and you sell off that fixed asset, then the sale proceeds are fully chargeable to tax, charging section 28. If you have claimed a deduction for a fixed asset under 35 AD, for a period of 8 years, it has to be used only for the specified business. This is the lock-in period concept. In the 8 years, if you sell it, it is covered under 28, matter over. If you sell the fixed asset, whether within 8 years or after 8 years, sale proceeds are always taxable as PGBP. But instead of selling it during the lock-in period of 8 years, if you start using it for some other purpose, for some other business, then cost of that fixed asset will be treated as taxable for you, but not full amount will be taxable. It will be assumed that this fixed asset was part of the block from the beginning, and then whatever depreciation you should have been allowed in those past years, that much will be subtracted. Balance WDV that remains will be subject to tax for you in the profit of the specified business, you will add that net amount. And if this asset is used for other normal businesses, we saw that it will be covered in the block of asset. 43 clause number 1 explanation 13 says that this net amount will be taken as actual cost, will be capitalized in the block, and henceforth you will depreciate it. Then there is another point relating to 35 AD. I have not put it up here in the notes because frankly speaking it is not part of PGBP. The thing is, if you are claiming a deduction under 35 AD and the assessee is anyone other than a company, then for you the provisions of alternate minimum tax AMT will be applicable. AMT provisions will apply. You will have to pay tax according to the regular tax. You have to calculate tax according to the regular provisions, and you will have to also follow AMT provisions. AMT gets subtracted if either you take chapter 6A part C deduction, 10AA deduction, or the third thing 35 AD deduction. So if you have claimed 35 AD deduction, but you are not a company assessee, you are a firm, individual, HUF, then AMT provisions also get attracted to you. AMT provisions are also equally applicable to you. This is your 35 AD. Section 35, expenditure on research. Very easy section. 3-4 years ago, there used to be a concept of weighted deduction, etc. Now the government has made the provision really very easy. You will get 100% deduction. All that you have to do is to remember what all things are covered here. If you incur revenue expenditure for scientific research which is exclusively done for the assessee only, then you get 100% deduction. Whether you pay tax as per the budget rates or you pay tax as per these concessional sections, you will get a deduction of revenue expenditure that you have incurred on your own. If you have incurred revenue expenditure for scientific research before the commencement of business, pre-commencement expense, then that will be allowed as a deduction in the year of commencement. But only the immediately preceding 3 years ka expenditure becomes eligible here. Like there is revenue expenditure, suppose there is capital expenditure which you have incurred for scientific research on your own. Land cost though anyways is not allowed, but any other capital expenditure, building, machinery, furniture, scientific research equipments, any other fixed asset, deduction will be allowed whether you decide to pay tax as per budget rates or concessional rates. If capital expenditure remains unabsorbed due to lower profits, then the way we carry forward unabsorbed depreciation, we will carry forward this amount also without any time limit. Again, to carry forward this amount, the provisions of 139(3) are not applicable. So it is not compulsory or mandatory for you to file a return of income, only then the carry forward will be allowed. No, you can carry forward this loss without any problem. Capital expenditure remaining unabsorbed can be carried forward. There is absolutely no issue at all. If you are a company, only if you are a company who is engaged in the business of biotechnology or who is engaged in the business of manufacturing, and you yourself incur cost of assets, land cost not allowed, building cost also not allowed under 35(2) AB. Under the normal section 35(2), like any other scientific research, building cost can be claimed as a deduction. Any other capital expenditure and all type of revenue expenditure, you will get 100% deduction. But now comes a situation that if the assessee is paying tax as per concessional rates, then this deduction will not be allowed. If you are paying tax as per concessional rates, then the clarification that I'm trying to put up here is, if you are paying tax as per concessional rates, then the act is saying that by 35(2) AB is not available to you. So other fixed assets, you can take a deduction under 35(2). 35(2) is available to assessees paying tax as per concessional rates also. Building cost you can claim under 35(2). Other capital expenditure If you are paying tax as per concessional rates, no deduction. Revenue expenditure, no deduction. If you're paying tax as per budget rates, you can go ahead, take a deduction without any problem. Now comes the situation of giving contribution, giving money to outsiders. If you give contribution to research association, college, university for scientific research, budget rates, pay tax, allowed, concessional rates, no deduction. If you are giving contribution to Indian company whose main objective is scientific research, same provision, concessional rates, you won't get the benefit. Budget tax rates, you can take a deduction. If you are contributing to national laboratory or IIT for a specific program approved, budget rates, you'll get a deduction. Concessional rates, no deduction. And if you are giving money for statistical research, social science research, those contributions will be allowed as a deduction only if you pay tax according to budgets. Finance Act ka rate. If you pay tax as per concessional rates, so you can observe outside contributions are not allowed. 35(2)(ab) is not allowed. Self-incurred expenditure, revenue and capital expenses are allowed if you pay tax as per concessional rates. Other points, 41(3) relating to income. If your fixed asset is sold without using for business, then take the sale proceeds, add back the deduction, subtract the actual cost. This excess amount or the amount of deduction that has been allowed to you, whichever is lower, will be treated as taxable. And then sale proceeds minus the actual cost will be taxable under the head capital gain. So to the extent deduction has been allowed to you, that much amount of profit will be taxable under the head PGBP 41 subsection 3. If your sale proceeds is greater than the actual cost, then that excess will be taxable under the head capital gains. This is something that we saw if an assessee claims depreciation on actual cost basis, more or less it is on the same lines. Sale proceeds above cost is taxable under capital gains. Up to the amount of deduction that you have taken, PGBP section will apply. Here the section number is 41(3). For actual cost, it was 41 subsection 2. If you are an assessee whose GTI does not include PGBP income, and you are making contributions to scientific research and social science research, then you will get a deduction under 80GGA. But if the payments are made exceeding 2000 in cash, then deduction will not be allowed. Got to remember that this assessee that I am talking about is an assessee who pays tax as per Finance Act rates and not as per the concessional tax rates. Because if you pay tax as per concessional tax rates, anyways chapter 6 deductions are not allowed to you, so 80GGA will also not apply. So if you are an assessee who is involved in PGBP activities, then section 35 will apply. If you are an assessee who does not have PGBP, then 80GGA will apply. But here we are talking about an assessee who does not pay tax as per the concessional rates, paying tax as per the Finance Act only. This was your section 35. Chalo. Going ahead, let's talk of deductions under section number 36. Deductions under section 36. One of them is, always part of your question number 1. One of these clause numbers will be there. Either there'll be bonus or commission, or there'll be something relating to interest. Bonus and commission is allowed as a deduction, but 43B applies, so deduction will be allowed on payment basis. Many questions have this bonus wala concept where they tell you payment is made in the next year, so you have to apply 43B. So bonus and commission is allowed as a deduction on payment basis, which means if bonus is paid during the year, allowed as a deduction in that year only. If bonus is paid after the previous year ends, but on or before the applicable due date, then also deduction will be allowed in that year only. If bonus is paid after the due date of filing return, then in the year in which the actual payment is made, deduction will be allowed in that year. And in the current year, you'll have to disallow the bonus. A very small case law. There was a dispute between the employer and the employee about the amount of bonus. So he created a trust and he transferred the bonus amount to that trust. The dispute got resolved in time. On the very next day, the trust paid the bonus to the employees, and all of this happened
before the due date of filing return. But just because he had made the payment to trust and then trust had made the payment to employees, the assessing officer was denying the deduction to the employer. Supreme Court said that deduction will be allowed because looking at the substance of the transaction, payment has been made on or before the due date. Giving it to a trust is just separating out the money that will not hamper your deduction. You will get a deduction. 3613 interest in respect of capital. Capital should be borrowed for the purpose of business profession. It should be borrowed capital and not your own capital. Interest expense will be allowed as a deduction. If the capital is borrowed for acquisition of a fixed asset, then up to the date the asset is put to use, you will have to add it into the cost. 43.1 explanation 8. After the asset is put to use, it will be treated as a revenue expenditure and you will take a deduction under 3613. Certain cases you will have to follow TDS provisions when you pay such interest. If TDS provisions are not complied with, then the interest expenditure will get disallowed. Section number 40, clause number A, 40 small a. If if you have taken a loan from bank, public financial institution, state financial corporation, state industrial investment corporation, certain non-banking financial companies, then 43B applies. Make the payment of interest on or before the due date, take a deduction in the current year. Make the payment of interest after the due date, it will be disallowed in the current year and the interest will be allowed as a deduction in the future year when you make a payment. Normally speaking, if 43B does not apply, then interest will be allowed as a deduction as per the method of accounting followed by the assessee. What are those selected NBFCs? An NBFC, number one, an NBFC which accepts deposits from the public, that is a selected NBFC. From this NBFC, if we have taken a loan, the interest expense will be allowed as a deduction as per 43B. Second, an NBFC who does not take deposits from the public but has a total assets of 500 crores or more. Such an NBFC is called as systemically important non-deposit taking NBFC. For this NBFC, if such an NBFC is the lender and we are the borrowers, then we will get a deduction of interest expense only when 43B is satisfied. Every other NBFC will not be covered by 43B provision. The borrower will get a deduction of interest expense according to the regular method of accounting followed by the assessee. Two important case laws, SA Builders and Hero Cycle. If you borrow money and give that money as an interest-free loan to your sister concern, you have borrowed money and incurred interest expense. If you can justify that the money was borrowed for business purposes, the money was borrowed keeping in mind commercial expediency, then you are not getting any interest income from the sister concern, but the interest expense will be allowed as a deduction to you. This is what Supreme Court held in two different cases, but it will be depending on the facts and circumstances of each case. The assessee will have to prove that there was this commercial expediency, commercial necessity to give a loan for business purposes. Taparia Tools versus Joint CIT. Here, the company issued debentures and on the debentures gave two options to those debenture holders for interest. One, interest will be paid every year for 5 years. That's the life of debenture. Second, instead of paying interest every year, a lump sum amount of interest will be paid upfront at the starting, which is obviously lower than the total interest of 5 years. A lower amount is paid, but upfront it is paid. What the company did was, company took a deduction of the upfront amount in the first year itself. Assessing officer spread it over 5 years. Assessing officer spread it over 5 years. But Supreme Court said, okay, since the company has paid the amount upfront in the first year, it has incurred the expense in the first year itself. Once the genuineness was proved, the amount will be allowed as a deduction to you in the first year itself. You cannot spread it over 5 years. All those debenture holders who opted for the lump sum upfront payment for the company, that is an expense incurred in the first year, company will take a deduction in the first year itself. Next, 3613A, discount on zero coupon bonds to be spread over the life of the bond. So you will get a pro rata deduction. The small amendment is that infrastructure debt fund is also now authorized to issue zero coupon bonds. And when such zero coupon bonds are issued by infrastructure debt fund, the discount on that will be allowed as a deduction to the infrastructure debt fund also. 3614 and 3615. 3614 is talking about employers' contribution to recognized provident fund and approved superannuation fund. 5 is talking about approved gratuity fund. So these are all retirement funds. If these retirement funds are recognized or approved by the Commissioner of Income Tax, then you will be entitled to take a deduction. Deduction will be allowed under 3614 or 3615, read with section number 43B. You will get a deduction, but the payment concept will have to be followed. But if by chance these funds are unapproved, if by chance these funds are unrecognized, then first of all, these funds which are unapproved, unrecognized, will be disallowed. They will be disallowed as per section 40A9, and these amounts will be allowed as a deduction in the year of retirement. Here also there is a small, I won't say twist, but there is a small provision to study. Okay, they will be allowed as a deduction, but then employer has to ensure that TDS arrangements have been adequately made. And if they are made, so it's absolutely fine, deduction will be allowed. But if TTS arrangements are not made, then there will be no deduction allowed. This is what is mentioned in 40A sub clause number 4. So if they're recognized funds, approved funds, take a deduction under this section 36, but then you have to follow 43B. If they are unapproved, every year during service period, you'll have to disallow it. Whenever retirement happens, by default allowed. But if TDS arrangements are not made, then it is not allowed. Contribution made towards pension scheme. Employer makes a contribution to pension scheme under clause number 4A. You will get a deduction. But 10% of salary is the maximum deduction that is possible. Some MCQs that you find in your MCQ booklet, not the case scenario ones, but the individual MCQs, some of them have this concept. 36(1) clause number 5A. This is a bit important because of a small amendment that we have. Employees' contribution to staff welfare scheme. Once the employee contribution is deducted from the salary and retained by the employer, first of all, it will be treated as income, taxable under the head PGBP. Then whatever contributions are deposited into the fund on or before the fund's due date, only that amount will be deducted as an expense. First, you take the full contribution as income of the employer. Whatever employer deposits in the fund up to the due date, on or before the due date, will be deducted as an expense. Income minus expense, balance is taxable. The controversy was the meaning of this term, funds due date. Gujarat High Court had given a judgment that funds due date strictly means the due date prescribed by the fund, and 43B will not apply. Due date of filing return will not apply. Whereas Delhi High Court, Rajasthan High Court and Uttarakhand High Court, in 3 different High Court judgments, it was said that by 43B will be applicable, and if you deposit the contribution up to the due date of filing return, deduction will be allowed. All due respect, these 3 High Court judgments were actually wrong, and it was a Gujarat High Court judgment which made more sense because employer was deducting it from employee's salary and retaining the money with him. Then it's a very strict provision because it is employee's money with the employer. You can't allow the employer to enjoy it up to due date of filing return. Then the amendment introduced is clarifying this. The provisions of 43B shall not apply and shall be deemed never to have been applied. So it's a retrospective amendment introduced for determining due date. That means Gujarat High Court judgment has been upheld and these three High Court judgments have been struck down. Now the due date means, strictly speaking, the due date as per the relevant Provident Fund Act. If you miss that date even by 1 day, the amount will not be deducted as an expense. 3617 bad debts. So pretty logical. Okay, by bad debts will be allowed as a deduction as and when you write off the bad debts. The bad debt should be related to your business activity, and the amount which you are showing as a bad debt today, that was a debt, that was something receivable. So that was your income, that was considered as your income, that was considered as your sales, as your fee income. And now because it is turning bad, you are writing it off. So you write it off, you will get a deduction. Subsequently, if you recover bad debts, the bad debts recovery will be taxable under 41 subsection 4. Bad debts recovery will be taxable under 41(4) even if the business has been discontinued in the year of recovery. So if you have discontinued the business and after that you get bad debts recovery, for that year it will be taxable as PGBP and not taxable under any head of income. Banks and financial institutions get a deduction under clause number 7A as provision for bad and doubtful debts. A formula is prescribed, and according to that formula, provision is allowed as a deduction. If you are an assessee who is not a bank, who is not a financial institution, who is a normal trader, manufacturer, or a professional, provision for bad debts are not allowed only as a deduction. Directly, bad debts will be allowed as deduction. If you are a bank or financial institution, first of all, provision will be allowed as a deduction as per the tax section. Naturally, if provision is allowed as a deduction, bad debts will be allowed as a deduction to you only if the bad debts exceed the provision allowed. So if your bad debts are greater than the provision allowed, the extra bad debts will be allowed as bad debts under clause number 7. To the extent of provision allowed under clause number 7A, that much bad debts will not be claimed as a deduction under clause number 7. Only the extra will be claimed as a deduction. What is the amount that is allowed as a deduction under clause number 7A? If you are a bank, 8.5% of your total income before chapter 6A deduction and before taking a deduction under 3617A, plus 10% of the aggregate average advances made by rural branches of such bank. So there, it is not a case of two different provision accounts, one for rural and one for urban. No. Provision account is a single account in the eyes of Income Tax Act. It is a single provision that is allowed. Rural branches, whatever loans and advances they are giving, that is taken as a base for calculation. That does not mean that this provision is only for rural advances. It is for all the advances made by the bank. This provision is a single provision account. In books of account also, actual provision will be made as per RBI rules. That will be accounting provision. Accounting provision will be disallowed and tax provision will be allowed. Now in future, when bad debts happen, we will compare the bad debts with the taxation provision. To the extent of taxation provision that was allowed, bad debts will not be allowed. But if your bad debts are genuinely much in excess, then the excess amount of bad debts will be allowed as a deduction under clause number 7. If you are a foreign bank or a public financial institution or state financial corporation, then the formula is much simpler. 5% of the total income before taking this clause number 7A and chapter 6A deduction. So if you are a scheduled bank, non-scheduled bank, cooperative bank, Indian bank in simple terms, that would also be wrong actually. Scheduled bank, non-scheduled bank, cooperative bank, a bank in simple terms, not a foreign bank but a bank. 8.5% of GTI plus 10% of rural advances. Foreign bank, public financial institution, 5% of the gross total income. I say gross total income because it is before chapter 6A deduction, but then you have to also ignore clause number 7A ka deduction. Similarly, when you are a financial institution, banking company, you will also get a deduction of special reserve. As per RBI Act, you are supposed to transfer some amount to the special reserve account, and income tax is recognizing it and giving you a deduction. Whatever is the amount transferred to the special reserve account, 20% of the profits derived from business activities before taking this clause 7 clause 8 ka deduction, 20% of the paid up share cap, 200% of the paid up capital and general reserve minus opening balance of the reserve account as per tax. Three amounts: the amount that is actually transferred, double the paid up share capital minus opening balance, 20% of the profits before taking this deduction. Out of the three, whichever is lower, this is the amount of deduction that will be allowed. Securities transaction tax, if securities are held as stock in trade, will be allowed as a deduction. Commodities transaction tax, if held as stock in trade, will be allowed as deduction. Mark to market losses will be allowed as deduction if they are calculated according to ICDS. Like valuation of inventory is one example where you can have some loss because you are valuing it as per ICDS at market value, and that is resulting into a loss. That loss will be allowed as a deduction. No other mark to market loss, no other M2M loss will be allowed as a deduction to you. Coming to 37.1, general deduction, as the name is suggesting, general, so it should not be covered by the specific deductions 30 to 36. The expenditure should not be capital, the expenditure should not be personal, it should be incurred for the purpose of PGBP income, then it will be allowed as a deduction to you. If the expenditure is incurred for a offense, for something which is prohibited by law, if the expenditure is incurred for an illegal purpose, that expense will not be allowed as a deduction. CSR expenses will not be allowed as a deduction. There are certain sections where you can take the benefit of CSR expense, like donation given to Swachh Bharat Kosh and Clean Ganga Fund can be claimed as a deduction under ATG, although they are CSR expense. But ATG will also cover PM Cares Fund, that is also a CSR expense and covered under ATG. Under section 35, certain expenses, certain contributions made for social science research, etc., can be covered here. Similarly, there is a section 35 CCA where you can take a deduction of National Fund for Rural Development, Urban Poverty Eradication Program, and it will fall in the CSR definition, and you will be entitled to take a deduction also. There is one small circular, sometimes a very small question comes up. Pharmaceutical companies are giving to doctors free gifts, cash, travel facility, etc., so that the doctors would prescribe their medicines, prescribe their hospitals, etc. This is taken as this is a violation of the regulations of Medical Council of India. So, as a doctor, I cannot recommend a certain medicine because I'm getting a benefit from that pharmaceutical company. If I do that, it is in violation. So the pharmaceutical company is giving me such free things. For them, it is an expense in prohibition of law. That is an illegal expense. They will not get a deduction. But as a doctor, whatever income I get, I will be paying tax. That is a benefit in the course of profession. But that does not mean that the pharmaceutical company will take a deduction. This explanation number 1 says it is a prohibited by law expense, and so you will not be getting a deduction. The doctor, the medical practitioner will have to pay tax. 37.1 as such has many case laws to study, but certain case laws which frequently come up in your papers. Illegal expenses are not allowed as a deduction. But if you are doing an illegal business and your stock in trade is seized, stock in trade is taken away, loss of stock in trade is allowed as a deduction. T.A. Qureshi case law, Supreme Court judgment, loss of stock in trade. If you pay income tax, that is not allowed as deduction. So on that income tax, the interest that you are paying, that is also not allowed as deduction. Bharat Commerce Industry. Interest for delayed filing of return of income, default in payment of advance tax, any interest that you pay for deferment of advance tax, that interest is calculated on your income tax liability. If income tax itself is not allowed as deduction, so interest also cannot be allowed as a deduction. Rotok controls comes up many a times. If you make a provision for a revenue expense, but this provision is not random, This provision is made on a reliable basis. This provision is made on a scientific basis. There is data to back up the calculation. It is based on past track record. Then this provision will be allowed as a deduction to you. If it's a random provision, every year 5 lakh rupees, that is not allowed. If it's a provision for a capital type of expense like retirement benefit of employee, that provision is not allowed. That will be allowed when actual payment is made. But if the provision is for a revenue expense, any revenue expense, and if it is not random, if it is on a reliable basis, Rotok control, Supreme Court says deduction will be allowed. Brookbond India. While we were discussing preliminary expense, I had just mentioned this. Share issue expenses are capital in nature, so you can't debit them to P&L and take a deduction. If possible, then you will get a deduction under 35D preliminary expense. Otherwise, you will not get a deduction of share issue expense because they are capital in nature. Fees paid to ROC for enhancement of authorized share capital is also a capital expenditure. When you increase your authorized capital, you are getting a long-term benefit over the lifetime of the company, so it's a capital expenditure. But when bonus shares are issued, and relating to this bonus share, if some expenditure is incurred, that is revenue. Because issue of bonus share does not change your asset side of the balance sheet. Some profits which were shown as profits, reserves and surplus are now shown as share capital. Expenses incurred for bonus shares are revenue expense. Expenses incurred for fresh issue of shares, capital expense. If share capital is authorized share capital is increased, capital expenditure. If redeemable debentures are issued at a discount, so you know the discount because it is at the time of issue, and they are redeemable, so you know the period also after which you'll be redeeming it. It is to be proportionately spread over the period of redemption. Last Supreme Court judgment, Honda sale cars. If you get a right to use a certain technology, a certain know-how, but it is for an existing business, then the expenditure is revenue in nature. If this technical know-how is for setting up of a new business, it means there is a new source of income which is coming into existence, then the expenditure is capital in nature. That capital expenditure will be allowed as capital expenditure will not be allowed, revenue expenditure will be allowed. So the logic is very simple. Existing business, it's a revenue expense. If you are doing the expense for a new business means a new source of income, then that expenditure will be capital in nature and won't be allowed as deduction. High court judgments. If you are paying some amount to compound an offense, if you are paying some amount in the form of a penalty, but you show it as regularization fee or compounding fee, it is still penalty in nature. You will not get a deduction of it. PVR, Priya Village Road Show. This is also, in a way, if you understand, connected to the same logic of Honda sale. Feasibility fees, fees were paid for feasibility study. If a new business, a new asset is coming into existence, then it is capital. If there is no creation of a new asset, then it will be revenue in nature. For an existing business, if the studies were conducted, then the expenditure is of a revenue nature. Very old case law, hardly a chance that it might come, but once in 2012 or 13, almost a decade ago, there was a question asked based on this. Heart surgery expense was claimed as a deduction by a lawyer and it was outright rejected. It is not treated as repairs to plant. Section 31 will not be applicable. 37(1) will not be applicable. Next, if you purchase second-hand machinery, equipment, but don't use it as a equipment, use it for repairing your existing equipment, then it's a revenue expense. You purchase a second-hand medical equipment, dismantle it, and then use the spare parts. It is a revenue expense. If payment is made to police, if payment is made to gundas and underworld dawn and stuff like that, that is again for a offense for something illegal. Deduction will not be allowed. If you had a share issue and SEBI did not give you approval or the issue got cancelled, does not mean that the expenditure becomes revenue. Expenditure is still capital in nature only. If you are raising money through borrowings, debentures or taking loans, Then for that, whatever expenditure is incurred is a revenue expense. If you have redeemable debentures, zero interest unsecured redeemable debentures, and you are going to redeem them at a premium, they are not issued at a discount, but they are redeemed at a premium, and you are going to do it after 10 years. Take the premium, spread it over 10 years. Glaxo Laboratories, this comes up quite a few times. A managing director was invited to a foreign country for attending a conference, but the invitation was managing director plus the spouse. Because in that foreign country, the culture was such that the invitation should always be sent out as one plus one. So the spouse attended, and the company where this person was a MD, the company bore the expense, traveling expense of the spouse. Now the court said, okay, by traveling expense of the spouse was also a business related expenditure only. It was not a holiday, and the spouse had to, in a way, compulsorily attend the conference or the seminar because of the culture of that foreign country. So this is not a personal expense, this is a business related expense, keeping in mind the various social aspects of different cultures in different countries. Last two case laws, once in the question paper, this had come up. Okay, what about non-compete fee? Madras High Court said, okay, by paying non-compete fee, you are protecting your existing business. There is no new source of income coming up. There is no new business. The existing business is being retained. So this non-compete fee is a revenue expense. But for the same non-compete fee, Gujarat High Court has said that it is wide enough to cover any other business or commercial right of a similar nature, which is included in the definition of intangible asset. So, according to Gujarat High Court, this non compete fee is a capital expense, but it can be classified into the block of intangible assets and you can claim a deduction under section 32. So Madras High Court is saying non-compete fee is a revenue expense, allowable as a deduction. Gujarat High Court is saying you must put it into the block of intangible asset and depreciate it. 25% WDV. 43B, 37(1) gets over with this. 43B, deduction allowed on actual payment basis. Three expenses that we've already seen. Um, Contribution made by employer, employer's own contribution, bonus or commission paid to employees, interest on loan from certain lenders, these lenders are covered, any tax, duty, cess or fee by whatever name called. So the most common example to take up will be GST. GST is treated as an item of income and as an item of expense. GST collected from customer is income. GST paid to supplier will be an expense. GST will be included in the valuation of purchase also, valuation of sale also, valuation of opening closing stock also. Section 145A told us, half an hour ago we revised it, or maybe 40 minutes ago we revised it. So GST is now an expenditure item. GST will be allowed as a deduction to you only if you pay the GST to the government. If it is payable, GST ka deduction will not be permitted. 43B is applicable to GST. If you are paying any leave encashment to your employee, that will be allowed as a deduction on payment basis. If you are making any payment to Indian Railways, then that payment, if you make the payment, only then you'll get a deduction. Advertisement expenses, freight and carriage charges paid to Indian Railways will be allowed as a deduction only if payment is made. If you have taken a loan and any interest is converted into interest on that loan is converted into another loan to give you more payment for to give you more time, converted interest shown as loan does not mean payment is made. When that so called loan, that converted interest which is actually a loan, when that is paid, it means you are actually making the payment of interest. Converted interest is eligible for deduction in the previous year in which it is actually paid. So on conversion, nothing will be treated as paid. When that converted amount is actually paid, then you will get a deduction. These are your important sections where expenses get allowed as a deduction. Now let's try and Study the expenses which are not to be allowed as a deduction, the expenses which are disallowed. Expenses which are not to be allowed as a deduction. 37(2)(b) very frequently comes up in your question number 1. To a political party, if you give any payment in the form of advertisement expense, if you make any donation to political party, then that will be disallowed under 37(2)(b). The reason is you are going to get a deduction of that amount under 80GGB if you are an Indian company, or under 80GGC if you are other than Indian company, other than local authority. So individuals, partnership firms will get covered by 80GGC, Indian company will be covered by 80GGB. So you're going to get a deduction under from gross total income. So under 37(2)(b, this amount of expenditure will be disallowed. 80GGB and 80GGC tell you that no payment should be made in cash. If you make a payment in cash, then you will lose the deduction in that section also. Section 40, amounts which are not deducted. 40, clause number A, subclause 1. If you make a TDS default and the receiver is a non-resident, 100% expenditure will be allowed as a 100% expenditure will be disallowed. Amounts are payable to a non-resident outside India, or amounts are payable outside India, or they are payable in India but to a non-resident. Interest, royalty, fees for technical services, any other sum. Then the amount is the 100% expenditure will be disallowed. What do you mean by TDS default? Either tax is not deducted at source, or tax has been deducted at source but not deposited on or before the due date of filing return of income. 100% expense disallowed. In future, when that TDS which is deducted in the current year is deposited in future after the due date of filing return, then the year in which the TDS is deposited, in that year you will get a deduction. Suppose that receiver has filed a return, paid income tax on it, and as a payer I have not deducted tax. So payer has failed to deduct tax at source, but the receiver has paid income tax, filed the return of income, then expenditure will be allowed as a deduction in that year in which the receiver has paid the tax and filed the return. So if the receiver has filed a return on or before the due date applicable, then we will get a deduction in the current year itself. If the receiver files a belated return, then I will also get a deduction in that year in which the belated return has been filed. So expenditure will be allowed as a deduction to the payer, even if he has committed a TDS default of not deducting tax. But when the receiver will file the return and pay the income tax on it, in that year we will get a deduction. So receiver follows due date, we will get a deduction in the current year. Receiver files a belated return, we will get a deduction of the expense in the year in which he has filed a return. If there is this TDS default, I will have to pay interest on TDS, 1% per month ka interest for a default in deducting tax, 1.5% per month ka interest for a default in depositing the tax on time. Subclause number 1A, if the receiver is a resident person and there is a TDS default, 30% expense will be disallowed. It means 70% will automatically get allowed, 30% will be disallowed. If tax is deducted in the current year but deposited after the due date of filing return, the 30% which is disallowed in the current year will be allowed in the future year. If tax is not deducted in the current year but the resident receiver files a return and pays income tax, the same concept that we saw for non-resident receiver is equally applicable to resident receiver also. The year in which he files a return, if it is on or before the due date, I will get a deduction of my expense in the current year when the expenditure is accrued. If he files a return after the due date, I will get a deduction of the expense in that future year. Current year, I will have to disallow the amount. If that guy is a non-resident, I will disallow 100%. If that receiver is a resident, I will disallow 30%. I will still have to pay interest under subsection 1A of 201. Subclause number 3, if you pay salary outside India or you pay salary to a non-resident, tax is not deducted at source, tax is not deposited. If deducted but not deposited, so the 100% amount will be disallowed, but then There is no other relaxation allowed to you. It's a permanent disallowance. In future, if you deposit the TDS, does not matter, this disallowed amount will remain disallowed only. Even if the non-resident is paying tax on that salary income from his own pocket and filing return of income, still for you it will remain disallowed only. So for salary you have to take extra care. Once it gets disallowed, it is a permanent disallowance. A very important case law, although I feel Institute has asked this quite a few times in the past, so it may not repeat the question, but then it is an important thing. There was a very old judgment, Vector Shipping Services, which said Allahabad High Court had made a error in its judgment, in its final verdict. Allahabad High Court had said that TDS default provisions will apply only to expenses of 31st March. Supreme Court in Palam Gas Services is putting everything correct. Obligation to deduct tax at source is applicable to every payer, whatever method of accounting he follows. If the TDS section applies, he has to deduct the tax. Whether the expenditure is incurred on 31st March, whether the expenditure is incurred before 31st March during the year, TDS provisions are mandatory. So, if TDS defaults are made, then PGBP ka this section will apply and you will have to disallow the expense. You cannot come to a conclusion that 31st March wala expenditure is only covered by the disallowance. Nahin, disallowance will apply to all the expenses. Whether you follow accrual system or cash system, if the TDS provision applies to you and you have made a default, the disallowance will be there. Narayani Ispat, interesting case law, easy case law. 10 15 minutes ago, we saw a case law, Bharat Commerce Industries. On your own income tax, when you pay interest, it is not allowed as a deduction to you. But on the TDS default, whatever interest you pay, that interest is compensatory in nature. That TDS is also, in a way, part of the expenditure incurred. So the interest on TDS will be allowed as a deduction to you. Bharat Commerce Industries was saying my own income tax, my own interest. Whereas this case law is talking about receiver's income tax deducted by the payer, and on that TDS component, if there is any interest paid, interest will also be allowed as a deduction. Clause number 1B, equalization levy. If there is an expenditure covered by equalization levy, what is the expenditure which is covered by equalization levy? Any payment made for online advertisement, digital advertising space, then that is a specified service. If you are making a payment to a non-resident, so non-resident is the receiver, and that non-resident does not have a permanent establishment in India and is providing you online advertisement, digital advertisement services, then as a payer you have to deduct equalization levy and you have to deposit it on or before the due date. Equalization levy will be deducted at the rate of 6%. If you don't deduct it, the expenditure, the advertisement, online advertisement expense will be disallowed for you. If you deduct it, but you do not deposit it up to the due date of filing return, then this expenditure of online advertising will be disallowed to you. For that non-resident who does not have a permanent establishment, the income is anyways exempt. 10 subsection 10 clause number 50, it is exempt. This disallowance that we are discussing is for the payer. What is a payer doing? The payer is a person resident in India who is doing PGBP, or a person non-resident in India having a permanent establishment in India and doing PGBP activity. Receiver has to be a non-resident who does not have a permanent establishment in India. Receiver has to be a non-resident who does not have a permanent establishment in India. If the amount of advertisement expense is less than equal to 1 lakh rupees, then the concept of equalization levy is not applicable to you. If the payment is made for non-business purposes, for some other than business purposes, so equalization levy ka concept does not apply only. Clause number 2, taxes on income. Income tax, surcharge, health education cess, income tax paid in India, income tax paid in foreign country, income tax paid on PGBP income, income tax paid on other incomes. All these are personal expenses of the assessee. Income tax will not be allowed as a deduction. 40 clause A subclause number 2. Income tax is disallowed. So income tax is disallowed. Its provision created is disallowed. On the income tax, any interest paid is disallowed. If you pay any penalty, the penalty is obviously for breaking the law, that is disallowed. Income tax refund is not taxable at all under any head. Interest on income tax refund is taxable as income from other sources. But against this, if you compare income tax with GST, indirect tax, so we saw about 20 minutes ago that GST is covered by 43B, and 43B is saying payment basis. So provision for GST will not be allowed, but payment of GST will be allowed. On GST, if any if any interest is paid, then that interest is also allowed as a deduction, compensatory in nature. Definitely penalty will not be allowed because it is breaking the law. If GST paid is allowed as a deduction, then GST refund is taxable as PGBP, and interest on GST refund will be taxable as income from other sources. Next disallowance, if you are a state government undertaking, which means state government has 51% or more stake in you, or a state government company has 51% or more stake in you, or state government plus that state government company in combination have more than 51%, or they control your management, then you are a state government undertaking. If you pay to the state government royalty, service fee, license fee, privilege fee, but it is exclusively levied by the state government on you, state government undertaking, you are only paying it to state government, then such expenditure will be disallowed. If it is not exclusive, which means as a state government undertaking, you are paying it to state government, you're paying something to central government, you're paying something to somebody else, it's not an exclusive levy, then this disallowance will not apply. This disallowance will apply if the state government undertaking exclusively pays these amounts to state government, then the expenses will be disallowed. Subclause number 4, I discussed it some time ago. If the fund is unrecognized, then every year employer ka contribution will be disallowed. At the time of retirement, ideally the entire amount should be allowed. But if the employer fails to make TDS arrangements, then this 40 clause A subclause number 4 is telling you that by the employer contribution which should be allowed will not be allowed because TDS arrangements have not been made. So if you want a deduction of employer's contribution that he has made over all these past years, if you want a deduction of that amount, you have to ensure that TDS arrangements have been made. Subclause number 5, non-monetary perquisites borne by the employer. Tax on the non-monetary perquisites borne by the employer. Employer provides a non-monetary perquisite, and on that, whatever is the income tax, instead of deducting it from the salary, he himself pays it from his own pocket to the government. That will be disallowed for the employer. This benefit that the employee is getting will be an exempt benefit, section 10 clause number 10CC, and the tax component which the employer has paid from his own pocket will be disallowed for the employer. Coming to section 40, now we are talking about clause number B. Payments made by partnership firm to its partner. Any interest, whether it is interest on capital, interest on loan, interest on current account, any interest that the firm pays to the partner, if it is not authorized, disallowed. If it is for a period prior to date of partnership deed, disallowed. If it is in excess of 12%, disallowed. Whether the payment is made to a sleeping partner or a working partner does not matter. Unauthorized interest, disallowed. Period prior to date of partnership, disallowed. Up to 12% per annum, that interest is allowed. In excess of 12% per annum, that interest is disallowed. If we are talking about salary to partner, commission, remuneration, salary, amount paid for efforts. Paid to sleeping partner, fully disallowed. Paid to working partner but not authorized, disallowed. Authorized but for a period prior, disallowed. Authorized for a period on or after the date of partnership but in excess of the limits prescribed, so the excess amount will be disallowed. Now, how do you calculate this? Net profit or net loss? Take the starting point. Make all the PGBP adjustments that you are supposed to make in this chapter of PGBP, all PGBP adjustments. First of all, disallow all the salary paid to all the partners. In this, you have to take care current year depreciation and brought forward unabsorbed depreciation will be adjusted, but all the losses under section 70 to section 80 will not be adjusted because these losses, they are covered in chapter 6, whereas here we are only supposed to do chapter 4 part D, that means PGBP ka adjustments. For computation of book profit, many a times they ask you, they give you this information, so this is what you have to take care. You can adjust unabsorbed depreciation and current year depreciation when you do book profit ka calculation, but losses brought forward, losses of the current year will not be adjusted. Once you calculate the book profit, on the first 3 lakh rupees of book profit, either 1,50,000 or 90% of the book profit, whichever is more. If you have book profit which is more than 3 lakhs, then on the balance 60%, and this will be your limit. Take this limit and compare it with salary to working partners, which is authorized by the partnership deed, which is for a period on or after the date of partnership. Take this amount, compare it with the limit, whichever is less, this will be the amount of deduction that will be allowed. So this is the amount of deduction that you will claim from your book profit, or in case if you have a book loss. If you are a partner representing someone but you receive interest in your personal capacity, that will not be disallowed, that will be allowed. If HUF is a partner and the Karta of HUF in his personal capacity has given some loan, then the interest on that loan is not covered by this section. Reverse, if individual is a partner, and the Karta has given a loan, then the interest that we are going to pay to that Karta will not be covered by this section. The restriction of 12% will not apply. When the firm pays interest on capital to partners and the firm receives interest on drawings, interest on drawings is fully taxable separately. Interest on capital will be covered up to 12% as allowed, and the balance will be disallowed. So you will not do the net off. Share of profit in the total income of the firm shall be exempted. The partner will not pay tax on the share of profit. He will pay tax on interest, he will pay tax on salary, but only those amounts which are allowed as a deduction to the firm. Moving on, 40A subsection 2. Unreasonable or excess payments made to relatives or related party. Very simple adjustment comes up in your question paper. Very simple adjustment. Revenue expenditure is given to you. It is in excess of the market value. That means the transaction is done at an amount greater than the FMV. Then transaction value minus fair market value, whatever is excess, is disallowed for the payer. Then there is a list given who all will be treated as relative. Every expenditure is not disallowed here. The transaction should be done with a related party. So for individual, relatives, a person who has substantial interest in the business, they are all treated as relative. Companies, the directors, spouse, relatives of director, another company where this director has a substantial interest. So this is, the list is very simple. When the adjustment comes up, it will become very obvious that yes, this is a concept of related party. You have to find out whether there is any excess payment or not. And if there is any excess payment, it is that excess payment which will be disallowed. 40A subsection 3. the amount of expenditure incurred is greater than 10,000. Which expenditure am I talking about here? Here I am talking about revenue expenditure and not capital expenditure. Single day payment is greater than 10,000 and this payment is not made through these prescribed modes. If it is made through prescribed modes, then it is allowed as a deduction. If it is not paid by these prescribed modes, so I wrote it earlier also, if the payment is made by cash, if the payment is made by bearer check, if the payment is made by crossed check, then whatever amount you have paid on a single day greater than 10,000, that entire amount paid through these modes will be disallowed under 40A3. If you make a payment through prescribed modes, everything is allowed. If the amount paid on a single day is less than equal to 10,000, then whether you use the prohibited modes or the prescribed modes, everything will be allowed. Suppose an expenditure has been allowed as a deduction on accrual basis, and then this cash payment or bearer check payment is made in the next financial year, then whatever amount you have paid through the prohibited modes greater than 10,000 will be chargeable to tax as your income. If the receiver is into goods carriage business, transportation business, then for us as payers, the limit is 35,000 instead of 10,000. There is a rule created, rule number 6DD. If your transactions are covered by 6DD, then even if the payment is greater than 10,000, greater than 35,000 and prohibited modes are used, still the amount will be allowed as a deduction. Rule 6DD targets certain transactions like making payment to Government of India, making payment to LIC, making payment to railways, making a payment to employee. His salary is paid, but he is at a remote place or he is at a ship and tax has been deducted at source, and then you are making a payment in cash if he is posted to such a place for more than 15 days. The amount paid is more than 10,000. TDS provisions have been complied with, then even if cash is used, it's absolutely fine. If you are making a payment to a villager who does not have any banking facilities in the village, though the expenditure will be covered by Rule 60D, it will be allowed. If we are talking about revenue expense, 48.3 is there for disallowing it. If we are talking about capital expense, specified business, 35AD is not covering this payment made through non-prescribed modes, prohibited modes. And in respect of regular business, the same concept is there in 43.1. That is the reason why at the start I wrote that this section applies to revenue expense. For fixed assets, this same type of restriction is already existing in 43.1 and 35AD. 40A7, employer's contribution to gratuity fund. If you make a provision in your books of account for payment of gratuity, it is disallowed. What will be allowed is if you make a payment to approved gratuity fund as your contribution. But if gratuity is payable during the year because the employee is retiring during the year and you are making a provision, that provision is allowed as a deduction. So generally speaking, provision made every year will be disallowed. But in the year of retirement, if you make a provision, it will be allowed. If you are making a contribution to unrecognized funds, unapproved funds, then the expenditure, then the contribution that you are making to those unrecognized, unapproved funds will not be allowed as a deduction to you. As and when the employee will retire, at that point of time, the deduction will be allowed to the employer. MTM losses, mark-to-market losses, if they are covered by 36.118, then they are allowed. Otherwise, any other MTM loss that you record in your P&L will not be allowed as a deduction to you. So these were all the expenses which were disallowed. We've seen expenses allowed, we have seen expenses disallowed. Now we are going to incomes which are chargeable to tax. A lot of it we've already done. Section 41 ka incomes will be taxable as PGBP even if the business is no longer in existence. If any expense, loss or deduction was allowed earlier and now you are having any recovery, that recovery will be taxable. Example we took, okay, GST paid is allowed as a deduction and when GST refund is received, it is taxable. If there is any trading liability and it stops being your trading liability, you write back that trading liability in your books. You stop recognizing that as a liability. Then the amount written back is your income. To that extent, you don't have to pay that much. You have recognized it as your income. You will have to pay tax on that income. A very recent case law, uh, CIT versus Mahindra and Mahindra. Loan was taken for fixed asset, but loan was taken from a foreign company. Now that foreign company waived off that loan. So is it covered under 28.4? 28.4 talks about a non-monetary benefit or a non-monetary perquisite. Waiver of loan is a monetary item. It's not non-monetary. For 41.1 to apply, you must have taken a deduction earlier, and now you are getting any benefit out of it. Now there is some write back out of it. Cost of fixed asset was never taken as a loan amount, rather I should say. Loan amount was never taken as a deduction. Fixed asset ka cost was never debited to the P&L account. So 41.1 is also not applicable, 28.4 is also not applicable. The only possibility existing is that if waiver is included in explanation number 10 to 43.1, you can reduce that waiver from the cost, from the actual cost of that fixed asset. Here the problem was waiver was from a foreign company. So waiver by a foreign company is not included in the definition of subsidy. So it is not recognized as an income. So you can't tell the person to pay the tax. But if it is in relation to fixed asset, you can apply explanation number 10. If you have taken a deduction of depreciation on actual cost basis, then we have already seen this. Okay, when you sell, if the sale value is greater than WDV, then the surplus amount will be taxable as PGBP. If asset is used for scientific research and then it is directly sold, so the surplus or the deduction that has been allowed so far, whichever is lower, is taxable. If bad debts was allowed as a deduction, bad debts recovery is taxable under 41.4. You get a deduction of special reserve under 36.18. So amount withdrawn from special reserve is taxable under 41.4a. Everywhere you can observe, somewhere or the other in the past year you have taken a deduction. Now there is any refund recovery, then that refund, that recovery is taxable for you. 41 subsection 5. The business or profession has been discontinued. You are having income in the nature of 41.1, 41.3, 41.4 and 41.4a. You are having income in the nature of recovery of expense, scientific research, fixed asset directly sold, bad debts recovered, or amount withdrawn from special reserve. Non-speculation loss, which you carry forward and set off for 8 years, of the year of discontinuance of the last year, only that is eligible here. And section 72 is over, so 8 years are over. Such a loss of the year, the last year, the year of discontinuance, will be set off under section 41.5, but 41.5 will apply after 8 years as per section 72 are over, because during 8 years you will anyways use section 72. After 8 years, if you have any of these incomes arising, then those incomes will be used, and 41.5 will be used for setting off the loss of the year of discontinuance only. Prior years ka losses, after 8 years they will lapse, they cannot be covered by 41.5. 43CA is absolutely identical to 50C. Normal margin available 10%. But then the extra thing that we'll discuss is the amendment. It is applicable to residential unit. Since we are in 43CA, we are talking about held as stock in trade. Sale happens between 12th November 2020 and 30 June 2021. It should be a first time allotment and the consideration does not exceed 2 crores. Then instead of the margin being 10%, the margin available now is 20%, which implies K for the seller, if it is held as a capital asset, then section 50C will apply. And when we say section 50C will apply, the margin will be 110%. But if we are talking about the seller holding it as stock in trade, then I will have two possibilities. This amendment is covered by the second proviso to section 43CA. That means if all these conditions are getting satisfied, then second proviso will apply. Then the margin available is not 110%, then the margin available is 120%. Even if you uh, sell your stock in trade below SDV, but you have a margin of 120% now. Huh. If held as stock in trade, but second proviso is not satisfied. So consideration is about 2 crores, or probably the date of sale is after 30 June 2021, or it is not a residential unit, it is a plot of land, or it's a commercial unit. Then it is other cases, which means then we have a normal margin of 110%. Remember that an identical thing is there, an identical amendment is equally applicable in income from other sources also. When you talk of income from other sources, it means you're talking about the purchaser. If the purchaser who is holding it as a capital asset buys it from a seller, and for the seller also it's a capital asset, so under 56 to 10, the margin available is 110%. That means the margin available to the buyer also is 10% margin. 50,000 or 10% of the consideration, whichever is higher. This has to be compared with your inadequate consideration. But if for the seller it is held as stock in trade and second proviso is applicable, then purchaser gets a benefit of 50,000 or 20% of the consideration. A corresponding amendment is there for the purchaser also in 56 to 10. In all other cases, we will go back to our margin of 10%. So like in the chapter of PGBP, in 43CA there is the amendment for the seller. The same amendment is introduced in 56 to 10 for the purchaser of the capital asset also, for the purchaser of this residential unit also. Purchaser should hold it as a capital asset, seller can hold it as stock in trade. Else the entire section 43CA is exactly identical to section 50C. Whatever we have studied in section 50C, we can same thing reproduce it in 43CA also. Now, going ahead, income calculations, we have seen 41, we have seen 43CA, 43CB. Again, very simple. It is a concept based on ICDS provisions. If you are earning income from construction contract or a contract of service, basic rule is that you have to follow percentage of completion method. But now there are these exceptions created, two exceptions. If it's a contract for providing service, and remember both the exceptions are for contract of providing service, not for construction contract. If you are into a contract for providing service and the duration of this contract is less than or equal to 90 days, then you will follow project completion method, less than or equal to 90 days. If the duration is fixed but the number of activities is not fixed, then you will follow straight line method. So basic rule, follow percentage completion method. If the duration is 90 days or less, it is much smaller contract, follow project completion. The duration is a fixed duration, but you don't know how many activities you will have to do to provide the service and earn the income. Then you spread it over the entire duration of the contract on SLM basis. Whatever method you follow, when you say contract revenue, whether it is construction contract or service contract. Revenue will always include retention money. Cost shall not be reduced by incidental incomes. So these incidental incomes like interest, dividend and capital gain, these incidental incomes will be taxable under the relevant head of income. Interest and dividend will be taxable as IFRS, capital gains will be covered under that head. You will not reduce the cost of the contract by these incomes. Separately show the incomes as taxable and take this cost and subtract the cost. Last provision of income, this is talking about banks and financial institutions. We saw for banks and financial institution कि by provision for doubtful debts is allowed as a deduction, and when the doubtful becomes bad debts, extra bad debts over and above the provision will be allowed. This is a section created for income. On those bad and doubtful debts, interest income that you will recognize, then they will be taxable in the year in which it is credited to the profit and loss account or in which it is actually received, whichever is earlier. So if as per RBI guidelines, you will recognize the income as and when you receive it, interest income, then Income Tax Act also will not force you to follow method of accounting and pay tax on accrual basis. It will be taxed when you receive it. If RBI guidelines tell you, okay, you have to record this on accrual basis, you will record it in P&L, Income Tax Act says taxable. If RBI guidelines would tell you, okay, you record this in P&L only when you receive it, not on accrual basis. So when you receive it, that time we'll collect tax from you. It's something very simple, nothing great. Okay, this was the section that I was referring to about an hour ago when we were doing depreciation. If fixed assets are acquired from a country outside India, either you have taken a loan in foreign currency or you have not taken a loan, but the supplier is giving you a credit period, you're going to pay within 1 or 2 months or something like that. And the interest that you're going to capitalize as per Income Tax Act provision. You will record the transaction at the foreign exchange rate prevailing on the date of transaction. Generally, these items are not, restated on 31st March. Fixed assets are not covered by the 31st March restatement. Any exchange gain or loss, when you pay these amounts, instead of putting them in the P&L, Income Tax Act is saying it will be adjusted from the WDV of the asset. In accounting, you would put it in the P&L, accounting standard. This is one provision of income tax which is which is contrary to accounting standard. Okay, the loss will be added to WDV, the gain will be reduced from WDV of that asset. By chance, if you've entered into a forward exchange contract, then you will compare the forward rate with the transaction rate. The exchange rate fluctuations at the time of actual payment with reference to the forward rate will be used for calculation, not the spot rate, the forward rate with the transaction. And according to that, whatever exchange gain or loss you have, that will be adjusted into WDV. This is 43A. 43A is only applicable to an asset covered by 43(1), that is a fixed asset covered by 35(2), scientific research, and a capital asset. 43AA is applicable to all other items, monetary, non-monetary, everything. And whatever your Indian accounting standard prescribes as accounting treatment, same thing is prescribed by 43AA also. Record the transaction at the rate prevailing on the date of transaction. If settlement takes place during the year, and on that settlement, exchange gain, PGBP income, exchange loss, PGBP loss, deduction allowed. If you don't settle it during the year, then on 31st March, you would restate it. So on that restatement, exchange rate on the transaction, exchange rate on 31st March. On that restatement, gain, taxable, loss allowed. This is for monetary items. For non-monetary items, record the transaction at the exchange rate prevailing on that date. Non-monetary items except inventory shall not be converted on 31st March. If non-monetary items are converted on the 31st March, other than inventory of course, gain will not be taxable, loss will not be allowed as deduction. For inventory, if there is any exchange gain or exchange loss, that will be allowed as a deduction, that will be taxable. Foreign branch, foreign branch can have monetary items, foreign branch can have non-monetary items. Monetary items, gain or loss give effect. Non-monetary items, other than inventory, don't give effect. Inventory, you give effect, similar to what you would have done for Indian branch. Same treatment has to be given for foreign branch. So fixed asset related fluctuations, fixed asset related foreign currency gain loss, adjust in WDV, do not put in PNL. PNL effect nahi, WDV ka effect. But monetary items give effect to PNL, gain will be taxable, loss will be allowed as deduction. 44 AA maintenance of books, hardly important. You may not even waste 10-15 minutes on this. It's something very simple. Certain conditions are prescribed. Your receipt should exceed a certain amount. Your turnover should exceed a certain amount. Your taxable PGBP should exceed a certain amount. Certain books are told you have to maintain the books compulsory. If these books are not maintained compulsorily, then you will have to pay a penalty of 25,000. This is actually worth remembering. Baki 44 AA, you may choose to ignore it also. There's nothing great. You will have to pay a penalty of 25,000. If proper books are not maintained, then yes, it will result into best judgment assessment. That is one conclusion which is a bit more significant. Okay, by not maintaining books of account will result into best judgment assessment. Okay. Discussing something important. Certain professions are specified in the section, and all these professions which are specified, they are eligible to be covered in presumptive taxation under 44 ADA. So 44 AA, you should rather actually focus on this only. That is more important. Audit of accounts. This section is a bit important because of the amendment. Threshold for businesses to get their audit done, your turnover should be greater than 1 crore. If during the year receipts in cash, receipts will mean total receipts, business, personal, capital, revenue, everything. If receipts in cash are less than equal to 5% of the total receipts, if payments in cash are less than equal to 5% of total payments, then the threshold earlier was 5 crore. Last year it was 5 crore. Now the threshold is 10 crores. That means if you are dealing in cash less than equal to 5%, payments and receipt both, then tax audit will apply to you only if the turnover exceeds 10 crores. The clarification, if the payment or receipt is not account paid check, then it will be deemed it is cash. Not account pay means we are talking about bearer check and we are talking about crossed check. So bearer check and cross check will be covered in this. Payment in cash, receipt in cash. What does this mean? This will mean cash plus bearer check plus crossed check. And the total of these three should not exceed 5%. If you're a person carrying on profession, the threshold is 50 lakhs. If your gross receipts exceed 50 lakhs, then tax audit applies. If you are covered by 44 AE, 44 BB, 44 triple B, presumptive taxation, then you are claiming that your income is lower than these sections, then audit will apply to you. If you are covered by 44 ADA, presumptive taxation for professionals, now you are claiming that the income is lower and you are having total income greater than basic exemption limit. So you are claiming your professional income is lower than what is prescribed by the section, but your total income is above the basic exemption limit, so you will have to get your books audited. And if you are covered by 44 AD, but you get attracted, you get covered by subsection 4, there's a violation prescribed in subsection 4, and your total income exceeds the basic exemption limit, so you will have to get your books audited. If you are covered by 44 AD and the turnover does not exceed 2 crore, you don't need to get audit done. If audit is applicable, then your due date of filing return will be 31st of October. If you fail to get audit done, 0.5% of the turnover or a maximum of 1,50,000, this is the penalty that you have to pay. So coming to the last part of the chapter, presumptive taxation. 44 AD. Presumptive taxation 44 AD. First section applies to individual HUF and firm. They should be resident, but LLPs are excluded. You should not be claiming your 10AA deduction, Chapter 6A deduction. You should not be carrying on profession. You should not be covered by 44 AE wala business. You should not be earning commission income, etc. If you are having all these, so presumptive taxation is not applicable. What is a presumptive profit? The turnover should be less than equal to 2 crores and the profit is 8% of the turnover. But out of this turnover, whatever amount is received, actually received through our prescribed modes on or before the due date of filing return, then instead of 8%, the presumptive profit will be 6%. If you declare profits which is actually higher than this 8% and 6%, then the higher amount will be taxable. If your actual profits are lower, actual profits means profits as per books. If your actual profits are lower than this 8%, 6% amount, and you pay tax according to the section, according to the 8% amount, your actual profit is lower, yet you are paying tax on the 8% amount, on the 6% amount, then audit will not apply. If you claim, if the assessee opts to offer his income to tax lower than the presumed profit, then audit will apply. If you are paying tax according to the presumed amount, 8%, 6% amount, or a higher amount than that, tax audit is not needed. Separate deductions will not be allowed. All the deductions are deemed to be allowed. Depreciation, etc. will not be deducted. No expenses will be allowed. In this 8% calculation or in this 6% calculation, all deductions are deemed to be allowed. Again, if you show profits according to the section, maintaining books is not mandatory. If you offer a lower amount of profit, then but of course you will have to maintain the books and get the books audited. If you are paying tax according to 44 AD, then you have to pay the whole amount of your advance tax liability on or before 15th March, but only one installment. You are not supposed to follow all the 4 installments. You can just pay the last installment 15th March, pay the entire amount of advance tax. Chapter 6A deductions can be claimed, but Part C deductions cannot be claimed. Set off of losses is absolutely perfectly fine, no problem. If you are covered by 44 AD, then you have declared income for a particular year as per 44 AD. For the next 5 years, if you don't declare income for any previous year as per 44 AD, then that is the year of, let's say, non-compliance. Now from that year of non-compliance, for next 5 years, you are not eligible to claim the benefit of 44 AD. In the next 5 years, you will have to maintain books. You will have to compulsorily get the books audited. Whether you pay tax in the next 5 years, according to presumptive or not, audit and books of account will become mandatory for you. This is a provision only in AD, not in the other 2 sections. 44 ADA for professionals. All resident assessees who are carrying on professions, but here there is a small change introduced कि भाई only resident individuals and resident HUFs are covered here. All assessees are not covered. Your gross receipt should be less than equal to 50 lakh rupees. 50% of the gross receipt is the presumed profit. If you earn more, no need to get books audited. If you earn less but pay tax on this 50% wala amount, no need to get books audited. If you earn lesser profit and you want to pay tax on the lesser profit, then books of account maintenance will become compulsory, audit will become compulsory for you. Then chapter 6 deductions can be claimed, absolutely fine, no problem. Advance tax provisions, you will have to pay your advance tax on or before 15th of March. You are not supposed to follow all the installments, you can just pay it once. You can set off the losses also, that is also absolutely fine. The concept of 50% is fixed 50%, in the sense there is no reduction if you receive your gross receipt, if you receive your fees through prescribed modes. The benefit of 8% becoming 6% is in AD, but not in ADA. ADA will be 50% of the gross receipts. Whatever amount you receive, in whichever way you receive, it will be 50%. 44 AE. If you are into the business of plying or hiring or leasing good carriages, that means you are into the transportation business. Number of goods carriages owned throughout the year are less than equal to 10. Then, out of those number of vehicles, whatever are heavy goods vehicle, whose weight is greater than 12,000 kg, per ton per month, 1000 rupees is your assumed profit. Multiplied by number of tons, multiplied by number of months, this will be from that heavy goods vehicle the profit. If you have a goods carriage but whose weight is less than equal to 12,000 kgs, then forget what the weight is. Monthly 7,500 multiplied by the number of months will be the profit. In calculating the number of months, any part of a month will be rounded off to the full month. So if it is 10 months and 5 days, you will round it off and you will say calculation to be done for 11 months. Logic still remaining the same, this concept remaining the same. If you pay tax on this amount or a higher amount, no need to get books audited. But if you claim that your actual profit is lower than the presumed profit and that's what you want to offer to tax, then audit of books will become mandatory. Maintenance of books will also become mandatory. This is one section where, in case of a partnership form, interest and remuneration shall be separately allowed as a deduction under 40B. Separately. This separate deduction is not covered in the first two sections. It is covered only in the third one, 44AE. Rest all things are same. Losses can be set off. Chapter 6 and deductions can be claimed. In your MCQ booklet, I think there is case scenario number 2 or maybe 3, where it's a tabular type of a question and there are 4 assessees given. All of that can be solved using, one is AB, one is XY, one is LMN, one is PQ. These are the 4 assessees and all of them are covered by this presumptive taxation wala thing. You can go through that MCQ. That will also help you in revising these sections. All these 3 sections that we studied, they were applicable for resident assessees. Presumptive taxation provisions are there for non-residents also. There are 4 sections. If you are into the business of operating ships as a non-resident, 7.5% will be your deemed profit. Fixed profit 7.5. Assessing officer cannot tax you on a higher amount. You cannot offer a lower amount to tax. Any amount accruing in India, if the ship starts in India, amount is accruing in India, that will be considered in the calculation. If the ship starts from outside India and comes to India and the income is received in India, that amount will be considered. If the origin and destination both are outside India, but the freight charges, etc., are deposited in an Indian bank account, it is deemed to be received in India. These 3 gross receipts will be totaled: accrued in India, received in India, deemed to be received. Taking the total, 7.5% of the total will be deemed as your PGBP income and that will be taxable. Higher profits not possible, lower profits also not possible. In your ICI booklet of MCQ, there are 2-3 questions like this, based case scenario based MCQ. 2 or 3 which are pretty much identical. You can solve any one of them and you'll understand, you'll get the grip of it. MAT provisions will not apply. MAT is calculated on book profit, but you are not allowed to refer the books, neither for higher income nor for lower income. Fixed amount 7.5. So MAT is not applicable only. AO cannot tax you on the higher amount. You cannot show lower amount. So MAT is not applicable to you. Huh. Against this, set off of losses can be done, chapter 6A can be done. PGBP separate deductions cannot be taken. If you are in a non-resident who is into business of operation of aircrafts, then instead of 7.5% it is 5%. But the balance is, but the section is identical to the shipping business wala section. 5% amount accruing in India, amount received in India, amount deemed to be received in India, take a total 5% of it. Does MAT apply? No. Can you take chapter 6A deduction and set off carry forward of losses? Absolutely yes. Can the AO tax you on more amount? No. Can you declare a lower amount? No. 5% is a fixed amount of profit. Next section, 44BB. If you are a non-resident, related to mineral oil, there is prospecting, extraction and production. And you are providing services for this prospecting, extraction, production. You are giving plant and machinery and earning rental income out of it. Then you are covered by 44BB. For those services, whatever amount are paid to you, for those plant and machinery, whatever rent amount is paid to you, 10% of that amount is deemed to be your profit. The prospecting, extraction, production of that mineral oil should be done in India. So if it is done in India, it is pretty evident that the income is accrued in India, and so this will be taken into account for our calculation. But if this prospecting, extraction, production is done outside India, then, but of course, it is accrued outside India. Now, as a non-resident, if your income accrues outside India, it should not be taxable for you. But if this income is received in India, or if this income is deemed to be received in India, then yes, but of course, it will be treated as chargeable to tax in India, and we will take these two amounts and take a total of these two amounts and apply 10%. Can the assessing officer refer to your books and say more than 10% is taxable? No. But can the assessee open up his books and say I have earned less than 10%? That option is available to you. But that option has consequences. Consequence number one, you will have to get your book, you have to maintain the books compulsorily. Consequence number two, audit will be done. Consequence number three, there will be a compulsory assessment for you as per 143.3 regular assessment. Assessing officer will perform the regular assessment, calculate your income, determine the amount payable, amount refundable. So can he look at your books and tax you more than 10%? No. But if you have shown 3% profit, he can look at your books, he can do a scrutiny assessment and increase that from 3% to say 8%. But he cannot go beyond 10%, but you can show profits lower than 10%. Is MAT applicable? So your MAT will apply if the income that you are offering to tax is lower. How will you offer income to tax lower than 10%? By opening up your books. So if assessee himself is referring to books and saying I'm earning less than 10% as my profit ratio, then book profit also concept will come into play, and that means MAT will apply. But if you are paying tax according to the section, you are paying tax according to 10%. That means MAT will not apply to you. Assessee himself refers to books and says lower profit is taxable, apply MAT also. Assessee does not refer the books and says 10% is the profit offered to tax, MAT will not apply. And the last section in 44BB series, 44BB. If there is a turnkey power project and relating to this turnkey power project as a foreign company, what you are doing is civil construction, or you are doing construction of plant and machinery, or you are doing testing of that plant and machinery. For this, whatever charges you will get, that charges cut 10% will be deemed to be your profit. Can the assessing officer tax you on a higher amount? No. Can you declare a lower amount? Yes, but the same three consequences: maintaining books mandatory, getting them audited mandatory, facing scrutiny assessment, and according to scrutiny assessment, according to regular assessment, your income and your tax liability will be decided. What about MAT? Same concept. If income offered to tax is in accordance with the section, MAT is not applicable. But if you offer income lower than the section, then MAT provisions will be applicable to you. So, this is where we end our PGBP discussion. Now, the next chapter to pick up will be the chapter of TDS TCS. After that, TDS TCS will pick up residential status, transfer pricing, and charitable trust. Okay. Moving ahead to our next chapter for revision, TDS and TCS. Something that regularly comes up in your paper. You have a dedicated question based on TDS and TCS. Also, there are a lot of amendments in TDS TCS, so you can reasonably be sure that something from the amendments will definitely be part of your paper. When you have to revise this chapter, you revise this chapter broadly speaking into three parts. First, some general provisions. Second, provisions relating to TDS, which can be further subdivided into two parts: TDS if the receiver is a resident, TDS if the receiver is a non-resident. And the third part, tax collected at source, TCS. The third and the last part, TCS, is a very small part, but from an examination perspective, it is very important primarily because of the number of amendments, the nature of amendments that have happened in Finance Act 2021 and Finance Act 2020. Chalo, let's get into it. TDS, that's the first thing to study. Responsibility of the payer. Payer will deduct tax either on payment basis or on credit basis, whichever happens earlier. Whatever tax is deducted has to be deposited with the government. The time limit to deposit the TDS generally is 7th of the next month. The month in which tax is deducted at source, 7th of the next month, you will be depositing the TDS. If the month of TDS is March, if the month of TDS is the last month of the financial year, then on or before 30th of April, you are supposed to deposit that TDS with the government. So the liability of the payer, it's a liability, it's a duty. The liability of the payer is number one, to deduct tax, number two, to deposit that tax within the time limit. When tax is deducted at source, and if the receiver is a resident person, then only the basic amount of TDS which is mentioned in the section will be deducted at source. If the receiver is a resident person, only the basic TDS will be deducted at source. If the receiver is a non-resident, then along with the basic TDS, surcharge also will be deducted at source. Health and education cess will also be deducted at source, and the total of those three items will be your total TDS. TDS is generally always the basic amount, but for non-resident receivers, surcharge and health education cess will also apply. If you are deducting tax at source in case of salary income, if you are deducting tax at source for an employee, so it does not matter whether the employee is a resident or a non-resident. For the employee, TDS will always include surcharge and health education cess. Surcharge, of course, if the threshold limits are exceeding, if the threshold limits are crossed, health education cess will always be there. So if the receiver is an employee, if the receiver is an employee, so surcharge will be deducted at source provided the amount that you are paying to the employee exceeds 50 lakhs, exceeds 1 crore, exceeds 2 crores, exceeds 5 crores. These, if you observe, these are the same rates of surcharge that we have studied when we were studying tax payable. So the rates of surcharge, luckily, the government has kept the same rate of surcharge. Tax payable and TDS ka surcharge rate is same. If the receiver is an employee, whether he's a resident or non-resident, health education cess will always be deducted at source. If the receiver is a non-resident, if the receiver is a foreign company, so basic TDS will be done as per the budget rates or as per the sections rate. Surcharge will also be added to the TDS if the receiver is a foreign company greater than 1 crore but up to 10 crores 2%, greater than 10 crore 5%. Again, these are the same rates. If the receiver is a non-resident partnership firm, non-resident cooperative society, and you are paying greater than 1 crore 12%. If the receiver is a non-resident but other than a foreign company, other than partnership firm, other than point 1 and 2, so the same surcharge rates that we studied for individual will also be deducted. Remember, this table that you are looking at is if the receiver is a non-resident or a foreign company. Health education says of 4% will apply, whatever be the amount, but because it's a non-resident or foreign company, that will be your TDS. Same concept is also equally applicable for TCS also. Tax collected at source will also be increased by all these rates. Individual and HUF, many places you will find this. Individual and HUF, if they are the payers, if they have to deduct tax at source, then at many sections, in many sections, this criteria is put up that the turnover or the gross receipts in the preceding financial year, if they exceed 1 crore in case of business, if they exceed 50 lakhs in case of profession in the preceding financial year, then in the current financial year, they are supposed to deduct tax at source. The rule is very simple. Two things to remember. Number one, this is applicable only if the payer is individual and HUF. If the payer is a company, firm, AOP, then the TDS section will compulsorily apply. If the payer is individual HUF, only then you have to look at this criteria. Number two, the turnover that you are checking is of the preceding financial year, not of the current financial year. If the individual is involved in business activity, preceding financial year turnover is above 1 crore, current financial year, TDS provision is applicable. If the individual is a professional, preceding financial year gross receipts are above 50 lakhs, in the current financial year, the TDS provision is applicable. Wherever this concept will apply in our revision lectures, in our revision lecture, we'll see that in this section, this is the criteria applicable. Two sections created, section 197, which talks about a certificate, and section 197A, where the receiver gives a declaration to the payer. The whole idea of these two provisions is to reduce or to eliminate the refund that is arising due to TDS. If tax is deducted at source, but then the tax liability is zero or the tax liability is lower than the TDS amount, so assessing officer can issue a certificate to you. Receiver has to make an application to the assessing officer. Assessing officer will issue a certificate. Payer will deduct tax at the rate mentioned in the certificate. Not follow the section, but follow the rate given in the certificate. It could be 0%, if it could be lower than what the section prescribes. Declaration. So by declaration means you have to give a declaration in form number 15H or form number 15G. The receiver is giving this declaration to the payer. He is declaring that his estimated income is below the basic exemption limit. So payer, do not deduct any tax at source. Give me the full amount because my tax liability is also zero and therefore TDS also should be zero. Payer will take one copy of the declaration for himself. He will take a second copy and submit it to the commissioner, and then he will not deduct tax at source. Furnishing a declaration is optional. Getting a certificate is optional. You have to make an application to the assessing officer, only then you will get it. By chance, after you get a certificate or after you give a declaration, if your income increases, if your tax liability increases, it's not a problem at all. You can pay that tax in the form of advance tax on your own, or you can pay that tax in the form of self-assessment tax when you are filing a return of income. These two sections are a provision created to reduce the refund which can be arising due to TDS. 206AA, multiple times this will get tested in a small practical question, so better you remember this section properly. 206AA is talking about requirement to furnish permanent account number. The receiver is supposed to submit his permanent account number to the payer. Instead of permanent account number, if you submit your Aadhaar number, that is also sufficient compliance. But if you are supposed to, it's a requirement, it's mandatory. And if you fail to furnish your permanent account number, then TDS will be deducted at the rate given in the provision of the act, or 20%, whichever is higher of the two. If you are doing TDS under section 194O, or you are doing TDS under section 194Q, then the formula to be followed is rate given in the section, or instead of 20%, the rate is 5% out of the two, whichever is higher. So generally speaking, you have to consider it as the section rate or 20%, whichever is higher. But just to keep this in mind, for 194O e-commerce transactions and for 194Q, which is the amendment purchase of goods, the TDS will be not 20% but 5%, or the rate given in the section, whichever is higher. The certificate that the assessing officer was supposed to give you under section 197 for lower TDS or no TDS, he will not give you the certificate if it does not contain your permanent account number. If the declaration that you have given, form number 15G, 15H, does not contain permanent account number, then the declaration will be invalid. By chance, if the declaration becomes invalid, it will be treated that you have not submitted your permanent account number, and the payer will be deducting TDS as per 206AA. 206AA does not apply in case the receiver or deductee is a foreign company or a non-resident. You are making interest payment under 194 LC, or you are making dividend payment, royalty, fees for technical services, payment on transfer of capital asset, then 206AA will not apply. The higher rate of TDS will not apply. TDS will be done at the original rate only, provided the receiver, the deductee, the non-resident submits these data to the payer. He does not have a permanent account number from the Indian tax authorities, but if he gives his name, email ID, contact number, address, a residence certificate of that foreign government, and the tax identification number that would exist in that foreign country, if he submits this to the payer, then it is enough compliance. The payer will not deduct tax as per 206AA. He will deduct tax at the original rate only. So as a non-resident or a foreign company, if you do not have permanent account number, you need not make an application and get a permanent account number just to avoid this section. You can submit these details and 206AA will not be attracted. Normal TDS will happen. A very important amendment introduced, 206AB. This amendment is targeting all those people who are not filing the return of income properly. This amendment 206AB, this section overrides the entire TDS chapter. There are certain sections for which this is not applicable. If tax is deducted under 192, 192A, salary payments, RPF payments, winnings, etc., cash withdrawals, then this section will not apply. This section will also not apply to a non-resident who does not have a permanent establishment in India. The reason being, there are various sections existing in the Income Tax Act which are giving a non-resident relief from return of income filing. So, if you are given that relief of filing return of income, you can't now claim that the non-resident who does not have a permanent establishment is a non-filer of return of income, and so higher TDS should be done as per this section. No. So this section will not apply to a non-resident who does not have a permanent establishment. If the non-resident has a permanent establishment in India, then definitely 206AB as a section will be applicable. This section is saying, condition 1, if you have not filed, if the receiver has not filed a return of income as per 139(1) for the immediately preceding 2 years, and number 2, for those 2 years, the aggregate TDS and TCS for each year was 50,000 rupees or more. So for the immediately preceding 2 years, that means it will be 2021 and 1920. If return of income has not been filed according to 139(1), and for each year, TDS plus TCS is greater than or equal to 50,000. If both these conditions are satisfied, then twice the original rate given in the section, or 5%, whichever is higher of the two, this is going to be the TDS rate as per 206AB. So this is in a way penalizing the non-filers of return of income. You will suffer a double TDS, you will suffer a TDS at double the rate because you have not filed a return for the preceding 2 years. By chance, the receiver is not submitting his permanent account number also, then 206AA will be attracted for him. and he is a non-filer of return of income also, if both 206AA and 206AB apply, then TDS will be done at whichever is higher of the two. So independently apply 206AA, original rate or 20%, whichever is higher. Apply 206AB, twice the original rate or 5%, whichever is higher. And then take the TDS rate as per 206AA, as per 206AB, and whichever is higher of the two will be finally the rate at which tax will be deducted at source. If both the defaults happen, default in filing return and default in submitting permanent account number, so we will apply both the sections simultaneously and select the higher of the two. Three sections, 194A, 194B and 194M, where your normal time limit of 7th of next month does not apply. 30 days from end of the month is the time limit applicable. 194A is talking about transfer of immovable property. 194B is talking about rent income, and 194M is a section where three other sections do not apply, so 194M will apply. Of course, as we go ahead, I'll describe all these things in detail. But for these three sections, the time limit will not be 7th of the next month. Whichever month you deduct tax, 30 days from the end of the month, tax has to be deposited. Please remember, it is not 1 month from end of the month. It is 30 days from the end of the month. If the month in which tax is deducted is, for example, June, then your last date is not 31st July, your last date will be 30th of July. If the month in which tax is deducted is February, then 30 days from end of February will be 30th March, not 31st of March. So please do not round it off as 1 month. Please keep it accurate, 30 days from end of the month. Chalo, moving ahead. These are the sections where tax is deducted for residents and for non-residents. Just for remembering section numbers, I have drawn this small chart. You can refer to it if you have time, if you feel quick revision is needed. First section. Now we are going into resident receivers. Salary. Tax will be deducted at source by employer. General rule is payment or credit, whichever is earlier, but for salary, TDS will be deducted only at the time of payment. Employee can be resident, employee can be non-resident, TDS liability will arise. Tax is deducted at source under this section according to slab rates. So, by default, automatically, the concept arising is that TDS under this section will apply only if your salary income exceeds the basic exemption limit. You will apply the slab rates. According to slab rates, you will calculate the tax, and that tax will be deducted equally. That tax will be spread throughout your service period, or rather, I should say, throughout the year for which you are doing the service. If you are working for the employer for all the 12 months, he will say divide by 12. If you have joined the job during the year, then the denominator will not be divided by 12, it will be divided by the exact number of months for which you are working with the employer. TDS will be done on payment basis only. If you are a non-filer of return of income for the past 2 years, still 206AB will not apply. So twice the rate will not be applicable. The rate will be the tax calculated according to slab rates. If the employer so wishes, he is providing a non-monetary perquisite to the employee. Non-monetary perquisite like a accommodation, like a motor car, non-monetary in nature. If the employer wishes to, the income tax component on that non-monetary perquisite, employer can bear from his pocket himself and directly give it to the government. When we were doing PGBP ka revision, we saw that amount will be disallowed under 40A subclause number 5 for the employer, and that amount will be exempt for the employee 10 subclause number 10CC. So how is that calculated? Calculate your total TDS according to the section using slab rates. Find out the proportionate TDS on the non-monetary perquisite. So take the total tax divided by total income multiplied by the value of the non-monetary perquisite. This proportionate tax will not be deducted from the employee's salary. Will not be deducted from the employee's salary. That much tax employer will directly pay from his own pocket. The balance TDS will be deducted from the employee's salary, and it is optional for the employer to do it. He may do it for all employees, he may do it for some employees, but if he does it, then the TDS component which he has paid from his own pocket, which he has borne, will be a disallowed expense for him, and that amount will not be treated as a taxable income for the employee. Employee can have other incomes also. So the act has taken care of that aspect also by saying submission of form number 12B. Employee can have other incomes. An employee could be doing a part-time job with one employer and part-time job with the second employer. So if the employee wants, and it's completely optional, if the employee wants, he will submit form number 12B to the employer. In that form number 12B, employee will tell the employer what are the income details from other sources that he has, other heads of income, what are the income details from the other job that he's getting, has any tax been deducted by those guys. This information will be given to the employer in form number 12B. The employer who receives form number 12B will consider the other incomes, other employer ka income, will also consider the TDS already done by them. The TDS already done by those other people will not be deducted by this employer. He will adjust that amount. He will deduct the balance TDS only. Completely optional for the employee. If he wants, he can give this data. If he wants, he may not disclose any further income to the employer. I said TDS will be done on according to slab rate. So how is the working done? If the employer does not get form number 12B, the only information that he has is the income from salary. Give all the exemptions, give all the deductions that is available to the employee under the head salary. Take that salary income, calculate tax on it, and deduct that tax. This is the simplest example where employee does not submit form number 12B to employer. So employer takes into account the income that he is paying to the employee, computes the taxable amount, and computes the income tax on it and deducts it. If details of other incomes are also furnished, then take into account the other incomes, do the computation. But when you are talking about house property, for house property you will take into account profit also and loss also. But for the other three heads of income, you will take into account only the profit. If form number 12B tells you capital gains, PGBP, IFOS have a loss, income from other losses, I'm sorry, income from other sources. If house property has a loss, you are allowed to consider that loss. If PGBP, capital gains, and other sources have a loss, you are not allowed to consider that loss in this computation. At the time of return of income, employee can do whatever he wants with that loss. But at the time of TDS computation by the employer in the previous year, he will ignore all the losses. The only loss that he will consider is house property ka loss. On that, he will after that he'll give chapter 6A deduction. Even this information obviously will be made available as per form 12B only. Tax is calculated. We saw that if the employee is the receiver, surcharge will be calculated, health education cess will be calculated. Whatever tax is deducted by other deductors, that will be adjusted. This is the first amount, and this will be deducted at source. Second calculation. When does second calculation apply? Second calculation applies only if house property has a loss. If house property has a profit, then the second calculation will not apply. Then the A amount itself will be the tax deducted at source. Only if house property calculation has a loss, then a second calculation will be done. Take salary income, take house property ka loss, that's your estimated income, calculate the tax on it. Do not adjust any other TDS, do not take into account other heads of income, take only salary taxable and house property ka loss. That is your total income, no effect to chapter 6A deduction also. Finally, this is your total income. Compute the B amount, second amount of tax. A or B, whichever is higher of the two, will be your TDS. This TDS will be spread throughout the year, throughout the service period in the year. So B will come into picture only if house property is submitted as a loss. If house property has a profit, then it will be only A amount and that will be deducted at source. This is your section 192. Now, last year, Finance Act 2020, a very interesting amendment was introduced. This amendment, this is a last year amendment. This is applicable only if you are an eligible startup as an employer and you are giving ESOP wala perquisite. ESOP perquisite is a non-monetary perquisite. And generally the ESOP perquisite given as a ESOP given as a perquisite will result into a huge amount of tax liability. Cash component of salary will be much lower. ESOP will be the major component taxable. This will create practical problems where TDS will have to be deducted from the cash component, which will be very insufficient. So last year, what the government did, government said the ESOP will be taxable in the year of allotment, but the TDS component on ESOP will not be deducted in that previous year. The TDS component will be postponed. The recovery of tax on ESOP is postponed to a future year. 4 years, 48 months from the end of the relevant assessment year, date of sale of such ESOP, or date when the assessee stops being an employee. Find out of the three dates, whichever is the earliest date, and take that earliest date, and from that earliest date, you count 14 days more. This will give you the last date. Up to this date, TDS on ESOP will have to be deducted. Obviously, it will have to be deducted by the employer, and due to any reason, if the employer is not able to deduct tax, if the salary is insufficient, if employer fails to deduct tax, then it becomes the employee's duty now to pay this amount as a direct payment under section 191. So the concept here is very simple. What we are saying is ESOP will be subject to tax. ESOP will be taxable in the year in which the shares are allotted, but the income tax component on that will not be deducted at source in that year. Employee, we will collect that tax from you at a future date. How will we collect it? Either by telling the employer that you deduct tax at source 14 days from one of these three dates, whichever is the earliest of the three dates, and by chance if the employer does not deduct tax, so employee will have to pay that tax directly from his own pocket. Case law quite frequently comes up in your paper. ITC limited case law. Customers paid tips to the waiter, but the tip was paid along with the bill, and therefore the tip was directly deposited in the company's bank account. And thereafter, the company dispersed the tips, paid the tips to the waiters, to the employee. But when the company paid the tip to the waiter, TDS was not done on the tip. Now the income tax officer is saying that company is a defaulting assessee because it has failed to deduct tax. Supreme Court said this tip income is not salary income. Customer, instead of directly paying the tip to the waiter, is paying the tip to the hotel, and hotel is thereafter passing it on to the waiter. So it is not income derived from employment. It is not that the hotel is paying this as part of the salary package, and therefore there is no liability to deduct tax at source. ITC limited, the employer is not an assessee in default because this is not salary income, and therefore TDS liability does not arise. Going ahead, 192A. From a recognized provident fund, when you receive money and that amount is greater than or equal to 50,000 rupees, then tax will be deducted at source at the rate of 10%. This TDS will apply only if the amount received is taxable. Generally speaking, amount received from recognized provident fund is exempt if your service period is 5 years or more. If your service period is less than 5 years, but you are getting the RPF money because employer is shutting down his business, because you are forced to retire prematurely because of your ill health, due to any reason beyond the control of the employee, or if he's changing the job and transferring his money from one RPF balance to another RPF balance, or if he is transferring the money from RPF account to National Pension Scheme account, then even if your service period is below 5 years, the amount is exempt. If your service period is 5 years or more, amount is exempt. If your service period is below 5 years, but the reason for getting the money is ill health, business of employer closing down, reason beyond the control of employee, transfer to another RPF on change of job, transfer to National Pension Scheme, even if it's below 5 years, you will still get the exemption. Obviously, if income is exempt, TDS ka section does not apply. But if your case does not fall in any of these exemptions, then the amount is taxable. And if the amount is taxable and it is 50,000 rupees or more, then the RPF is supposed to deduct tax at the rate of 10%. 206 AB does not apply. So even if you are a non-filer of return of income for the past 2 years, double TDS rate will not apply. But if you do not submit permanent account number, then instead of the section rate being 10%, section tells you to do TDS at the maximum marginal rate. That means even if you try to apply 206 AA, what was 206 AA? The rate given in the section, or 20%, whichever is higher. Normal circumstances, this rate is 10%. But if permanent account number is not submitted, section only has made the rate as 42.744%. That means in simple terms, actually speaking, 206 AA will not have any effect. You will deduct tax at the rate of MMR, that is 42.744%. TDS provision will apply only if the amount is taxable. Next, if interest is to be paid to resident persons, there are two sections. 193, which is interest on securities. 194A is other interest, other than covered by 193. But in both the sections, TDS rate is 10%. What is important to study in both the sections are the exceptions. What are the situations, what are the cases where tax is not to be deducted at source? If the receiver is an insurance company, TDS is not to be done. This exception you will find in section 194A also, the next section. This exception you will also find in 194 when we study the TDS relating to dividend. If the receiver is an insurance company and it is receiving interest income, no TDS. Second, if the interest is payable to a resident individual or resident HUF, it is paid by a company in which public are substantially interested. So I'm talking about a public limited company. It is interest on debentures. Interest is paid by account pay check. The amount does not exceed 5,000. If all these small things get satisfied, then TDS will not apply. If you are paying interest to another company, a partnership firm, TDS will apply. If you are paying interest to individual HUF above 5,000, TDS will apply. If you are paying interest to resident individual, resident HUF, but you are a private limited company, TDS will apply. If you are paying interest to a resident individual, public limited company, less than equal to 5,000, account pay check, only then TDS will not be applicable. Interest on debenture. Third exception, any security. So here I am talking about debentures also. Here I am talking about something like bonds also. Any other security is also covered here, not just debenture. It is issued by a company and this security is held in dematerialized form, condition number 1, and it is listed on a stock exchange in India, condition number 2. Then whatever be the amount of interest, whatever be the mode of payment, whoever may be the receiver, company, firm, individual, HUF, if the securities are held in demat form and they are listed on a recognized stock exchange, as per the third point, TDS provisions will not apply. No need to deduct 10% tax. So there's a possibility that somebody could not be covered by exception number 2, but is covered by exception number 3, and therefore TDS is not applicable. 194A. These exceptions are a bit complicated. I've tried to tabulate them so that it becomes a bit easy to study. But yes, they are a bit complicated. You got to pay attention properly. If a banking company is the payer, these are the first 2 points that we are thinking. If a banking company is a payer, in simple terms, if a bank is a payer, and you are getting interest on FD, interest on RD, then if that amount exceeds 50,000 rupees in case of senior citizen, resident senior citizen, or 40,000 rupees in any other case, then TDS will be done. So if you are a resident but below 60 years, if you are a company who is getting FD interest or a firm who is getting FD interest, the threshold is 40,000. If you are a resident senior citizen, the threshold is 50,000. Same banking company gives you interest on savings account, interest on current account. Whatever be the amount of interest, whoever be the receiver, TDS provisions are not applicable. This is in case of a banking company. But now, if you are a cooperative bank, so you are a bank, but it's a cooperative society doing banking business. Now, if you are paying interest on FD, interest on RD, whether you are paying to your member or you are paying to an outsider, 50,000, 40,000, the same point that we studied for FD, RD interest in case of banking company is applicable for cooperative bank also. But if you are getting interest on savings account, interest on current account, and the payer is a cooperative bank, then TDS provision will be done, TDS will be deducted if the turnover of this cooperative bank for the preceding year exceeded 50 crores. So it's a large cooperative bank, and the current year amounts are greater than 50,000, greater than 40,000. Then TDS will be done, otherwise TDS will not be done. So if you make a comparison, banking company, cooperative bank, FD interest, RD interest, the provisions are absolutely identical. I'll put them up in a separate ink so that you'll understand what I'm trying to say. I am saying that a banking company and a cooperative bank, FD interest, RD interest provisions are absolutely same. But if I am talking about a banking company paying savings account and current account interest, there is never any TDS done. But if the same savings account, current account interest is paid to a cooperative bank, then yes, TDS provisions are going to be applicable if these two conditions get satisfied. Next, if I am talking about a cooperative bank, if I'm talking about a cooperative society, but it's not a cooperative bank. It is not a cooperative bank, it's a cooperative society, and it is paying interest. Then the same concept. Last year you were having a turnover greater than 50 crores, you are a large cooperative society, and current year the interest paying is greater than 50,000, greater than 40,000, then TDS shall be done. In other cases, TDS shall not be done. This is where you are paying interest to a member or to any other cooperative society. If you are paying interest to any other person, so that the receiver is not a member for you, the receiver is not a cooperative society, receiver is somebody else, then TDS will be done if the interest amount exceeds 5,000. Now, cooperative society can have a turnover greater than 50 crores or less than 50 crores or equal to 50 crores in the preceding financial year. We don't care. Every cooperative society is covered here, and the threshold is as low as 5,000 rupees, because you are paying to any other person, you are paying to an outsider, you are paying to someone who's not a member, who's not another cooperative society. Threshold is 5,000, TDS will always apply. If you are a primary agricultural credit society, primary credit society, cooperative land mortgage bank, cooperative land development bank, so you are basically a cooperative society who is somewhere or the other connected to agriculture or land mortgage, and you are paying any interest to to a member or to another society, 50 crores preceding financial year, 50,000, 40,000 current year ka interest, TDS provisions will apply. Same concept, same rule, absolutely same rule. If you pay interest to any other person, if you pay interest to an outsider, the provision is the identical provision. TDS liability will get attracted whether you pay to your member, outsider, any other cooperative society. TDS provision will get attracted if your turnover in the preceding year was above 50 crores and the current year interest that you are paying is above 50,000 or above 40,000. These things are complicated actually to remember. Henceforth, after this, all other implications or other exceptions are very simple. If the post office is paying interest on senior citizen savings scheme, so 50,000 ka threshold limit, if it exceeds, TDS will be done. Of course, any person here means I am talking about a senior citizen only. Obviously, in a senior citizen savings scheme, it will be a senior citizen who is receiving interest. Any other person getting interest, any other type of interest greater than 5,000, TDS will apply. Whether it is FD made with post office or savings account made with post office, TDS will apply. If banking company, LIC, insurance company, any other insurance company, unit trust of India, cooperative society carrying insurance business, a financial corporation, if these people are receiving interest, example, interest on car loan, interest on housing loan, interest on working capital loan that we pay to them, on some LIC policies you get loan and you have to pay interest, then there is no tax to be deducted at source. It is income taxable for LIC, it is income taxable for those banking companies, but they will directly pay income tax. As the payer, I don't have to deduct tax on the interest component. When a partnership firm pays interest to a partner, whether it is on capital account, current account, loan account, any type of interest, no tax is deducted at source. If you are making a payment on zero coupon bond, but obviously zero coupon bond means there is 0% interest. So if there is 0% interest, where is the question of deducting any tax at source? There is no TDS done. When central government pays interest to any person, and it is interest under the Income Tax Act, that means I am talking about interest on income tax refund, then it is an exception under section 194A. But the implication of this is section 194A will apply only if the receiver is a resident person. So if central government is paying interest on IT refund to a resident assessee, TDS will not be done. But at the same time, when the central government pays to a non-resident assessee interest on IT refund, the moment you say that the assessee is a non-resident, what will happen is कि by 194A will not apply. If 194A does not apply, 195 applies. That means this exception of 194A is also not available. TDS will be done under section 195. If there is any interest which is awarded by Motor Accident Claim Tribunal, then on that interest, on payment basis only, tax will be deducted provided the threshold is 50,000, exceeding 50,000. When a special purpose vehicle pays to a business trust interest on loan, that interest is exempt under 10 clause number 23 FC subclause number A. Naturally speaking, if for the receiver this is an exempt income, then for the payer there will be no liability to deduct tax at source. 194A का exceptions, they are a bit difficult, a bit lengthy. Just ensure take about 10-15 minutes and patiently try and read them and try and memorize them, and then you'll be able to tackle the questions properly. A very small case law, 2014 का case law, it was clearly assessing officer's mistake. A dispute going on in the High Court between two individuals or two persons about a certain transaction. So the money involved in the transaction was deposited in UCO Bank. The High Court deposited it, and it was a FD made in the name of Registrar General of the High Court. Obviously, the money does not belong to High Court. So UCO Bank did not do any TDS. The entire interest was accumulated in the FD amount. Assessing officer sends a notice to UCO Bank saying you are a defaulting assessee because the interest is exceeding the threshold limit and you have not deducted tax. Now the Delhi High Court said that these deposits are in custody. They are as per the orders of the court. They are in the custody of the court, which means the interest accrued is also part of the funds under custody. It is not to a person who is liable to be assessed to tax. So High Court said that Delhi High Court said, "K assessing officer, you are wrong in saying that UCO Bank should have deducted tax." One thing is very clear. Once the court decides the ownership of the money lying in the fixed deposit, TDS provisions will apply to that receiver of income. After the dispute is resolved and the court has said, "Okay, so and so person is the owner of the money," obviously TDS provisions will get attracted thereafter. But no tax has to be deducted at source if the interest is credited in the name of Registrar General. This is your interest ka discussion. Dividend, very easy. Last year, 2020 budget made dividend taxable and DDT was abolished. So obviously with DDT getting abolished, TDS provisions have to be made. If domestic company is deducting tax at source, 194 is a section. Receiver is a resident shareholder. Rate of TDS 10%. No tax will be deducted if the receiver, that means if the shareholder, is a resident individual, resident HUF, dividend amount is less than equal to 5,000 and payment is made by any mode other than cash. So number one, the shareholder should be individual HUF. Number two, the dividend amount should not exceed 5,000 and the payment should be any mode other than cash. Then there is no need to deduct tax at source. If the receiver is an insurance company, no need to deduct tax at source. A small amendment which is also pretty logical. When a special purpose vehicle pays to a business trust dividend, then for the business trust, this dividend is exempt under 1023 FC. Sorry, not F, 1023 FC. Subclause number B. And so if the dividend income is exempt anyways, where is the question of deducting tax? Until now, this exception was not clear-cut mentioned in the law. The amendment, what it has done is, it has brought about this clarity whereby it says, by there is no need to deduct any tax at source because the income is exempted from tax. So you don't worry about the taxability of this income. TDS will not be done. Special purpose vehicle, you don't need to deduct any tax at source. 194K, when dividend is paid by mutual fund to a resident unit holder, TDS will be done at 10%. The odd thing here is, receiver is an insurance company. This exception is missing in 194K. The exception created is, if the nature of income is capital gains, TDS will not be done. Obviously, here in this section, we are only talking about dividend income, not capital gains. If the amount of dividend is less than equal to 5,000, but this is the only exception created. So as an insurance company, if you receive dividend more than 5,000, TDS will apply. Remember, as an insurance company, if you receive dividend from domestic company, there will be no TDS. I'll repeat what I said. If there is a domestic company which is paying dividend to LIC, then there is no tax deducted at source. But if a mutual fund is paying dividend to an insurance company, then the provision, which is honestly speaking quite odd, the provision says that if this dividend is up to 5,000 rupees, no problem, don't deduct any tax. But if this dividend exceeds 5,000 rupees, then TDS provisions will be applicable. So that receiver being an insurance company is an exception which the government seems to have missed out. Next, winnings income. Lottery winnings, puzzles, gambling, betting, and winnings from horse race. Both places the threshold is 10,000 rupees. If it exceeds 10,000, TDS rate will be 30%. The section of non-filing of return of income is not applicable to these two sections. So you will not do double the rate. You will not do 30% into 60%. You will do 30% only. These incomes are subject to tax without any basic exemption limit, without any benefit of set off carry forward of losses, without taking any chapter 6A deduction. So getting a reduced TDS rate by getting a certificate from assessing officer or giving a declaration that income is below exemption limit, all these things are not possible. Certificate, declaration, form 15G, 15H, nothing of that will apply. If the amount is greater than 10,000 on payment basis only, TDS will be deducted at the rate of 30%. If the winnings are partly in cash and partly in kind, then the cash component that we are talking of, that is available for TDS. That's not a problem. Cash component is available for TDS. But if it is in kind, the in-kind TDS, in-kind winnings is also eligible for TDS. Now we may so happen that cash plus kind total winnings into 30% TDS. This TDS is more and the cash component is less. So the payer will collect the TDS deficit from the receiver, deposit it with the government, only then will give the winnings to the receiver. If the winnings are fully in kind, then whatever is the TDS, first you collect it from the receiver and deposit it with the government, only then release the in-kind winnings to the receiver. This case law, something very simple. If a lottery ticket seller, somebody who is an agent and who sells lottery ticket for commission, wins a lottery on an unsold ticket, then he is not a lottery distributor now. As far as that prize money is concerned, he is a holder of a lottery ticket. Lottery was selected on that ticket which remained unsold. So as a lottery distributor, I took that ticket and I went to the lottery organizer and I demanded my money. Now I am demanding my money like any other lottery winner. So it will be taxed at the rate of TDS 30%. TDS under 194B will be applicable. It is subject to tax at 30%. It is not your business income just because you are a lottery distributor. It is subject to TDS at 30%. Going ahead, commission, three sections of commission. 194D, which talks of insurance commission. Obviously, when we are talking about insurance commission, the payer is an insurance company. The receiver is the agent of insurance company. 194G, sale of lottery tickets. So lottery organizer will pay and lottery distributor will receive the commission. Any other commission which is not covered by D, which is not covered by G, will be covered by 194H. For example, when we purchase or sell a property, we pay commission to the broker. Then that commission is covered by 194H. In the course of business, I could have a selling agent who sells my goods, and to that selling agent, I will pay commission. He's an agent. This commission does not include commission that we pay to employee. Commission paid to employee is part of salary income, and for which section 192 is already there. This commission that we are talking about is commission that we pay to a pure agent, but it's not covered by 194D and 194G. Then 194H will apply. For all three sections, the threshold is greater than 15,000. For all three sections, the TDS rate is 5%. In all three cases, the receiver is a resident person. But specifically, in case of 194H, and this is what we saw some time ago, in case of 194H, if the payer is an individual HUF, then TDS provisions will apply in the current year only if for the preceding financial year your turnover exceeded 1 crore in case of business or exceeded 50 lakhs in case of profession. At the starting of the revision of TDS, we saw this point. Now we are seeing this point. Okay, at the starting, we saw it on a general basis. Now I'm saying this is a point applicable for 194H. Television channels making payment to advertising agency, it is in the nature of trade discount, and because the relationship is on a principal to principal basis, so then there is no commission, there is no principal agent, there is principal to principal basis wala equation, and so there will be no tax deducted at source. When a telecommunication company supplies SIM cards and recharge coupon to a distributor, then the difference is that commission. So if a SIM card is given by the telecom company for 200 rupees, and the agent is going to sell it, the distributor is going to sell it for 300, that 100 rupees is his commission. The distributor is only acting as a middleman, and therefore what he's getting as the difference is the commission. If there is a recharge coupon of 500, the distributor will get it for, let's say, 470 rupees. The customer will pay 500, so that 30 rupees is the commission income of that middleman, and therefore 194H will be applicable. CIT versus Ahmedabad Stamp Vendors Association. So what is this? The stamp vendors are required to purchase the stamp papers on a certain price less discount, but this is on a principal to principal basis. So there is no agent. It's a vendor. The person is buying stamp papers from the government agency, from the government authority, I should say, buying stamp papers. 100 rupees the stamp paper. I will pay, let's say, 95 rupees. I will sell it for 100 rupees. So 5 rupees is my profit, but then I am taking that 5 rupees. It's not a commission. It is on a principal to principal basis. That means 194H is not applicable. The discount on purchase of stamp paper therefore does not fall within the expression of commission or brokerage to attract the provisions of 194H. Qatar Airways, a very famous case law. Multiple times it has come up in your paper. In fact, in your ICAI study material, main study material, they have created a small illustration also on this. The agent is told that X rupees is the maximum price, say for example 12,000, and 7,000 is the minimum price. And he is given that liberty anywhere between this 7,000 and 12,000, he can sell the ticket of the airline of that particular flight. For every ticket that he sells, he will be paid 9% of that maximum price. It is the industry norm to pay commission of 9%, and that is always based on the maximum price. Whether the ticket is sold by the agent for 10,000 rupees, 11,000 rupees, or 7,000 rupees, his commission is calculated on the maximum price. And on this commission, TDS is deducted at this as per 194H. The assessing officer said, okay, whatever is the actual sale price, TDS should be done on the difference between this actual sale price and the minimum price. This is the TD. This is a special commission according to assessing officer, and the court said it is not practically possible for the airline company to find out at what price the ticket was sold and what is the exact income. So the way TDS is currently being done is absolutely fine. On the maximum price, 9% is paid as commission. The tax was not deductible at source on the difference between the actual sale price and the minimum price. even though the amount that was earned by the agent is taxable in his hands as income, but then that will not be subject to TDS. There's no special commission as such involved here. Moving ahead, 194I and 194IB rent. Important, you can expect a small question based on this. It's easy. I'm not saying it's difficult. I'm saying it's important. It's very easy. Here we are talking about 194I is the first section to study. In a sequence, you must first study 194I. Rent, deductor is any person, deductee is a resident person. The threshold is greater than 2,40,000, and the threshold of 2,40,000 is on the basis of per person. That means per person, I should say per receiver. So with that receiver, you have taken one asset on rent or multiple assets on rent. But to that receiver, if you are paying rent greater than 2,40,000, then the section of TDS is applicable. Per transaction, the rent could be less than 2,40,000. But during the year, for multiple assets taken on rent, if you are paying more than 2,40,000, TDS will apply. If the asset is plant, machinery or equipment, 2% ka TDS. If the asset is land, building, furniture, 10% ka TDS. Again, a provision which we are aware of, if the payer is an individual or HUF, then 194I will apply in the preceding financial year if your turnover was greater than 1 crore, greater than 50 lakhs. That means if the turnover in the preceding financial year was below 1 crore, below 50 lakhs, then this individual, this HUF, will not be required to deduct tax at source under 194I. And that's why government created 194IB. 194IB is talking about a situation which says that if the payer is an individual or HUF, in the preceding financial year, if the turnover did not cross 1 crore, did not cross 50 lakhs, then 194I is not applicable. And if 194I is not applicable, we have created 194IB for you. You have to deduct tax as per 194IB. What is 194IB saying? It applies only if you are an individual HUF as a payer. The asset covered is only land or building or both, which means if there are other assets like furniture, machinery, air conditioner, etc., so 194IB is not applicable. It's only applicable for immovable property like land and building. The monthly rent should be greater than 50,000. You are supposed to deduct tax at source under 194IB only once. In the last month of the financial year, that is March, or the last month of the tenancy if your tenancy agreement is expiring before March. So you don't need to deduct tax every month. You have to deduct tax just once, that is at the end of the year or end of the tenancy period. You will deduct tax at the rate of 5%. Obviously, you will deduct tax at the rate of 5% on the total rent, not on the rent of the last month only. But this will be your TDS and this amount will be deducted from the last month rent. If by chance 206AA gets attracted, in case of 194IB, 206AA gets attracted. So the receiver of rent, the owner of the land or building, refuses to give permanent account number. The tenant will be forced to deduct tax at the rate of 20%, 5% or 20%, whichever is higher. But the problem is that if he does that, there is a possibility that the last month rent is less and the TDS of 20% is more. Then we will not count the payer, the tenant, as a defaulting assessee. We are saying the TDS shall be restricted to the amount of last month ka rent. So if the receiver does not submit permanent account number to the payer, 206AA and 194IB both read together, TDS will be at the rate of 20% but restricted to the last month rent. For 194IB, since you are doing tax deduction only once in a year, there is no need to obtain any tax deduction account number. You don't need a TAN number. You can directly deduct tax. Coming back to our section 194I, Threshold is 2,40,000. All the payers, company, firm, everybody is covered in 194I. But if an individual or HUF is a payer, then 194I will apply only if in the preceding financial year the turnover is more than 1 crore or more than 50 lakhs. When rent is being received by REIT, then that income is exempt under 1023 FCA. So the tenant who is paying the rent, no tax needs to be deducted at source. If there is a non-refundable deposit that the tenant is paying to the owner, it is not a deposit in the true sense, it is a non-refundable deposit. So the money is not going to come back to the tenant. The owner is going to take that money and it is going to be his income only. So this non-refundable deposit is equal to the rent amount. It should be included, and then you must check the threshold of 2,40,000. If the deposit is refundable, refundable deposit is a pure asset for the tenant, and on assets we will not do any TDS. TDS will be done on expenses and incomes, not on assets. If there is any interest on that refundable deposit, such an interest will be covered under 194A. So non-refundable deposit, 194I will apply. Refundable deposit, no TDS section will apply. Interest on refundable deposit, 194A will apply. Warehousing charges. Warehousing charges means you are paying amount for storage of products. That means you are paying rent. That warehousing charges will be covered by 194I. But if you make a payment for cold storage facility, you are making a payment for preservation of goods. And preservation of goods means it is a work contract, and work contract means section 194C will apply. So if it's a normal warehouse, it's rent payment 194I. If it's a cold storage facility for preservation of perishable items like milk, fish, meat, blood, etc., vegetables, fruits, perishable items are stored, then it is a work contract 194C will apply. Profits arising to resident on transfer. Now I am talking about transfer of immovable property. This is a section 194IA where you will deposit the TDS in 194IA within 30 days from end of the month in which tax is to be deducted at source. In fact, the same provision is equally applicable for 194IB also. 7th of the next month wala criteria does not apply. Transfer of number one, immovable property. So shares, jewelry, movable properties are not covered here. There is no TDS section created for movable property. It is only immovable. Second, it should be other than agricultural land, and the exact definition or the exact meaning here is that it should be other than rural agricultural land. We know from our capital gains lecture that rural agricultural land is not a capital asset. So this immovable property, if it is a rural agricultural land, then this section 194IA is not applicable. Any other immovable property, commercial, residential, open plot of land, urban property, urban land, non-agricultural land, then 194IA is definitely applicable. Threshold created is 50 lakh rupees or more than that. Rate of TDS is 1%. TDS will be done 1% on the amount of consideration. 1% of the amount of consideration. What is the meaning of this word consideration? Consideration will not only include the properties amount, but will also include all these ancillary payments: club membership fee, car parking fee, electricity deposit or electricity fee, maintenance fee. These are all ancillary payments connected to the transaction of immovable property. These also will be taken into account. Property ka amount will also be taken, and if this total is 50 lakh rupees or more than that, that is when TDS provision will apply. Payer will deduct tax of the receiver, 1% of the consideration. For the receiver, what is the head of income applicable? The receiver, the head of income applicable will be capital gains, but it does not matter. It can also be PGBP. As a payer, if I buy a flat from a builder, or if I buy a flat which is already owned by some individual, I don't know for them whether it is PGBP or capital gains. I am the payer. I will just look at the section and I'll say greater than 50 lakhs, I'll deduct tax. So for the receiver, whether it is taxable as PGBP or capital gains, this section will apply. Chalo, going ahead, other sections of TDS. 194 DA, amount received from life insurance policy. In a way, I have mentioned something earlier related to this. If you are getting money from life insurance policy, and that money that you are getting from life insurance policy is exempt under section 1010D, naturally the question of doing TDS under 194 DA will not apply. But if 1010D is not applicable, that means the amount is taxable. And if the amount is taxable, then yes, 194 DA will be applicable. The best and the most easy example to remember is Keyman insurance policy. It is a life insurance policy, but it is on the life of Keyman, therefore we call it as a Keyman insurance policy. Amount received from a Keyman insurance policy is chargeable to tax. And if it is chargeable to tax, then the TDS section will apply. But any other normal insurance policy that you and me purchase as individuals, amount received on maturity, amount received on death is all exempt. If the amount is exempt, there is no need to deduct tax. If the amount is taxable, then TDS provisions are applicable, and then tax will be deducted by the life insurance company. Deductee is any resident person. Threshold is greater than 1 lakh. Rate of TDS being 5%. On the amount of income that is comprised in the payment, not on the full payment, on the income component. And what is the meaning of income component? Whatever amount insurance company is paying minus whatever premiums it has received on such policy. That surplus is your profit element. On that profit element, we will deduct tax at source at the rate of 5%. So it's not going to be 5% on the gross amount, it's going to be 5% on the insurance company paying money minus the premiums that have been paid so far. Moving ahead, fees for professional services, technical services, 194J. There are 5 expenses covered here. Fees for professional services, fees for technical services, royalty, non-compete fees. For each one of them, there is a separate threshold of 30,000 rupees. TDS will apply if individually each amount exceeds 30,000. TDS rate is 10%. Fees for technical service, the TDS rate has been reduced to 2%. If you are paying remuneration to a director of a company and that remuneration is not covered by salary, so it is like paying to an independent director, sitting fees, then there is no threshold limit prescribed less than 30,000, more than 30,000, nothing doing. Whatever is the amount, tax will be deducted at source at the rate of 10%. If you are in the business of operation of call center, then the payer will deduct tax at the rate of 2% only and not 10%. If royalty income is paid, which is for sale, distribution, and exhibition of cinematography films, then TDS will be at the rate of 2%. So normally speaking, royalty ka TDS rate is 10%. But if there is sale, distribution, or exhibition of cinematography films, and royalty income is earned out of it, then the payer will deduct tax at 2%. Again, a point that which we are aware, if the receiver is, sorry, if the payer, if the payer is if the payer is an individual or HUF, then section 194J will apply in the current year only when the turnover exceeds for the preceding financial year 1 crore or 50 lakhs. If you are making a payment of professional services but for personal purposes, then TDS provisions are not applicable. When hospital receives the amount from insurance company, then insurance companies delegate this work to a third party administrator, TPA. So insurance companies will give the money to TPA and TPA will give the money to hospital. Now this is professional services given by hospital. Insurance company is making a payment to the hospital. This is not a personal transaction, this is a proper business transaction. So 194J will apply to the third party. Instead of the insurance company making a payment, the TPA is making the payment. But then TPA will also have to deduct tax at source. This was the circular given way back in 2009. This case law Ajmer Vidyut Vitran Nigam. Here we are talking about a transmission company receiving money, receiving income from distribution company. So when the distribution company distributes electricity to the general public, it gets the electricity, it gets the power from transmission company. And so transmission company makes the payment. This was held as fees for technical services. Transmission company will set up various power stations at which there will be engineers who will be working, who will be monitoring the power supply, and therefore the payment made by distribution company to the transmission company is fees for technical services. There is also something called as SDLC charges, but SDLC charges is a kind of a statutory levy. SDLC charges is because Electricity Act has imposed it. Distribution company will pay to the transmission company will pay to the state government, and so SDLC charges does not have any income component attached, so 194J will not apply. Kotak Securities case law. If you become a member of a stock exchange, the stock exchange gives you access to its software, a particular software which is needed for doing the transaction, for which a broker has to make a payment to the stock exchange. This is not a customized software. This software is made available to everybody who is a broker. So the broker is not making any special payment for any special type of any special type of software. These are a kind of transaction charge, and therefore they are not fees for technical services. And if they are not fees for technical services, 194J is not applicable. Getting a software which is of a specialized nature, customized to your requirements, that would be fees for technical services. But here there is no exclusivity concept. It is a normal software given, normal transaction charges are conducted, are levied, so there is no need to deduct any tax at source. 194C, something really important, contractor payments. Work contract is what is covered here. One time payment should be greater than 30,000. Total payment made during the year should be greater than 1 lakh. One of the two things getting attracted, TDS provisions will apply. 1% if the receiver is individual HUF, 2% in all other cases. The deductor, the person who is deducting tax, is broad enough to cover everybody. Individual HUF will be covered if greater than 1 crore, greater than 50 lakhs in the preceding financial year. The definition, the payment is made for work contract. What does work cover? Work covers advertising, broadcasting, telecasting, catering, carriage of goods, manufacturing or supplying a product as per the requirement or specification of the customer by using materials purchased from such customer or purchased from related party of such customer. So if you get an order from the customer gives you raw material, or the related party of the customer gives you raw material, then it is all included as work, and TDS under 194C will have to be done. If you purchase the product from a third party, it's not the customer, it's not a related party also of the customer. If you purchase the raw material from somebody else, then it is not a work contract, then TDS provisions will not apply. So if the customer gives you an order and the raw material is also supplied by customer or its related party, only then it is covered as work, and the definition of work is satisfied, 194C will apply. If you are individual or HUF and you are making a payment of work contract for personal purposes, TDS section will not apply. If you are making a payment for plying or hiring goods carriages, that means the work is carriage of goods, but the person to whom you are making a payment, that receiver, owns less than or equal to 10 goods carriages. That means this person is covered by 44AE, presumptive taxation, less than equal to 10 goods carriages. If he submits a declaration that his number of goods carriages are less than equal to 10, and that declaration contains his permanent account number, then 194C will not apply. If the number of goods carriages that he has are greater than 10, TDS section will apply. If they are less than 10 and he gives a declaration, but the declaration does not contain his permanent account number, 194C will apply. Not containing permanent account number, which means 194C along with 206AA will apply. If the number of goods carriages are less than 10, he gives you a declaration, the declaration contains a permanent account number also, then there is no requirement to deduct any tax at source. First circular, if the seller of gas cylinders also undertakes transportation to the buyer, and he specifically says that for the gas cylinder it is X rupees and for transportation it is Y rupees, it does not mean that it becomes a transportation contract. It is still a sale contract. TDS will not apply. When the seller delivers goods to the buyer and takes some amount as transportation charges does not mean it's a transportation contract. TDS under 194C will not apply. But of course, if the seller makes a if the seller delivers the goods to the buyer but does that delivery through a third party transporter, then the payment that the seller will make to that transport operator is obviously 194C is applicable. If the seller delivers the goods to the buyer on his own, it is still essentially a sale contract and not a work contract. 194C will not apply. CA Intermediate, May 2022. CA Intermediate, the paper that just happened about 4 or 5 days ago. Based on this circular, a question was asked in the CA Inter paper, May 2022. Circular number 4, 2016. When a production house, a television production house, makes a payment receives a payment from television channel makes a payment to the production house, it is a work contract because channel has told the production house what type of content it requires, and according to that content the production house will make the television episode, television serial. Channel will own the IPR, intellectual property rights. Channel making a payment to the production house is work contract. Where the content is produced as per the specification of the broadcaster of the channel, copyright is also with that channel, it is work as per 194C and therefore subject to TDS. Next, we saw this cold storage means it is to preserve the perishable goods and not storage. The normal warehouse is covered by 194I, and if it's a preservation cold storage facility, then 194C will be applicable. A very important case law, Japan Airlines and Singapore Airlines, the conflict was when the airline company makes a payment to Airport Authority of India, AAI. Is it payment for using the airport, using the land, or is it more complex? Supreme Court took two High Court judgments. One is a Delhi High Court judgment, the other is a Madras High Court judgment. Supreme Court took both the judgments together and gave a combined verdict. The agreement between the airline company and Airport Authority of India is not just for using land. There are various other facilities which are provided. Ground staff is provided by Airport Authority of India. Air traffic services, air traffic control, ATC is provided. Communication with the airplane, it is all facilitated by Airport Authority of India. This means it is properly a work contract. It is not just for parking the aircraft in the on the runway. It is not for usage of runway. This is specifically speaking cargo charges, passenger handling charges, meteorological services. All these services are provided by Airport Authority of India to every airline company. It is a work contract. 194C will apply. It is not rent. 194I will not apply. Indian Oil Corporation. A carrier who is engaged in road transport was told, okay, you have to carry our petroleum products, transport our petroleum products from one place to another. When the contract was analyzed, the carrier would be paid transport charges for the shortest route traveled. The contract did not require payment of idle charges. There was no entitlement of any other payment other than transportation of goods. So carrier was not being hired full time only for Indian Oil Corporation, but Indian Oil Corporation said that we will make the payment to you, you transport these goods. It means it is purely for transportation and 194C is applicable. The carrier is not exclusively working for Indian Oil Corporation. Whenever Indian Oil Corporation wants, it will hire the services for transportation, it will make the payment. This is a work contract. 194M. 194M applies to all situations where 194C is not applicable, work contract, where 194H, commission is not applicable, and where 194J is not applicable. Who is the payer? Payer has to be individual HUF. If the turnover of this individual HUF in the preceding financial year was less than 1 crore, less than 50 lakhs, then 194H, C and J are not applicable, so 194M will apply. If you are making a payment for work contract but for personal purpose, professional services but for personal purpose, then 194C and 194J are not applicable, so 194M will apply. The threshold created is greater than 50 lakhs, the TDS rate is 5%. If the amount paid is greater than 50 lakhs, only then tax will be deducted at source, that too at the rate of 5%. Going on, 194N. For 194M, the section that we just finished, 194M, here also the time limit to deposit this TDS is 30 days from end of the month. 7th of the next month concept is not applicable, and you don't need to obtain any tax deduction account number. Without that also you can deduct tax. 194N, payment of certain amounts in cash. To discourage cash withdrawals, this TDS section has been introduced. You will the bank where you have an account will deduct tax at the rate of 2% if you withdraw cash in excess of 1 crore. Then on that excess amount, the amount in excess of 1 crore, that amount will be subjected to TDS, and the TDS rate applicable will be the rate of 2%, 2% on the excess. But then last year, a proviso was inserted. What is the proviso saying? For all the 3 past years, if 139(1) has not been followed and return has not been filed on time for all the 3 preceding years, then two conclusions will happen. First, the threshold will come down to 20 lakhs. Second, 2% if the cash withdrawn exceeds 20 lakhs but up to 1 crore. And if your cash withdrawn goes above 1 crore, then tax will be deducted at the rate of 5% of that excess. So if it goes above 1 crore, this is the chart that will help you. If the cash withdrawn is above 1 crore, on that 80 lakh rupees, TDS will be at the rate of 2%, and anything above 1 crore, TDS will be at the rate of 5%. This is where that proviso is getting attracted. So if you have not filed your return of income for the preceding years as per the 139(1) due date, then this proviso will get attracted. Obviously, for non-filing of return for the preceding 3 years, there is already a section existing. So 206AB, non-filers of return for the preceding 2 years, that provision is not applicable because for 3 past years, we already have a concept in 194N. So if you are a regular assessee, if you have filed your return of income for all the past 3 years properly, threshold is 1 crore, TDS will be 2%. If you are not filing returns properly, threshold will come down to 20 lakhs. From 20 lakhs to 1 crore, 2%. Above 1 crore, 5%. Generally speaking, whatever tax is deducted is to be treated as your income, but tax deducted under 194N will not be treated as your income, which is pretty normal. This section is to discourage cash withdrawals, and therefore this section will not consider the TDS amount as your income. 194O. This is talking about e-commerce transactions. E-commerce operator will deduct tax. E-commerce operator is a person who is providing a platform to you on which you can sell a digital platform, on which you can sell your goods, you can provide your services. E-commerce participant is the person who will sell the product, sell the services. So the buyers will make the payment to e-commerce operator, and e-commerce operator will pass on the payment to e-commerce participant, and that is where this is the situation where TDS under 194O will apply. This section overrides the entire chapter of TDS. So if 194O is applicable, no other section of TDS will apply. Tax will be deducted at source at the rate of 1% of the gross amount. If by chance 206 double A gets attracted, then it will be 1% or 20%, 1% or 5%, whichever is higher. For 194O, the threshold is 5. The rate of TDS as per 206 AA is 5%. If the buyer has directly made the payment to e-commerce participant for certain goods and services, it will be deemed that this amount is also payable by e-commerce operator to e-commerce participant. A deemed credit will be done, and that means even on this amount, 194 OCA TDS will have to be deducted at source. A small exception to remember: if the e-commerce participant is an individual HUF and of course a resident, the amount does not exceed 5 lakh rupees and the e-commerce participant has submitted permanent account number or Aadhaar number, then because the amount of sale is below 5 lakhs, up to 5 lakhs, no tax will be deducted at source, the full amount will be paid. If When will this section not apply? Non applicability of TDS under any other section, which means if sorry, any other section will not apply if under this section tax has been deducted under 194O, so other provisions will not be applicable. E-commerce operator is a person who operates who provides this digital platform. E-commerce participant is somebody who is a resident of India. Services provided through the e-commerce platform will include professional and technical services also. Goods ka sale is also covered. Going ahead, when the business trust distributes income to the resident unit holder, if the income is of the nature of interest, dividend, and rent, then these incomes are taxable for the unit holder. Obviously, it means if it is taxable, the business trust will be liable to deduct tax. And my unit holder is a resident person here. For all three items, it will be 10%. But as far as this dividend is concerned, if special purpose vehicle has paid tax under 115BAA, then and only then 194 LBA ka TDS will apply because the dividend component will be taxable for the unit holder. By chance, if the special purpose vehicle has paid income tax as per Finance Act 2021 ka rates, then this dividend is not taxable for the unit holder. Obviously not taxable for the unit holder, the 194 LBA is not going to be applicable. Coming to our amendments, first amendment 194P, you must be a specified bank. Specified bank means a banking company. Specified senior citizen. Specified senior citizen means you are an individual who is a resident, who is of minimum 75 years at any time in the year. You are having pension income, and that pension income is being deposited in an account maintained with that specified bank, and you are earning interest income from that specified bank. So you are having only two incomes: one is pension and other is interest from that specified bank. You don't have any other incomes. You are a specified senior citizen, you have only these two incomes, and if you give a declaration to the bank, what the bank will do is calculate your total income, give you chapter 6A deduction, whichever chapter 6A deduction you are entitled to, give you the rebate under section 87A, calculate your tax according to slab rates, and that will be the tax deducted at source. Of course, basic exemption limit will be 3 lakhs or 5 lakhs only because you are a senior citizen and a resident. If TDS is done as per this section, your entire tax already has been deposited in the form of TDS. So you don't need to file a return of income because this is the relief given to you. Pension income, interest income, taxable, chapter 6A deduction allowed, total income on which tax payable is equal to the tax deducted. So no need to file a return of income. 80 TTB deduction of 50,000 will be available to you if you are a senior citizen. Any account can be maintained, savings, fixed deposit, etc. And on all the interest that you get, savings, fixed deposit, recurring deposit, all the interest, you are entitled to 80 TTB ka deduction. 194Q. 194Q is a section which says if the buyer of goods is having a turnover in the preceding financial year greater than 10 crores. And today he is making a payment for the goods whose value is greater than 50 lakhs. Then this buyer is supposed to deduct tax at source. TDS is to be done at the rate of 0.1% on the excess over and above 50 lakhs. These goods do not cover goods covered by 206C subsection 1 where tax will be collected, goods covered by 1F where tax will be collected, any remittance made for goods covered by 1G or any other product where any other transaction where TDS is done. So, if these goods are covered by 206C subsection 1, subsection 1F, subsection 1G, then seller will collect the tax. Buyer, you don't deduct tax. If buyer is supposed to deduct tax on some other transaction, then he will not deduct tax under 194Q. Keep this amendment in mind. 5-10 minutes later, we'll come back to this amendment and we'll discuss this. Combined application is also given. You can read it for an example purposes. It's an amendment, therefore I've put up the example. Next part of the chapter, when TDS provisions are applicable for non-resident receivers. If you are making a payment to a non-resident sportsman, non-resident entertainer, non-resident sports association, if they are an individual, they are not a citizen of India, then TDS provisions will apply. Then 194E will apply. Tax will be deducted at source at the rate of 20%. You are making a payment to non-resident sportsman. Which payment are you making? Because he is participating in India or maybe in any sports, he is earning advertisement income or he is writing articles for newspaper and magazine and is earning income. If you are making a payment to non-resident sports association, then this payment that is being made is because their team, their players are coming to India and participating in the game, then that association is being made a guaranteed amount of payment that is covered here. A non-resident entertainer, because he's giving his performance in India, he'll be getting some income. 20% is the amount of TDS to be done. If you make a payment to umpires and match referees, so they are professionals, all right, but they are not sportsmen. So therefore, umpires and match referees who are non-residents and non-citizens of India, they are not sportsmen. So 194E will not apply. Tax will have to be deducted at source under 195. The same umpire, the same match referee, if he is a resident, then 194J is applicable. If he is a non-resident, then 194E will not apply because they are not sportsmen. They are part of the sport which is being played, but they are not sportsmen. So TDS will be done under 195. Coming to this provision of TDS payments, just 1 second. Uh, hmm, when you make interest payments to non-residents, sorry, rotating it isn't working. I'm trying it, but it's not working. Let's not waste time. Chalo na. Uh, no, chalo. Let's just focus on the lecture. When infrastructure debt fund pays interest to a non-resident, TDS will be deducted at the rate of 5%, 194 LB. When Indian company or a business trust pays interest to non-resident, 194 LC applies. TDS is done at the rate of 5%. If Indian company is making a payment of interest to foreign institutional investor, then 194 LD is deducting tax at 5%. Government could be paying, municipal authority could be paying interest on debt securities. TDS will be at the rate of 5%. When an Indian company is paying interest on foreign currency convertible bonds, foreign currency exchangeable bonds, global depository receipts. Global depository receipts will have dividend income. Just 1 second. So when 196C gets attracted, so on foreign currency convertible bond, foreign currency exchangeable bonds, there is interest. On global depository receipts, there will be dividend. The same section 196C is going to tell you that TDS will be done on dividend also, interest also at the rate of 10%. And foreign institutional investor gets interest income, but it's not covered by 194 LD, it's not covered by 194 LC, it's not covered by 194 LB. Then any other interest income that you are getting, tax will be deducted at source at the rate of 20%. Here the small amendment is that if by chance double taxation avoidance agreement is existing, India has a double taxation avoidance agreement with a foreign country and this FII is in that foreign country. Then if the FII is able to produce a tax residency certificate, TDS will be done at 20%, the rate given in the section, or the rate in DTAA, whichever is lower. So the rate in the section 20% or DTAA rate, whichever is lower, will be the rate applicable. This will apply. This amendment is saying that it is possible provided you are submitting a tax residency certificate of the country where you are, of the foreign country where you are a resident. Coming to dividend income, if it is dividend on mutual fund units that a non-resident is receiving, tax will be deducted at the rate of 20%. If the dividend is on global depository receipts, then tax will be deducted. We just mentioned it 2 minutes ago, 10%. If it is any other dividend, which is not covered by 196A, which is not mutual fund units, which is not GDR dividend, then TDS will be done at the rate of 20% as per section 195. When business trust is going to distribute to a non-resident unit holder. Earlier we saw business trust distributing income to resident unit holder, and there we saw TDS at the rate of 10%. Now we are thinking that the business trust is distributing income to a non-resident unit holder. Now, if the nature of income is interest income, distributed income of interest, TDS is at the rate of 5%. If you have just seen in the preceding page, we have always seen okay, on interest paid to non-residents, tax is deducted at 5%. 194 LB 5%, 194 LC 5%, 194 LD 5%. So generally speaking, when you pay interest to non-residents, TDS is at a lower rate, at a rate of 5%. Dividend 10%, rent 20%. So the same rates that are generally applicable for TDS are also applicable when a business trust is distributing income. If there is long-term capital gain that the business that is being earned, and that long-term capital gain is covered by 115 AB. So offshore fund is getting long-term capital gain. So 115 AB prescribes a tax rate of 10% and 196B prescribes a TDS rate of 10%. Foreign currency convertible bond, foreign currency exchangeable bond, global depository receipts. When they earn interest income, dividend income, tax rate is 10%, TDS is 10%. When they are sold and you get long term capital gain is taxed also at 10% and TDS is also at 10%. If the long term capital gain is not covered by 196B and 196C, then normal rates of TDS will apply, and those TDS rates are the same rate as tax rate. If your long term capital gain is covered by 112A, so 10%. If your long term capital gain is covered by 115C, NRI, non resident individual, then TDS is to be done at 10% because there the tax rate is 10%. If your long term capital gain is covered by 112, then 20% ka tax rate is there, so 20% ka TDS rate is also there. Now, 195 is basically saying the same thing. Any payment made to non-resident or a foreign company, 195 will apply. TDS will be done at the time of payment or credit, whichever is earlier. Finance Act 2021. Every budget gives you the tax rate. Just a simple theory, got to remember, nothing great here. TCS provisions. Now, TCS provisions. 206C subsection 1. Alcoholic liquor for human consumption, tendu leaves, timber, forest produce, any other forest produce, scrap or minerals. No threshold prescribed. Tax will be collected at source by the seller. For alcoholic liquor, sorry, for timber, it is 2.5%. For tendu leaves, it is 5%. For all other products, alcoholic liquor, scrap, minerals, it is 1%. Tax is collected at source by the seller from the buyer. If by chance the buyer, just 1 second. If by chance the buyer does not provide his permanent account number, tax will be collected at source at twice the original TCS rate or 5%, whichever is higher. This is section 206CC for not submitting permanent account number to the seller. If it's a transaction of lease, then the lessor will collect tax. Parking lot, toll plaza, mining, quarrying, these are the four assets covered. Tax will be collected at source at the rate of 2%. Again, no threshold prescribed. If it is sale of a motor vehicle, not just motor car, motor vehicle, so all type of vehicles are covered. Retail sales are covered here. So when the manufacturer sells it to the distributor, this section will not apply. When the distributor will sell it to the consumer, that is when it will apply. Sale consideration should exceed 10 lakh rupees. Then 1% of the entire sale consideration tax will be collected at source by the seller. The buyer will have to pay it. Whether the buyer purchases the motor vehicle for business purpose or for personal purpose does not matter. Whether the mode of payment is account, pay, check, prescribed modes or prohibited modes, cash, etc. does not matter. If the sale value is above 10 lakhs, tax will be collected at source. But then this sale consideration about 10 lakhs should be done on an individual basis. So if I am purchasing two motor cars from the same dealer and each motor car ka sale value is below 10 lakhs, but the total goes about 10, TCS will not be collected. One motor car exceeds 10 lakhs, the other motor car is below 10 lakhs, tax will be collected only on the sale proceeds of that motor car where it is about 10 lakhs. You will not do it on an aggregate basis, you will do it on an individual basis. These are all FAQs that the CBDT had come out with, which I was discussing with you. 206CC, sorry, 206CCA, the amendment identical to 206AB for non-filers of return of income. 206CCA. If you have not filed a return of income for the two preceding assessment years as per section 139(1) and the TDS plus TCS exceeds 50,000 rupees for each of those years, then because you are a non-filer, twice the original rate of TCS or 5%, whichever is higher, this is going to be the TCS rate under 206CCA. Keep your eyes on the screen. For not submitting permanent account number, it is the same formula. Twice the original TCS rate or 5%, whichever is higher. For not filing return of income for the preceding 2 years, the formula is the same. So yes, from a remembrance point of view, it becomes very simple. 206CC, not submitting permanent account number. CCA, not filing return of income. Twice the original rate or 5%, whichever is higher. When we will study something called as 206C1H, collecting tax at source on sale of certain goods. Here the provision is twice the original TCS rate or 1%, whichever is higher. This is the only small exception. Otherwise, it is twice the original rate or 5%, whichever is higher. So, generally speaking, remember, non-filing of return, CCA. Non-furnishing of permanent account number, 206CC. What is the TCS rate? Twice the original rate or 5%, whichever is higher. If tax is being collected at source under 206C1H and there is non-furnishing of permanent account number, twice the original rate or 1%, whichever is higher. Coming back to our discussion, if tax is being collected at source, we have seen 206C1, 1 C and 1F. Now coming to 1G, overseas remittance. If I am talking about overseas remittance, then there will be an authorized dealer who will remit the money on my behalf. Now, there is a threshold and there is TCS rate as per this table. Second thing covered is somebody selling me an overseas tour package. No threshold. A seller of overseas tour package will collect tax at the rate of 5% even if the amount is as small as 10,000 rupees. There is no limit prescribed. But if you are remitting money abroad, if you are sending money abroad, now TCS provisions will apply subject to some limits. If you are remitting money abroad and the amount does not exceed 7 lakhs, no TCS. If it exceeds 7 lakhs, so TCS will apply. But if you are remitting money abroad and that remittance is out of a loan for higher education obtained from a financial institution, then the TCS is 0.5%. For any other purpose, it is 5%. If you are remitting money abroad and that amount remitted is from a loan taken for higher education from a financial institution, then it is 0.5%. If you've taken a loan from friends and family, 5%. If you are sending your own savings for higher education, 5%. If you're sending money abroad but it's not for higher education, it is for making payment of goods, it is for gifting it to someone, it is for donation, it is for any other purpose, 5% ka TCS. If the amount to be remitted is exceeding 7 lakhs, only then this TCS concept will apply. Cases where tax is not to be collected. If the seller has already collected tax at source under some other subsection, then 1G will not apply. If the buyer has deducted tax at source, then there will be no tax collected at source. And of course, if there is central government, state government, foreign embassy, etc., they have excluded themselves from the TCS provision. 1H, TCS on sale of goods. Here we are talking of a situation where the seller has a turnover in the preceding financial year greater than 10 crore. This seller is selling to the buyer goods of a value greater than 50 lakhs. Then the seller is supposed to collect tax at 0.1% on the sale value in excess of 50 lakh rupees. Some time ago, this is 206C1H. Some time ago, we saw a provision, an amendment of the current year 194Q. Just 1 second. Yeah, must be here. In 194Q, buyer ka turnover in the preceding financial year should be greater than 10 crore. In the current section 206C1H, we are talking about seller ka turnover in the preceding financial year being greater than 10 crore. In both the sections, the rate is 0.1% on the excess amount. The sale value should be greater than 50 lakhs. If 194Q and 206C1H both are applicable, then you have to ensure that 194Q will prevail and not TCS. So when will each section apply? Seller, your turnover in the preceding financial year was about 10 crore. You are selling goods to the buyer above 50 lakhs. You will collect tax. Buyer, if your turnover in the preceding financial year was about 10 crore and you are buying goods value above 50 lakhs, you will deduct tax at 0.1%. But if both the provisions are simultaneously becoming applicable, then TDS will prevail, 194Q will prevail, 206C1H will not apply. Which goods are we covering here also? If it is covered by subsection 1, subsection 1F, 1G, then 1H will not apply. If goods are exported out of India, 1H does not apply. If goods are imported into India, 1H does not apply. Which means here the seller should be in India, the buyer should be in India. I'm talking about domestic sales. So 1H will apply. And by chance, if 1H and 194Q both are applicable, then you will do TDS under 194Q and 1 to TCS under 1H will not apply. So this brings us to the end of our TDS TCS revision. Now the next thing to pick up in agenda is residential status of the assessee. Then we'll go to transfer pricing, and lastly we will revise charitable trust. Okay, chalo. Let's go ahead and let's pick up residential status of an assessee. When it comes to residential status of an assessee, in your CA final exams, you get a question either on individual or on company. So we'll discuss those two provisions. You got to just focus on those two provisions. They are the most important ones. An individual is the resident of India if he is in India for 182 days or more for the current year, for the previous year. If that condition is not satisfied, then you check the condition given by 6.1 subclause number C, which is 60 days or more in the current year, and the total stay for the preceding 4 years should be minimum 365 days. If that condition is satisfied, 6 clause number 1 subclause number C, then the individual is a resident. If 6.1 subclause A, 6.1 subclause C both are not satisfied, then the individual will be treated as a non-resident. Now for 6.1 subclause number C, there are certain exceptions. For 6.1 subclause number C, there are certain exceptions. Okay? If you fall in this exception list, then only 6.1A has to be checked. You are an Indian citizen who leaves India for employment abroad. You are an Indian citizen who leaves India during the previous year as a crew member of an Indian ship. You are an Indian citizen or a person of Indian origin who is already outside India, who is already abroad, and who comes to India on a visit. Then 6.1 subclause number C is not applicable. Satisfy the condition of 182 days or more, then you are a resident. Otherwise, you are directly a non-resident. Now in 6.1, a new provision was inserted last year. If you are an Indian citizen or a person of Indian origin who is already abroad and who comes to India for a visit during the previous year, it's identical to this third point that we just read. But your total income, other than income from foreign sources, exceeds 50 lakhs. So your Indian income exceeds 50 lakh rupees, then you fall in a different category. So in this point number 3, we can write down okay, the Indian income of this person is up to 15 lakh rupees. If the income other than income from foreign sources exceeds 15 lakhs, so the condition of 182 days is still applicable for you. But then subclause number C is now modified. Subclause number C will apply, but it is modified by saying that the stay should be minimum 120 days. Instead of 60, it becomes 120. Total stay of 4 years should be minimum 365. That remains the way it is. So you satisfy 182 days wala condition, you are a resident. You don't satisfy that condition and your Indian income exceeds 15 lakhs, then you will check the modified condition. And if you satisfy the modified condition, you are a resident. Otherwise, you are a non-resident. Second amendment that was introduced last year was the concept of deemed residency. If you are an Indian citizen and your Indian income is exceeding 15 lakh rupees during the year, and you are not liable to pay tax in any other country, either because of your stay in that country, because of your residential status in that country, in any other country you're not liable to pay tax. But Indian citizen, your income other than foreign sources wala income exceeds 15 lakh rupees. Then as per the concept of deemed residency, you are deemed to be a resident of India. Deemed to be a resident of India. Then you don't need to check anything. 6.1 subclause A, 6.1 subclause C, modified 6.1 subclause C, nothing has to be checked. If you are an Indian citizen who is having Indian income above 15 lakh rupees and you are not paying tax anywhere else outside India, then you are deemed to be a resident of India. Once you decide somebody as a resident, you will have to decide further whether that person who is decided as a resident, who is that person? Is this person a resident and ordinarily resident, or resident but not ordinarily resident? For that, extra additional conditions are prescribed. First, you must be a resident in minimum 2 years out of the past 10 years. Second, your total stay over the past 7 years should be minimum 730 days. If both these additional conditions are satisfied, if both these conditions are satisfied, then you are a resident and ordinarily resident. If any one condition, additional number one or additional number two, is not satisfied, then you are a resident but not ordinarily resident. Somebody who is covered by the modified condition, the modified 61C, 120 days wala condition. If you become a resident as per modified 61 subclause number C, 120 days or more but less than 182, then you are a resident but not ordinarily resident. But if you become a resident as per 61 subclause number A, then you are a resident and ordinarily resident. Again, it implies that in this particular case, those two additional conditions that we studied about 7 years and 10 years, they are not applicable. They need not be checked. Somebody who is considered deemed to be a resident is deemed to be resident but not ordinarily resident. Those two additional conditions are not applicable. This is your residential status of an individual. Now coming to residential status of a company. An Indian company is always treated as a resident. If you are a foreign company and if your place of effective management is in India, then you are a resident. If your place of effective management is not in India, then you are a non-resident. Now, when you get questions in your exam, it is based on this POEM, place of effective management. A circular was announced, a circular was declared by the government in 2017. Based on that circular, you are going to determine the residential status of a foreign company. Firstly, the circular prescribes what is called as ABOI test. ABOI test means active business outside India. We have to check whether is the company having active business outside India or not. Remember, we are talking about a foreign company. A foreign company is a company which is going to be registered outside India. Check whether it is in active business outside India or not. What do you have to check? Condition 1. Passive income should be less than equal to 50% of total income. What is the meaning of passive income? Royalty, dividend, capital gains, interest income, rental income. And if you are purchasing goods and selling goods to your associated enterprise, so you purchase from one associated enterprise and sell to another associated enterprise, that is passive income. If the passive income is minimum 50%, is less than equal to 50% of total income, then you are satisfying the first condition. Condition 2, less than 50% of your total assets are situated in India, less than 50% of total employees are situated in India, and the payroll expenses on those employees are less than 50% of the total payroll expense. Everywhere the term is and. So you must be having passive income less than equal to 50%. Fixed assets in India should be, sorry, total assets in India should be less than equal to 50%. Total number of employees who are in India or who are residents of India should be less than 50%. On those employees, the payroll expenditure incurred should be less than 50% of the total payroll expense. If both these conditions are satisfied, then active business outside India test is satisfied. Then you will call this foreign company as having active business outside India. Now check. If the majority meetings of the board of directors are held outside India, it means the place of effective management is outside India. And if the place of effective management is outside India, then the company will be a non-resident. So ABOI test satisfied? Yes, the company is in active business outside India. Now, where are the majority meetings held? Majority meetings are held in India, then place of effective management is in India, and place of effective management is in India, it means the company is a resident. Majority meetings are held outside India, that means place of effective management is outside India, and therefore this foreign company will be a non-resident. By chance, if the ABOI test fails, by chance if ABOI test is not satisfied, active business outside India test is not satisfied, then the circular goes a step ahead and gives you guiding principles. Identify the persons who make the key management decision. Determine the place where these decisions are made. Now, what are these guiding principles? You have to identify who makes the key decisions and you have to identify where those decisions are made. If board of directors retains and exercises authority, the place where meetings are held will be the place where the POEM is. And if that place is in India, the resident, otherwise non-resident. Where the board has delegated the authority to senior managers and shareholders, etc., then the place where actually these authorities, senior managers, financial advisors, where they take the decision, that will be taken as the place where the effective management is. POM is where the actual decision making is done, where the authority is delegated to committees. So where does the committee develop and formulate all the strategy and decisions? That is a place where the effective management is. If modern technology is used, like online meetings are done, the place where majority directors or persons taking decisions usually stay, usually reside. If some decisions are taken by shareholders, management decisions are taken by shareholders, then find out the location where those decisions are taken. Other factors: where is the head office of the location, where is the head office, where is it located? That is a place where predominantly key decisions will be made. Where is the main activity of the company carried out? Where are accounting records kept? If you can find, because of all these guidelines simultaneously applying, that place of effective management is in India also and outside India also, majority directors are in India but head office is outside India, then it will be assumed that it will be the place of effective management is in India if it was mainly in India, predominantly in India. So it depends on the facts and circumstances of the cases. But the scenarios where place of effective management cannot be said to be in India, just because the foreign company is a wholly owned subsidiary of an Indian company, you can't say that the management is in India. Just because the foreign company has a permanent establishment in India, you cannot come to a direct conclusion that the management is in India. Some directors of a foreign company could be residing in India. That does not effectively give you a conclusion that the management is in India. Support functions are done, not main decision making, but after the decision is taken, the execution functions are done in India. That cannot mean that the place of effective management is in India. So these are wrong guidelines. You cannot come to a conclusion just because the foreign company is a 100% subsidiary, its main management is in India. No, you have to apply all the guidelines in the table that we just saw, and applying any one guideline is also not enough. You have to apply everything together and come to a harmonious conclusion. You cannot just pick up any one guideline and say if this happens then it is outside India, finished. No, other factors are also to be taken. Everything has to be considered together. So keywords that you'll have to remember is, when you decide, when you have to apply these guiding principles, where are meetings held, where are majority directors staying or residing, where is the committee taking decisions, where is the head office located, where are accounting records, all these words that I have circled and underlined, they need to be present in your answer if you are answering in a situation where ABOI test is not satisfied. If ABOI test is not satisfied, then these principles will apply. If ABOI test is satisfied, then the law is very simple. Majority meetings outside India, POEM is outside India. Majority meetings in India, the POEM is in India. Chalo. Now coming to transfer pricing, something that is a major component of your international taxation syllabus. For transfer pricing chapter to apply, the transaction should be done between two or more associated enterprises. How are the enterprises? How are the organizations associated enterprises? They are associated enterprises if minimum 26% is held by one party, or there is common control. Two organizations are controlled by a third person having minimum 26% in each of the two. Management control: more than half of the board of directors are appointed. Association A appoints more than half of B. One or more executive directors of B are appointed by A. More than half of A and B are appointed by C. Executive directors of A and B are appointed by C. So Common shareholding, common management control means the enterprises are associated enterprises. Business factors. Loan given by A to B is minimum 51% of the total value of assets of B. Then A and B are associated enterprises. This very frequently comes up in questions. A guarantees 10% or more of the borrowings taken by B from somebody else. A gives a guarantee. Then they are associated enterprises. B does some manufacturing, and the manufacturing depends on some patent, trademark, copyright, etc., which is owned by A, which the manufacturing is fully dependent on this patent, trademark given by A. So A and B are associated enterprises. B requires raw materials, and minimum 90% of the raw materials are supplied by A. Then A and B are associated enterprises. Goods that are manufactured by A are sold to B or persons specified by B, then A and B are associated enterprises. If one enterprise is controlled by individual, the other enterprise is controlled by relatives of that individual or that same individual. If one enterprise is controlled by HUF, then the other enterprise is also controlled by the HUF or the members of HUF. So all these are associated enterprises. This needs to be satisfied at any time during the year. You need not satisfy this for the entire year. If it gets satisfied at any time in the year, then you are deemed to be associated enterprises. Now the transaction between two or more associated enterprises will be international transaction. One of them or both are non-residents. If both the associated enterprises are non-resident, then the transaction should happen in India. Therefore, the income is accrued in India, and only then transfer pricing chapter will apply. For transfer pricing chapter to apply, the two enterprises should be associated enterprises and they should be doing international transactions. International transaction is always a transaction between two or more associated enterprises. Transaction can mean purchase of goods, sale of goods, purchase of fixed asset, sale of fixed asset, renting of fixed asset, giving loan, giving service, taking service. Any transaction which will impact your P&L account, your balance sheet, that is an international transaction. International transaction also covers a transaction where all the enterprises which are associated and which are involved in the transaction, they will share the cost, and the revenue that will be derived will also be shared. So there is contribution or sharing or allocation of cost, and then there is a share in the revenue also. Such a transaction is also called as an international transaction. Then the second type of transaction which has been defined as a deemed international transaction. Transaction is done between two unrelated parties. The two of them are not associated enterprises. They are unrelated to each other. But for this transaction that is happening between two unrelated parties, there is a prior transaction which has happened with one unrelated party doing a prior transaction with the associated enterprise of that other unrelated party. So X and Y are unrelated to each other, but X does a transaction with A, and A and Y are related to each other, are associated enterprise. Then it will be deemed that the transaction of X and Y is also an international transaction, and the transfer pricing chapter will apply. Transaction was done between P and Q, but but the terms and conditions of the transaction were decided by associated enterprise of Q. Then although P and Q are unrelated to each other, it will be deemed to be an international transaction, and the chapter of transfer pricing will apply. The chapter of transfer pricing is also applicable to specified domestic transactions. Specified domestic transactions means it's not an international transaction, it's a domestic transaction. But it's a domestic transaction where goods and services are transferred by one unit to another unit of the same assessee. One unit is a unit which is going to take chapter 6A part C deductions or 10AA deductions, and the other unit is a normal unit, and you are transferring goods from one unit to another unit of the same assessee. Then this is a domestic transaction. Second domestic transaction covered is one assessee is doing a transaction with another assessee who is a related party, and the assessee who is doing a transaction is covered by chapter 6A part C or 10AA deduction. Now this transaction is a domestic transaction. Any transaction that is covered by 115BAB subsection 6, 115BAB is a transaction where a domestic company gets a concessional tax rate. Domestic company gets a concessional tax rate of 15% from on its manufacturing profits. But if you try to do a transaction with your related party so that you earn more profits and they are taxed at a lower rate, then 115BAB subsection 6 highlights these transactions and says concessional rate will apply only to the market value wala profit. Extra profit will be taxable at 30%. Such a transaction is also called as a domestic transaction. If all these transactions put together have an aggregate transaction value, aggregate in totality, transaction value exceeding to 20 crores, then it is a specified domestic transaction. If it's a specified domestic transaction, the chapter of transfer pricing will apply. And if the chapter of transfer pricing will apply, arm's length price ka concept will apply. If all these transactions are done by the assessee and the transaction value is greater than 20 crores, they are specified domestic transactions, chapter of transfer pricing will apply, arm's length price will be used for all the calculations. But if the total value of these transactions is less than or equal to 20 crores, then they are not specified domestic transaction. Then the chapter of transfer pricing is not applicable. Then the concept of arm's length price will not apply. The concept applicable will be fair market value. The normal valuation methodology of fair market value will apply. So we've seen what are associated enterprises. We've seen what's an international transaction. We've seen what is a specified domestic transaction. Now comes our main charging section 92. Income from international transaction computed according to arm's length price. Expenses will be allowed as a deduction in an international transaction according to arm's length price. Income and expenses in specified domestic transaction will also be governed by arm's length price. Income taxable according to arm's length price. Expenses allowed as a deduction according to arm's length price. If there is contribution, apportionment, allocation of cost, and after that the revenue generated will also be shared, will also be contributed, will also be allocated, that allocation of revenue should also happen according to arm's length price. This section sorry, this section which tells you that incomes and expenses from international transactions, specified domestic transactions should be as per arm's length price. This section will not apply if after applying this section, profit reduces or loss increases as compared to what you've shown in books. Transfer pricing chapter is for the benefit of the assessee. If by applying transfer pricing chapter, if by applying arm's length price, your profit is reducing, arm's length price concept will not apply. Your loss is increasing, arm's length price will not apply. Your profit is increasing, yes, you have to apply arm's length price. Your loss is reducing, arm's length price concept will be applicable. Now, going ahead, how to compute arm's length price? 5 methods: comparable uncontrolled price method, resale price method, cost plus method, profit split method, transactional net margin method. 6th method, any other method that the assessing officer or the CBDT may derive depending on the nature of transaction, the complexity involved. Out of these 5 methods, and the 6th one, customized method if you can say, out of this 6 method, whichever method is the most appropriate method, that will be selected and arm's length price will be computed according to that method. When you compute arm's length price, you will compare it with the transaction price. And if need arises, you will do a TP adjustment. So if extra income is to be taxed because of arm's length price, you will add that income. If there is an extra expenditure being claimed as a deduction as compared to arm's length price, that extra expenditure will be disallowed. Now, a small margin given to us is find the arm's length price, find the transaction price. If the variation between them does not exceed 3% of transaction price, find arm's length price, find the transaction price. If the variation between them does not exceed 3% of the transaction price, is less than equal to 3% of transaction price, then transaction price is only assumed, deemed to be arm's length price, no TP adjustment to be made. For wholesale business, wholesale trading business, the margin is 1%. And for every other business or every other service provided, it is 3%. This 1%, 3% is the normal margin that is available. If the variation between arm's length price and the actual transaction price is more than this, more than 3%, more than 1%, so yes, arm's length price is different, transaction price is different, TP adjustment will have to be made. Section 92C, a section worth remembering because it will have references and mentions elsewhere also. Section 92C gives power to the assessing officer if he feels that the price charged in the transaction is not according to the arm's length price method, if the information or data used by the assessee in computing arm's length price is not the correct information, if documents and is not the correct arm's length price, if information and documents have not been kept by the assessee, or if they are kept by the assessee but the assessee has failed to submit them. Number one, the price charged or the price received or paid is not arm's length price. Number two, assessee has suo moto calculated arm's length price but not done it in the correct way. Number three, assessee has not maintained information and documents that he was required to maintain. Number four, he has maintained it but he is not submitting it within time limit. If any of these four things happen, 92C gives the power that during assessment, assessing officer can himself determine the arm's length price on the basis of the methods that we have. He will have to give an opportunity of being heard to the assessee by giving him a notice. According to this arm's length price that assessing officer has calculated, he will pass your assessment order, he will compute your total income. If your total income is increasing because of the assessing officer's order passed, and you are someone who is entitled to chapter 6A deduction for that income or 10AA deduction. I'll repeat. If assessing officer is computing your total income according to the arm's length price he has himself calculated, and your income is increasing, and you are entitled to chapter 6A part C deduction or 10AA deduction, then that increased income will not be eligible for the 10AA deduction or chapter 6A deduction. You'll have to pay tax on that amount of TP adjustment. You can't claim a deduction for it. Second, if one associated enterprise ka income is increasing because a certain expenditure is disallowed, then the other associated enterprise will not be able to claim that because the expense is disallowed for the payer enterprise, that amount should be exempt for the receiver enterprise and the TDS that has been done on that amount should be refunded. No. Transfer pricing provisions are for the benefit of the revenue, for the benefit of other department. If the payer associated enterprise has paid something in excess of arm's length price, deducted tax at source, and the excess paid has been disallowed, then that amount will not be claimed as exempt for the receiver associated enterprise. The TDS component, extra TDS, will not be refunded. This will not be permitted. During assessment, under section 92CA, the assessing officer has the power to make a reference to the transfer pricing officer. Transfer pricing officer means he's a joint commissioner, he's a deputy commissioner, or an assistant commissioner, which means even a transfer pricing officer is an income tax authority under section 116. During assessment proceedings, assessing officer can use the power that we just studied in 92C to himself determine the arm's length price. Option 1. Option 2, during assessment, he has the power that he can refer these international transactions to the TPO. And he will tell the TPO, you give me an arm's length price. You pass an order and tell me the arm's length price of this transaction. Which transactions can be referred? International transactions can be given to the TPO. Specified domestic transaction will be given to the TPO. TPO will send a notice to the assessee asking the assessee if he wants to provide any evidence. Opportunity of being heard will be given to the assessee. TPO, after considering the entire international transaction, specified domestic transaction, after considering all the evidence, after making all inquiries, TPO will pass an order, and that order passed by the TPO, one copy will be sent to the assessing officer, one copy will be sent to the assessee. In that order of course has to be in writing, he will determine the arm's length price. Suppose there was an international transaction which AO had not referred to the TPO, but TPO himself is noticing it, is observing it. he can compute the arm's length price of that transaction also as if it was referred by TPO. If there is an international transaction with the assessee did not report, assessee did not disclose it, therefore AO did not refer it, but TPO found it, then it will be deemed okay, by TPO you are going to give us the arm's length price as if the AO had referred this transaction also to you. Order has to be passed by the TPO. One copy will go to the assessee, one copy will go to the assessing officer. Such order has to be passed at any time before 60 days prior to the time limit of completion of assessment. So, first of all, whatever is the time limit available to the assessing officer, whatever is the time limit available to the assessing officer for completing the assessment, the moment he makes a reference to the transfer pricing officer, this normal time limit will have a 12 months extension. This is because we are making a reference to TPO. So this can be understood as the new time limit. This is the new time limit for the assessing officer. Now you go reverse and subtract 60 days. And now whatever date you get, this is the last date for the transfer pricing officer to pass his order. So the intention of the act is okay, by the assessing officer should have minimum 60 days after receiving the TPO's order so that he can finalize his own assessment order. As an assessing officer, if you are making a reference to the TPO, you have to pass your assessment order in conformity with the TPO's order. The TPO is also an income tax authority. So if there is a mistake in the TPO's order, TPO has the power to rectify that mistake under section 154 and pass a rectification order. AO is supposed to pass an order in conformity with TPO's order. Now, if TPO is passing a rectification order, he is rectifying his own order. Naturally, the assessing officer will also have to rectify his own assessment order based on the rectified order of the TPO. If a reference is made by the assessing officer to the TPO, you get a normal 12 months extension. But by chance, if dispute resolution panel DRP gets involved, if the TPO tells the AO to make certain variations in the income which are prejudicial to the assessee, then DRP ka provision will get attracted 144C. I'm sorry. If DRP provisions get attracted, then the time limit for the assessing officer to pass the order will not be this time limit that we just studied. It will be as per 144C. Whatever 144C says, within 1 month from end of the month in which DRP gives its directions, AO has to pass the order. He will not follow these time limits of extension of 12 months. Reference made to TPO can also result into increase in income. That income is also not eligible for any chapter 6A deduction or 10AA deduction. So any increase made by the assessing officer or by the TPO is not entitled to any income based deduction even if you are doing that particular business. Now moving ahead, there are 5 methods of determining arm's length price. Comparable uncontrolled price method. Find the price charged in a comparable transaction and an uncontrolled transaction between two unrelated parties. Make all the adjustments that you have to make, called as functional differences. Adjustments which are necessary to be made, like to your associated enterprise you will give a discount naturally, so the price will reduce. You might give an extra credit period, so that credit period will result into an increase in price. You might provide warranty to your associated enterprise, so warranty cost will increase. The simple trick is, whenever you are solving an arm's length price wala question, start with the transaction which is an uncontrolled transaction. So start with the price at which the uncontrolled transaction happened, and then you go to the price at which our international transaction has happened. And international transaction is a controlled one. And these adjustments that you will make, these are your functional differences. Giving a discount to your associated enterprise, not giving a discount to your associated enterprise, giving warranty benefit to your associated enterprise vis-a-vis strangers, giving extra credit period, all these are functional differences. Now this price that you will get is your arm's length price, which will have to be compared with the transaction price. So find a comparable price in an uncontrolled transaction, make all the differences, make all the adjustments, get your arm's length price. Resale price method. Resale price method means you are purchasing from an associated enterprise and you are selling it to a third party. Now, find out if you had purchased from a stranger and sold to a stranger, what would have been the profit margin, GP margin that you would have earned by doing this resale? In your transaction of associated enterprise, that GP margin has to be kept constant. You are purchasing goods from associated enterprise and reselling it to a stranger. On that resale, the profit that you would have normally earned in a normal transaction, keep the profit same and try to work in a reverse direction, that if we had to earn this profit, at what price should we have purchased these products from our associated enterprise? That associated enterprise ka purchase price will be your balancing figure. In the resale price method, profit is considered constant and the reverse working is done. Purchase price is found as a balancing figure. Whereas in cost plus method, that's the third method, what you do is you will make adjustments to the markup. Find out the cost, direct cost and indirect cost of the services or the property, the product that you are selling or giving to your associated enterprise. Find the cost. Now you will add a certain markup to this. A markup is on the base of that cost. Now that markup will be the normal markup that you would charge to a stranger, adjusted for functional differences. In resale price method, this profit percentage was constant and we were finding the cost price as a balancing figure. In cost plus method, we are saying cost price is actual and we are going to make adjustments to the markup. Using the adjusted markup, apply that adjusted markup on cost, find out the invoice price. That is your invoice price at arm's length. And that is what you should have charged to your associated enterprise when you gave those services. Compare it with the transaction price and then decide whether TP adjustment is to be made or not. Profit split method. When multiple associated enterprises are together, they contribute to the cost. Costs are being shared, costs are being allocated. Then in the ratio in which the costs are being shared, in the ratio of who performs which functions, in the ratio of who uses how much assets, in the ratio of who takes that much risks, the revenue also should be shared in the same proportion of costs. More functions performed, more cost will be incurred. More assets used for the transaction, more cost will be incurred by that associated enterprise. More risks taken, that means more cost is being taken up. So in proportion to cost, revenue should also be allocated. Profit should be split according to that cost wala ratio, revenue wala ratio, and that should be your arm's length price. If you are showing any different profit, then TP adjustment may be needed. The last method, which is used a lot in the practical world, transactional net margin method. In cup, the first method, cup method, comparable uncontrolled price, resale price, cost plus method, it will be most of the times practically very difficult to find a exact identical transaction. So you will not be able to find a comparable transaction. So you find the profit margin on an overall basis. Find a person in the same industry in which you are and find out how much margin are they earning on an overall basis. That margin can be expressed as a percentage of turnover. That margin can be expressed as a percentage of cost. But this margin is not expressed as a percentage of turnover or as a percentage of cost on the basis of individual transactions. it is expressed as a margin on the basis of the entire P&L account, on the basis of the entire transactions taken up throughout the year. Find out the profit margin that a competitor, a comparable enterprise in your sector is earning. That profit margin will then be adjusted, keeping in mind functional differences, and that according to that adjusted profit margin you will find your arm's length price. Transactional net margin method avoids the defects or shortcomings of the previous methods. The main shortcoming is that you need to find an absolutely identical comparable transaction, resale price method transaction, cost plus transaction. You may not be able to always find it. So you do it not on the basis of a singular transaction, you do it on the basis of overall the entire transactions, all transactions done during the year. These are your 5 methods for computing arm's length price. Chalo, now going ahead in the chapter of transfer pricing, advance pricing agreement. Advance pricing agreement. Agreement between CBDT and the assessee. This agreement is for pricing. So this agreement is to decide what method of arm's length price computation will be used, and it is entered into in advance. So advance pricing agreement is for future transactions. If CBDT and the assessee sign an advance pricing agreement, then for all the transactions, international transactions only, not specified domestic transactions, for all the international transactions that this assessee is going to do in future with a particular associated enterprise, it will be decided today between CBDT and assessee that this particular method will apply. It will be transactional net margin method, it will be comparable uncontrolled price method. The method to determine the arm's length price is decided in advance. It's an agreement. So it is binding on the assessee, binding on the department also. Which means if the assessee has signed an advance pricing agreement, assessing officer cannot use his own power of calculating arm's length price under section 92C. Assessing officer cannot refer the transaction to a transfer pricing officer under section 92CA. 92C and 92CA, both these sections will become inapplicable for that international transaction for which this agreement is there. Then whatever is the method decided in the agreement, that method has to be followed by the department also and by the assessee also. It is not compulsory that you sign the advance pricing agreement for all the international transactions. You may choose to sign an advance pricing agreement for one international transaction, one type of international transaction with one associated enterprise, but not with the other. If you do not have an advance pricing agreement for an international transaction, then 92C and 92CA will apply. For specified domestic transactions, 92C and 92CA will apply. If advance pricing agreement is there for a particular type of international transaction, then those two sections will not apply. The concept of advance pricing agreement can also be used to decide if a non-resident is earning income from a business connection in India. How much income is attributable to Indian operations? That will be a point of dispute between the assessee and the assessing officer. So to avoid that dispute, assessee can enter into an advance pricing agreement, and the manner of calculating how much profit, how much income is attributed to Indian operations, that can be decided in the advance pricing agreement. That can be decided in the advance pricing agreement. Advance pricing agreement is entered into for a maximum period of 5 years. It is binding on the assessee, it is binding on the department. Department meaning commissioner and assessing officer. If this assessee who has signed the advance pricing agreement subsequently goes for amalgamation, then the advance pricing agreement will not apply to the amalgamated company. If there is a change in transfer pricing law, then the advance pricing agreement will no longer be applicable. If the facts have changed, the facts on the basis of which the agreement was signed, if they undergo a change, obviously advance pricing agreement henceforth will not apply. If it is observed that the assessee has done some manipulation, some misrepresentation, some fraud and got the agreement signed, then the agreement will be declared void ab initio from the beginning. All other provisions of the act will apply. All time limits available will be extended. Time limits for issuing notice, time limits for passing order, all of that will be extended. The agreement will be declared void ab initio, and all other transfer pricing provisions will be applicable. The intention of advance pricing agreement is pretty obvious: to reduce dispute, reduce litigation. So there is a concept called as rollback. Advance pricing agreement can be signed for the past 4 years also. If agreement is beginning from year 1 to year 3, year 4, year 5, these are the future years. Going reverse prior to year 1, the preceding 4 years, you can make the advance pricing agreement applicable for the rollback period also. If you want to do this, the biggest advantage that the assessee will get is pending disputes will automatically get resolved because the agreement will prevail. You have to make an application for rollback. Rollback will be applicable for all 4 years. You cannot choose any 1 year or 2 years or 3 years out of 4. Rollback will be applicable for all 4 years. The international transaction for which you have entered into an agreement for the future period, that international transaction, a similar type of international transaction, should have already been undertaken in the rollback period. Only then the rollback will apply. Rollback is applicable for 4 years. In those 4 years, those past 4 years, those international transactions for which you want to apply the rollback provisions, for which you want to apply the advance pricing agreement, they should be of the same nature, they should be with the same associated enterprise as it is for the future period for which we have actually originally signed the agreement. In the past 4 years, if in any 1 year such similar type of international transaction did not happen, then for that year the agreement will not apply, it will apply for the balance years. If for the rollback period, income tax appellate tribunal has already passed an order already has been passed, appeal is finished, decided, then for that particular year advance pricing agreement will not apply. If an appeal has been filed by the assessee for any particular year falling in the rollback, then assessee, when he wants the rollback to apply, he has to withdraw that appeal. That appeal has to be withdrawn to the extent of this transfer pricing arm's length price wala ground. The appeal can continue, but this ground of appeal will have to be withdrawn by the assessee. Even the other way around is correct. If the department has filed an appeal and that appeal is pending, the moment rollback applies, department will withdraw that ground of appeal. The appeal will continue on the balance grounds. If after applying the rollback, the taxable income is reducing lower, going below the income declared in the return of income, so the return of income wala amount will be taxable. If after applying the agreement in the rollback period, your amount taxable is reducing below what you have declared in the return, then your income taxable will be the amount that you have shown in the return of income. If the appeal is pending, then rollback will apply. If the appeal already has been decided and an order has been passed, rollback will not apply. Moment you sign an advance pricing agreement, for any particular year, if you have already filed a return of income and that year is covered by the agreement and you have already filed the return, you will file a modified return. The time limit to file the modified return is 3 months from end of the month in which the agreement was signed. Now for that particular past year, if assessment was already completed, the assessing officer will modify his assessment order. And if the assessment is pending, whatever is the original time limit, he will get an extension of 12 months. So once an agreement is signed and if the year is covered by the agreement, but the return of income for that year already has been filed, assessee will file a modified return for that particular year. He has a time limit of 3 months. Now comes the AO's job. That past year for which we are currently discussing, if assessment is already completed, based on the modified return, there will be a modified assessment order. If assessment is going on, then whatever assessment is going on will now be carried forward, will now be carried on considering the modified return. And there will be an extension of 12 months if it is pending, and if it is already completed, you will get a 12 months period to modify your assessment order. Chalo. Now coming to other provisions of transfer pricing. 94B, always ensure you study this and go. You can have a 4-mark question based on this. In the past, quite a few times it has come up. Quite a few times, even in your MCQ booklet, you will find 2-3 case scenario individual MCQs based on this. If 94B applies, it overrides the entire Income Tax Act. The borrower has to be number one, an Indian company, or number two, permanent establishment of a foreign company in India. The lender has to be non-resident and has to be associated enterprise of the borrower. Interest expenditure is incurred exceeding 1 crore, and that interest is allowed as a deduction under the head PGBP. Then under 94B, for the borrower, excess interest will be disallowed. What is the calculation of excess interest? Find out the interest that you are paying to the associated enterprise, say A rupees. Then take that A rupees and compare it with 30% of earnings before interest, tax, depreciation, amortization. Out of the two, whichever is lower, A or B, whichever is lower, will be taken up. It will be subtracted from the interest. If you have any amount remaining, this is your excess interest which will be disallowed. The impact of this formula is very simple. It is drafted in a complicated way, but the impact of this formula is that 30% of earnings before interest, tax, depreciation, amortization is the maximum limit. Interest up to 30% will be allowed as a deduction, and interest which is in excess of this 30%, this is the excess interest which will be disallowed under section 94B. But the act understands you are the borrower, you have borrowed from a non-resident associated enterprise, and a certain amount is being disallowed. That disallowed amount will be carried forward for 8 years. And in the next 8 years, this disallowed amount will be allowed as a deduction. But whenever that disallowed amount is allowed as a deduction in the future years, you have to ensure that 94B gets satisfied in the future year also. So in the future year ka interest plus a part of this excess interest will be allowed, but it cannot exceed 30% of EBI TDA of that future year. The simple logic of 94B is 30% is the cap put. 30% is the maximum cap that has been put. 30% of earnings before interest, tax, depreciation, amortization is the interest allowed as a deduction to you. If your interest is up to that limit, take a full deduction. It exceeds, disallow that. Carry forward it for the next 8 years. In the next 8 years, you can take a deduction of that disallowed amount. But in the future year, 94B still should get satisfied. Remember that this section is applicable only if the borrower and the lender satisfy certain criteria. So, if the lender is not an associated enterprise of the borrower, this point is a separate point. This is indirect version. Lender is not an associated enterprise of the borrower, but the associated enterprise of the borrower gives money to the lender and the lender then passes it on to the borrower. Or associated enterprise gives a guarantee to the lender and then the lender gives a loan to the borrower. So on a deemed basis, 94B will apply. So this is the indirect version which people can use to break the applicability of 94B. 94B has taken care of that also. 94B shall not apply if Lender and borrower are not associated enterprises, pretty obvious. Loan is for any purpose other than PGBP. Interest does not exceed 1 crore. If borrower is into business of banking insurance, then it's a normal business transaction of taking loan. 94B will not apply. If lender is in the business of banking, permanent establishment in India, and in the business of banking, then also 94B will not be applicable because it's a normal course. If 94B does not apply, then this overriding entire Income Tax Act wala clause also does not apply. Now, if 94B does not apply, but you come to the conclusion that the lender and borrower are associated enterprises, but 94B is not applicable, then your normal concepts of arm's length price, section 92, all those sections will apply. If 94B is not applicable, 92 will apply. Normal arm's length price ka working will apply, provided the lender and borrower are associated enterprises as per section 92A. So 94B check karo. If 94B is applicable, that's it. If 94B is not applicable, then apply section 92, apply section 92C, apply section 92CA. That means go to the concept of arm's length price. Next section. Special measures in respect of transactions with persons located in notified jurisdictional area. A territory called as Cyprus used to be a notified jurisdictional area. Today, practically, there is no area as a notified jurisdictional area. NJA means, in simple terms, a blacklisted area, a blacklisted country by the government of India. These are the territories and countries which do not share information with the government. So, if you do a transaction with a person located in NJA, the whole intention is to convert your black money into white money. And so, government has created a very, very, very harsh and a very strict provision. If you do a transaction with a person in NJA, that person is deemed to be your associated enterprise. Transaction is deemed to be an international transaction. Arm's length price concept will apply. You will not, you will not get the margin of 3% or 1% that we discussed some time ago. You will have to maintain documents and information which obviously you would not have maintained. So the concept of penalty will apply. This transaction would not have been reported in your international transaction transfer pricing report because it is deemed to be an international transaction as per the section. You are not considering it as an international transaction. So you would not have reported this. So non-reporting of international transaction, that means there will be a penalty. Transaction should be done at arm's length price. Any amount which is not as per arm's length price will result into a TP adjustment. The margin of 3% or 1% will not be applicable. If you are receiving some amount, share capital, debenture money, loan money, share premium, and you cannot, in India, you cannot justify to the tax authorities the source of that person located in NJA, then that amount will be deemed to be your income. Much similar to the cash credit section that we saw, section number 68. So, if you are receiving any income or any capital amount, if you cannot explain the source of that person located in NJA, the amount that you are receiving, even if it is share capital, loan received, debentures, etc., it will be treated as your income. When you are paying interest to them, then that interest will be allowed as a deduction only if you give an authorization to CBDT that when they will ask for information, they will seek relevant information, the person in that NJA will give that information. Such an authorization will not be possible only to give, and therefore the interest will not be allowed as a deduction. Similarly, depreciation and expenses incurred, various expenses incurred by me in India by doing a transaction with an NJA person will not be allowed as a deduction to me unless and until I maintain documents and information as prescribed. But I am doing a transaction with that person in NJA to convert my black money into white. So I will not maintain those information and documents. Automatically, the expenses will not be allowed as deduction. And the last harsh provision is if you do a transaction with a person in NJA and the chapter of TDS is applicable, then the rate given in the TDS chapter or 30%, whichever is higher of the two, will be the amount of tax that I will have to deduct at source. So quickly going through it, if you do a transaction with a person in NJA, it is deemed to be an international transaction with an associated enterprise. Arm's length price will apply. Transfer pricing chapter will apply. All penalties relating to transfer pricing chapter will become applicable to you. No margin of 3% or 1% will be available to you. Expenses will be allowed as a deduction to you only if you give authorization to CBDT asking for information, only if you maintain books and documents. Amounts received, even if they are capital in nature, will be treated as your taxable income if you cannot explain the source of this amount in the hands of that NJA person, or if you are explaining it, the explanation is not satisfactory. And TDS will be done at the rate applicable or 30%, whichever is higher. Chalo, going ahead. Secondary adjustment, primary adjustment. If there is a transfer pricing adjustment that is happening because of the arm's length price concept, then your taxable income is increasing either by disallowing the expense or by increasing the taxable income. If that is done in your return of income, or that is done in your taxation. Taxation would be an accurate word. 92 CE is expecting you to make a secondary adjustment. What is the meaning of secondary adjustment? In your books of account, you will disallow the expense or you will show the income, and the debit effect will be a deemed loan or deemed advance to that associated enterprise. So if an expenditure transaction has been incurred, if an expenditure transaction has happened, then whatever has been disallowed, that expense will be credited and the debit will be loan given to associated enterprise. It will be deemed to be a loan. If you have done an income transaction, you have received income, but you received lesser, then the income which was added into your calculation, that will be recognized as income to sales to income, and the debit effect will be loan to associated enterprise. The section is expecting that the assessee should repatriate this money, this difference, this is excess money. This entry that you are passing is for that excess money, transaction price minus the arm's length price. This excess money should be repatriated into India, should be brought into India within 90 days. If you don't bring it into India, whatever excess money is not repatriated into India, on that interest, implied interest, deemed interest income will be calculated. It is deemed that you have given a loan to your associated enterprise, and so you will receive interest. Interest income will become taxable on a implied imaginary notional basis. If your transaction is in rupee, if the invoice is raised in rupee, then take the State Bank of India 1st April ka 1 year marginal cost of lending rate, add 3.25%. This is the interest rate. If the transaction was in foreign currency, then take the London interbank offered rate, LIBOR rate of 30th September, and add 3%. This will be your interest rate. So if you bring the money, if you repatriate the money into India within 90 days, no problem. Whatever amount you could not repatriate, on that amount you will calculate interest. And that interest will be taken as your deemed income, implied income, and you'll have to pay tax on it. Then, how do you count the 90 days? This is how you count the 90 days. If the TP adjustment, the transfer pricing adjustment is made suo motu by the assessee, is made due to an advance pricing agreement, and you are filing the return later on. You are first signing the advance pricing agreement, and later on you are filing the return of income. Then 90 days from the due date of filing return of income under 139(1), you have to bring the money into India within 90 days. If the assessee has exercised the safe harbor rules, safe harbor rules have not been notified by the CBDT for our current assessment year. So from an examination perspective, if you have time, go through safe harbor. If not, you can skip it off. Chances are very less that safe harbor will get tested. If you have time, whatever safe harbor rules you have seen printed in our book, you can refer to them. You can just go through them once. But if you seriously are facing a crunch of time, you can ignore safe harbor rules because they have not been notified by the CBDT only for assessment year 22-23. If TP adjustment is made suo motu by the assessee, if TP adjustment is made according to safe harbor rules, if transfer pricing adjustment is made according to advance pricing agreement, and the agreement was signed first, and now later on we are filing the return, 90 days from the due date of filing return. Acha, if the transfer pricing adjustment was made due to advance pricing agreement, but APA is signed later and return already has been filed in the past, then 90 days from the end of the month in which the APA was signed. From the end of the month in which APA is signed, you will have to file a modified return. That period is 3 months. And roughly speaking, this is also the same 90 days ka period, roughly 3 months. You have to repatriate that money into India. If the TP adjustment was made by the assessing officer and accepted by the assessee, I did not file an appeal. 90 days from the assessing officer's date of order. But if AO made the TP adjustment, I filed an appeal, I lost the appeal. Then ITAT gave a judgment in favor of assessing officer. From the date of order of ITAT, within 90 days, I have to bring the money into India. Whatever amount I cannot repatriate into India, the excess money which is not repatriated into India, on that interest will be calculated. We saw LIBOR rate plus 3% or SBI rate plus 3.5%. This interest will begin from due date of filing return, or from the date of the AO's order, or from the date of the appellate authority's order, or from the date in which that advance pricing agreement is signed. If your TP adjustment is because of a DTAA mutual agreement procedure, then assessing officer will be told to give effect to that by passing an order. And whenever the AO gives an order, AO gives effect by passing an order, 90 days from that day, you get to repatriate the money. Otherwise, interest will start from that particular period. You got to understand one common thing, that when you will calculate interest will be computed for those 90 days also. Interest does not start from the 91st day. If you do not repatriate the money into India, interest will be calculated on that deemed loan even for these 90 days as well, up to the end of the financial year for which you are calculating the interest. Option 2, if you have to repatriate the excess money into India. Option 1, bring the money into India within 90 days. Okay. Option 2, bring the money into India within 90 days from any associated enterprise who is a non-resident. Not necessarily the same associated enterprise with whom you did a transaction. So government is saying we want the funds to come into India, whether you get it from the same associated enterprise or some other associated enterprise who is a non-resident, then it is your internal group matter to settle the differences. Who is paying, from whom it is payable, and from to whom it is receivable, that is not government of India's problem. Option 1, bring the money into India from the same associated enterprise with whom you did the international transaction. Option 2, get it from any other associated enterprise. Option 3, if you cannot get the money into India, interest is being calculated, no? So option 3 says you pay additional tax. Additional tax at the rate of 18%, mandatory surcharge of 12%, health education cess of 4%. So 20.9664 ka additional tax you will pay. If you pay that additional tax, no further interest will be calculated. Remember that whatever interest income, imaginary interest income that already has been calculated, already has become taxable, that will remain taxable. You will not get any income tax refund. This additional tax that you are paying, as the name is suggesting, it's an additional tax. So on your current year's income, you will pay income tax and you will pay this extra tax. And you cannot take this extra tax as a credit like you take TDS ka credit. This is an additional burden on the assessee. The deemed loan entry that you had passed, after you pay this additional tax, that loan is no longer needed. You need not bring the money into India, but you cannot write off that amount into P&L as a advance written off or loan written off. You will not get a deduction of it. So you will not be required to make secondary adjustment. You can write off that loan account. Not required to compute interest. This tax shall be the final tax payment. No credit will be allowed. The tax cannot be taken as a revenue expenditure also. The deemed advance which you will write off will also cannot be claimed as a revenue expenditure. So this brings us to the end of our transfer pricing provisions. Chalo. Now going ahead, we'll pick up the amendment of income escaping assessment. Income escaping assessment has undergone a fundamental change. Sections have been rewritten. 147, 148, 149 have all been redrafted. A new section of 148A has been introduced. So you can easily expect a question based on this income escaping assessment because of the nature of the amendment. Any income chargeable to tax which has escaped assessment, the assessing officer has the power to assess the income, reassess the income, recalculate the loss, recalculate depreciation, recalculate any other deduction. He has to follow the procedure given by section 148 to section number 153. But any income chargeable to tax, if it has escaped assessment, he can reopen the case. This is also popularly called as reopening. He can do assessment under this section. In the entire section, you will never find anything written which says an order has to be passed. So this section is a mechanism section. It is one of the methods of doing assessment, but order will be passed under 143.3 regular assessment. So the order will be 143.3 read with 147. If the assessee does not cooperate, the order will be 144 read with 147. 147, this income escaping assessment only gives powers to the assessing officer. Procedure is still regular assessment or best judgment assessment. To do income escaping assessment, you have to follow the process given by, you have to follow the procedural aspects of section 148 to 153. In the course of this, if you discover any other income, subsequently you discover any other income which has escaped assessment, then assessing officer has the power to tax that other income also in the same set of proceedings. In the old section, there was a concept of reason to believe. That concept is gone. Income, if it is chargeable to tax and escapes assessment, then this section can be used. There was a doctrine of partial merger which used to exist in the old section 147. If a certain part of the assessing officer's order is in appeal, then the assessing officer cannot do income escaping assessment for that particular issue, for that particular matter. He can do income escaping assessment for any other income which is not in appeal, which has not been raised in any appeal authority, in any appeal proceedings. The new section does not mention anything about doctrine of partial merger, but it is common sense to think a doctrine of partial merger will be applicable to the new section also. The procedure. This is a completely new provision introduced. This was not there in the old section. There was a Supreme Court judgment, GKN drive shafts, which prescribed a procedure that the assessing officer had to follow. Now that judgment has been put up slightly in detail in the form of a section. Before the assessing officer gives a notice under section 148, he has to conduct inquiry. Is this a fit case? Do we have information which suggests, the words written in bold and italics, do we have information which suggests that income chargeable to tax has escaped assessment? Conduct inquiry for that. Give a show cause notice under 148A to the assessee. Minimum time 7 days, maximum time 30 days. The show cause notice is the assessee has to give a reason, assessee has to show a reason why section 148 ka main notice should not be issued to him. If the assessee gives a reply, then the assessing officer has to consider the reply and then pass an order under 148A. In that order, the assessing officer will decide, is this a fit case for doing income escaping assessment? Is it a fit case for issuing notice under section 148? This order shall be passed after considering the results of the inquiry that he has, after gathering all evidence, after getting the reply from the assessee. As this order has to be passed within 1 month. If the assessee has responded to the show cause notice within 1 month from end of the month in which response is received. If the assessee has not responded, then the month in which his time limit is expiring, within 1 month from the end of that month, AO has to pass the order. This is an order to decide whether income escaping assessment should start or not. If he comes to the conclusion that yes, this is a case of income escaping assessment, he will give you a notice under 148. He will ask you to file a return of income. He will also give you a copy of the order under 148A that he has passed. He will ask you to submit a return of income within a specified time. That return is as good as a return filed under section 139. You will have to follow the due dates properly. You will have to follow the time limit properly basically. If you make a delay in filing this return, then you will have to pay interest also, as you pay interest in case of belated return. For issuing a notice under 148 for starting income escaping assessment, two conditions have to be satisfied. First, there is information with the assessing officer which suggests that income chargeable to tax has escaped assessment. For writing your theory answers, please memorize this term. Information with assessing officer which suggests that income chargeable to tax has escaped assessment. This is used in section number 148. This is used in section number 148A also. To write your theory answers, you will require this set of words. Condition number 1, the AO should have this information. Condition number 2, he should take prior approval of the specified authority. Specified authority means Commissioner of Income Tax, Director of Income Tax. After he gets the approval, he can issue a notice under section 148 and inform the assessee that I am starting income escaping assessment, you give me a return of income. What is the meaning of this term? Information with the assessee that income chargeable to tax has escaped assessment. One, any information flagged. They have a software which they call as Insight. This software has certain criteria to that it has decided, according to which the particular case, the particular assessee will be flagged, will get popped up. And if the assessing officer gets that flagging, gets that pop-up, it means, according to the software, the case has been selected. This means that the AO has information which suggests that income has escaped assessment. Number 2, any final objection raised by Comptroller and Auditor General of India. In the past, audit objections raised by internal audit team of CBDT have been used to reopen the cases, and courts have held that such a reopening is bad in law because it is a change of opinion. I repeat this. I feel this might come as a theory question, so please understand what I'm speaking. In the past, the internal audit team of CBDT would raise certain audit objections on the assessments done by AO. On that basis, the assessing officer would, on the basis of those objections, the assessing officer would do income escaping assessment. It would get challenged in the court, and the courts would say, this is a change of opinion by the assessing officer. This assessment is bad in law. So that was an established thing. That was an established thing. In the amendment, final objection raised by Comptroller and Auditor General is considered as information which suggests that income chargeable to tax has escaped assessment. Now it's not talking about the internal audit team of CBDT. Objection raised by internal audit team of CBDT is not what we are saying. The CAG of India, Comptroller and Auditor General of India, if they raise a final objection, then that is information with the AO that income has escaped assessment. Then the AO will do 148A ka procedure and then issue a notice under 148. So if you get a theory question, audit objection was raised by the internal audit team. Can income escaping assessment be done? Your answer will have two things. Number one, if this audit objection becomes the final objection raised by CAG, then yes, section 147 can be done. But only on the basis of this audit objection raised by the internal audit team, 147 cannot be done. Remember this thing. If my guess is correct and if you get this in the paper, then you'll be able to answer this theoretically. Explanation 2 to section 147. Again, something important worth remembering. One of the major change that has happened because of this amendment is, if you were covered by raid cases, if you were covered by search and seizure, and the search and seizure happened up to 31st March 2021, then its assessment was done under section 153A. If the search and seizure happens on or after 1st April 2021, then 153A is no longer applicable. Assessment will be done under section 147. So today there are only three types of assessments: regular assessment, best judgment assessment, and 147. If a search is conducted, if books and documents and assets are requisitioned from some other government authority by this income tax officer, if a survey is conducted, if search is conducted for Mr. A and assets belonging to Mr. B are found, if books and documents belonging to Mr. B are found, then it shall be deemed that assessing officer has this information which suggests that income chargeable to tax has escaped assessment, and it shall be deemed that he has this information for three preceding assessment years. So if search happens, survey happens, books and documents are books, documents, assets are requisitioned, books, documents and assets are found at somebody else's place, then it will be assumed two things. One, AO has information that income chargeable to tax has escaped assessment. Two, this is information for three preceding assessment years. So, search conducted, yes, for 3 years, notice will be issued, but then the 148A procedure is not needed to be followed. In case of search, you don't need to give any show cause notice, opportunity of being heard. This guy has undisclosed income, you can directly do assessment, don't need to follow 148A ka process. If survey is conducted, assessment will still be done for past 3 years, but 148A ka process will have to be followed. You cannot skip that process. If a TDS TCS survey is conducted, then you can do income escaping assessment, but only for that relevant year and not for the past 3 years. And the relevant year for which TDS TCS survey is done. And of course, 148A will have to be followed. If assets, books, and documents are found in somebody else's search, three preceding assessment years will be covered, 148A need not be followed. If, let's say, there has been a raid from GST department and then income tax department has requisitioned those assets, books, and documents, then for 3 years you will be getting a notice. 148A is not to be followed. 292BB shall also equally apply to a notice under 148. What is 292BB? Any notice is issued, but the assessee has cooperated, assessee has participated, then any irregularity for service of notice, not served properly, not served within time, not served to the assessee, all those irregularities will not be there. It will be deemed to be a valid service of notice. For this, you got to understand that notice has to be issued, problems or irregularities of service are rectified. This is applicable for notice under 143(2) regular assessment, notice under 144 best judgment assessment, and is also equally applicable to notice under section 148. Sometimes you get a case study question. If the notice was not issued, then 292BB cannot help you. even though the assessee had participated in the proceedings. Because notice was not issued, 292BB is of no use. For lack of issue of notice is a defect which cannot be cured by 292BB. Next, time limit for issue of notice. Originally, the time limits were 4 years from end of assessment year, 6 years from end of assessment year, and 16 years from end of assessment year. This is the old section 149(1). Basic time limit was 4 years. 6 years ka time limit if the income escaping assessment is likely to be 1 lakh rupees or more. 16 years if there is an asset outside India which has resulted into income escaping assessment. In the new section, the basic time limit is 3 years. Second time limit is 10 years if the assessing officer has in his possession books of account or other documents or evidence which reveal that income chargeable to tax represented in the form of asset which has escaped assessment is likely to be 50 lakh rupees or more. Asset will include, it's an inclusive definition, immovable property, shares, securities, loans and advances, deposits in bank account. It's an inclusive definition. So something like jewelry, etc., will also be covered as an asset. The old time limits are no longer applicable now, meaning 16 years ka time limit is no longer applicable. The government plans to cover it by Prevention of Money Laundering Act. 4 years and 6 years are gone. Now the time limit is 3 years. And beyond 3 years, if 3 years are over, but you can still issue a notice, then the overall time limit is 10 years from end of the assessment year. If a notice could not have been issued under the old section, then you cannot use the new section for issuing the notice. If 6 years are over, you cannot issue a notice under the old section. Then you cannot use the new section of 10 years and issue a notice. This section shall not apply to any assessment carried out under 153A for all the search that was up to 31st March 2021. This is only applicable effective 1st April 2021. Notices can be served after these limits. These are all for issue of notice. So an example I have taken up, you can study this. If notice is being issued in the financial year 21-22, then which years will be covered? So you can issue notice for AY 18-19, 19-20, 20-21 because they will be covered in the span of 3 years. But after that, notice cannot be issued. But you can probably issue notice in the year for those past years if the income escaping assessment is 50 lakh rupees or more. If it is below 50 lakhs, so 3 years is the time limit that is available. Coming to a case law which sometimes comes in your paper. Sometimes if a person expires, then for his situation assessment can be carried on against the legal representative if any proceeding already was taken against the assessee. Any proceeding which you could have taken against the deceased person if he was alive, it can be taken towards the legal representative also. But here the situation was that time limit got over, and after the time limit got over, a notice was sent to the legal representatives because the original assessee had died. So the section says कि भाई, because you cannot issue this notice to the assessee in case if he was alive, you cannot give it to the legal representative also. Therefore, the notice was held beyond time limit. Last part in the chapter to discuss 150. If you are doing income escaping assessment because of an order passed by Supreme Court, High Court, ITAT, CIT appeals, revision order by CIT, or if you have to give effect to a finding or direction contained in these orders. For giving effect to that finding or direction contained in these orders. If you are doing income escaping assessment, then notice can be issued any time. The section 149 time limits that we just read will no longer apply. Notice can be issued any time, but order will have to be passed, and for that you don't have a unlimited time. 12 months from end of the month in which that order needs to be passed. Order has been passed. You can issue the notice at any time, even if your original time limit of 3 years has expired. You can still issue a notice, but you have to pass the order within 12 months from end of the month in which the order of Supreme Court, High Court or ITAT or CIT was passed. Notice can be given at any time. Other provisions: tax will be charged at the same rate at which uh, tax will be charged at the same rate at which they would have been charged in the original assessment. So whatever is the assessment year, that year ka tax rates will be charged, not the current year ongoing. One provision which you can safely ignore, hardly comes up in the paper. If case is reopened, but if you can prove that I have not challenged your preceding assessment order and I've already paid more tax I've already paid tax on a higher amount of income, even after you include the escaped income, my current taxable income is still higher and I have not challenged that order. So do not do income escaping assessment, drop the proceedings under income escaping assessment. Important sections to remember: 147, 148, 148A and 149. For an amendment study, please ensure that you study this properly. Please ensure that you get the terminologies correct, because you have to write theory answers for which you will need the terminologies. Sun Engineering Private Limited case law, very old case law. The case law's crux is very simple. This income escaping assessment is for the benefit of department. So if your case is being reopened, you cannot ask the assessing officer, the deductions which were not allowed earlier, give it to me when you are doing income escaping assessment. If income had escaped assessment and for that income corresponding expenses were not claimed as a deduction, then today, like income is being taxed, the expense can also be allowed as a deduction, provided they were not claimed earlier. Only then you can take a deduction. But whatever assessment order has been passed originally, that order does not get wiped off, that order remains. If there is a disallowance, if there is an income taxable as per the original order, then either file an appeal or accept the original order. But if the case gets reopened, original order cannot be reworked, original order is not wiped off. Chalo, going ahead. Coming to our last chapter of this revision: taxation of charitable or religious trusts. Charitable purpose. Section 2, clause number 15 defines the term charitable purpose. Relief of poor, education, yoga, medical relief, preservation of environment, preservation of monuments, places, objects of artistic or historic interest, and the seventh one, advancement of any other object of general public utility. If you are doing anything of this, then what you are doing is a charitable purpose. Advancement of any other object of general public utility has this proviso. This proviso says, this proviso is not applicable to the first six. The proviso is only applicable for the seventh part of the definition. For advancement of any other object of general public utility, if you are undertaking a business activity, then it will be treated, your objective will be treated as a charitable purpose if your business activity is in the course of achieving this objective, and number two, the business receipts that you get do not exceed 20% of the total receipts. For yoga, education, relief of poor, medical relief, preservation of environment, preservation of monuments, business receipts can be about 20%, it is absolutely okay. But for advancement of any other object of general public utility, your business activity should be in the course of that objective, and secondly, business receipts should be maximum 20% of the total receipts. Only then it is treated as a charitable purpose. If you are a charitable trust, if you are a religious trust, then your income is exempt under section 11. This is section 11 ka exemption if you apply that income, if you use that income for charitable activity, if you spend that income. Using that income, spending that income means incurring expense. Capital expenditure is also covered, revenue expenditure is also covered. Whatever income you receive, if that income is in the form of corpus donation, that means you are receiving the income and the donor is telling you this is part of your permanent capital. Corpus donation is exempt from tax, section 11 subsection 1 clause D. The amendment that is introduced for corpus donation is that the exemption will be available only if this corpus donation is invested in the 11 subsection 5 modes. If you don't invest it, you don't get the exemption of corpus donation. Other than corpus donation, whatever income you receive, 15% of that income is a kind of a standard exemption. 11 subsection 1 clause number A, 15% is standard exempt. Whether you spend the money or you don't spend the money, 15% is exempt. Balance 85%. If you want to take exemption, you have to spend the money, you have to apply the money. That is called as income being applied. How do you spend it? Either you incur revenue expense or you incur capital expense. You can subtract the capital expenditure also fully. You can subtract the capital expenditure also fully and claim it as income applied. But if you claim that as an income applied, if you are claiming exemption for the cost of fixed assets, then you cannot again claim depreciation on those fixed assets as an expenditure. Even revenue expenses incurred are covered. Even income spent for revenue purposes covered. Salary to staff is also covered. Electricity expense, office rent, repairs, maintenance, all type of revenue expenses are covered. If revenue expenses are paid in cash on a single day, greater than 10,000, our 40A subsection 3 wala disallowance kind of applies here also. When you are calculating the amount applied for charitable purpose, if you are paying more than 10,000 on a single day and the payment is not through prescribed modes, then that amount will not be treated as income applied. If you have incurred some expense and the receiver is a resident of India and TDS provisions have not been followed, tax is not deducted at source or tax is deducted but not deposited on time, then that expenditure, 30% of that expenditure will not be treated as income applied. If you give corpus donation to another trust or institution registered under Income Tax Act, corpus donation will not be treated as income applied for you. Normal donations given will be treated as income applied. If you give donations to unregistered trusts, that is never considered as income applied. You will never get an exemption for that amount. If you give donations to a registered trust, if they are normal donations, you can claim as a donor, you can claim that as income applied and take exemption. If it is corpus donation, you can't take that as income applied. Some amendments. First amendment, though, I already told you. If the amount is received as corpus donation and instead of investing it into 11.5 modes, if you spend that money for charitable or religious purpose, that spending out of corpus donation will not be treated as income applied. But later on, in a future year, from your normal income, if you invest that amount into 11.5 modes, the amount which you have spent out of corpus donation, in the future year, you invest that amount out of normal income, then despite the fact that you've invested it and not spent it, it will be treated as income applied. So in simple terms, you can understand current year, corpus donation received will be exempt only if you invest into 11.5 modes. If you spend that money, for charitable religious purpose, current year, no exemption. Whatever amount of exemption has been denied to you in the current year, in a future year, out of your normal income, if you invest it into 11.5 modes, then it will be considered as applied. And although you've not spent it, you will get an exemption in the future year. Second amendment, if the trust has taken a loan and from that loan amount, if that charitable purpose, religious purpose amount has been spent, then that amount will not be treated as income applied for exemption purposes. Huh. But when you will repay that loan repayment will be treated as income applied. Third, in a particular year, if there is extra application, 100 rupees is your income, 15 rupees is standard exemption, 85 is balance. If you have spent 92 rupees, then the 7 rupees of loss in the subsequent year, you cannot take this loss and adjust it from the gross income directly. In a subsequent year, you will take the full income for computation without adjusting this loss. You will take the full income, take a standard exemption 15%, take the balance amount as exemption for that future year. Now the final taxable income that you will get, you can set off that 7 rupees ka loss against that final taxable amount, but not against the gross income that you have got. These are the three amendments in the chapter of charitable trust. Going back to our basic concepts, 15% income is exempt unconditionally, 85% income is exempt if you spend it. Suppose you are not able to spend it. Suppose you are not able to spend it. Why are you not able to spend it? Because you did not receive that income in the current year. It is taken as income on accrual basis, but it is not received in the current year, therefore you did not spend it. Then you can take an exemption in the current year itself on the basis of deemed application. On or before the due date of filing return, you have to exercise this option. It is an option available to you for deemed application. If you use this option, then current year, the amount of income which is accrued, not received, not spent, will be considered as deemed to be applied. Then in a future year, when you receive the income, that year and the immediately next year, the income received has to be actually applied for charitable or religious purposes. For those future years, the year of receipt and the subsequent year, this income that you are spending cannot be taken as exemption in those future years once again. You've already taken as exemption on deemed basis in the current year. Any amount which remains unused, income was received in a future year and the year thereafter. If any of that income is unspent, unused, then in that year it will become taxable. In the year immediately next to the year of receipt, that amount will be deemed as your income taxable. If you did not spend 85% of the income, although you had received it, then for any other reason, and the Income Tax Act is not concerned with the reason, although you have received it, but you have still not spent it, we will still give you an option of deemed application. In the current year, due to any reason, you have not spent it, deemed to have been spent, deemed to have been applied, take the exemption. But in the immediately next year, you are supposed to actually apply that income for for charitable religious purpose. You will have to apply that income for charitable or religious purpose. In that next year, whatever amount you could not apply, whatever amount you could not spend will be treated as your income that is taxable. Third situation, if you did not spend the income, 85% income, because you want to accumulate it for future usage. So have you received it? Yes. You have received it, but you have not spent it because you are going to require this income for a future period. Then 11 subsection 2 allows you to accumulate the income. 85% income you can accumulate. But to accumulate that income, number one, you have to submit a statement to the assessing officer in which you have to mention the purpose for which you are accumulating the income. You can accumulate the income for a maximum period of 5 years only. You have to write the purpose also. That year का return of income has to be filed on or before the due date. This statement also has to be furnished on or before the due date, and this amount has to be invested in 11.5 boards. If you invest the amount into 11.5 modes, submit a statement mentioning the purpose and the period cannot exceed 5 years. File this statement on or before due date, file the return of income on or before due date, then that amount accumulated as income is allowed as an exemption in the current year. Then you have to use it for the purpose for which you've accumulated it. At the end of the period, any unused amount, you did not spend it. You should have, but you did not spend it. Then that unused amount will become taxable for you. Remember, if you are accumulating the income, and from that accumulated income, if you give donations, then whether they are corpus donations or normal donations, they will not be permitted and that amount will become taxable to you. So, if I have my regular normal income, current year ka income, corpus donation not treated as application of income, normal donation treated as application of income. But if income has been accumulated, then in the future period, in the period of accumulation, if you donate whether corpus or normal donations, they are not treated as income applied, and you will have to pay tax on that amount which you have donated. If the income that you have accumulated is applied to purposes other than charitable or religious purpose, it will be treated as taxable. If it ceases to be accumulated, it will still be treated as taxable. You have not accumulated it, neither have you invested it in 11.5 modes, nor have you spent it for the purpose, treated as taxable. If you have not utilized it for the purpose for which you have accumulated it and utilized it for some other purpose, even though that other purpose is charitable, it will still be taxable. If you've donated to any trust, accumulated income, it will still be taxable. The Delhi High Court judgment, very simple. Can explanation to 11.2 be applied in respect of the accumulation up to 15% to treat the donation made to another charitable trust as income of the trust? The judgment, 85% income which is accumulated cannot be donated. But the 15% standard exemption, you can do whatever you want. So if you donate out of that 15% amount, then that amount donated cannot be said to be violation and it shall not be taken as taxable income. Investment modes 11.5, these are the investment modes. You deposit into any bank, deposit into any government saving schemes, units of UTI, debentures issued by companies where government has guaranteed the amount. Any public sector company, you can invest the money in the form of deposits. Financial corporation, banks, IDBI bank, investment in immovable property, these are all covered by, these are all my 11.5 modes. 11.5 is to be used at two places. One, for accumulation of income, and second, as per the amendment, corpus donations received will be exempted only if they are invested in 11.5 modes. If you earn capital gains because an asset has been sold, then you are expected to invest the net consideration. From which, how will your capital gains be computed? Full value of consideration of the asset that is sold, transferred asset, minus transfer expenses, net consideration, minus the cost of transferred asset, of course, without any indexation. Capital gains. Now, you have to invest into a new asset, and but of course, the new asset also should be used for charitable or religious purpose. Now, if the cost of your new asset is greater than or equal to the net consideration, is greater than or equal to this C rupees, then the full capital gain of E rupees is exempt. If the cost of your new asset is less than the net consideration, then your exemption is the cost of the new asset, the amount that you've invested, minus the cost of the old asset. That much capital gain will be exempted, balance capital gain will become taxable. If a practical sum comes up in this, then it will be very necessary for a student to remember this formula. If cost of new asset is greater than cost of the if cost of new asset is greater than the net consideration, then the entire amount is exempt. If cost of new asset is less than equal to the net consideration, then cost of new asset minus cost of that old asset, only this much is exempt. Anonymous donations. Anonymous donations means those donations where the donor wants to remain anonymous. So the trust does not keep a record of the name, address, and permanent account number of that donor. Now, anonymous donations, Section 115 BBC applies. If Section 115 BBC applies, then what happens is a certain amount of anonymous donations are covered as exempt anonymous donations. So from my total anonymous donations, a certain amount will be exempt, and whatever balance remains, balance anonymous donations will be taxed at the rate of 30%. So some a point to always keep in mind for question solving also, total anonymous donation will be included in the taxable income in the total income. Section 11 is not applicable. No exemption of 15%, no concept of deemed application, no concept of accumulation. As per section 115 BBC, a certain amount is exempted. It is exempted meaning it is exempted from the 30% tax rate. That means this is not exempted from income tax fully. On this, you will have to pay tax according to slab rates. On that balance anonymous donation, or I can say taxable anonymous donation, you will pay tax at the rate of 30%. What is this formula? Total anonymous donations that you have received, total anonymous donation received minus exemption. What is exemption? 5% of total donation received or minimum 1 lakh, whichever is higher. 5% of total donation received. What is total donation received? Corpus, non-corpus, anonymous, known donations. Everything is covered. This amount which we are considering right now as exempt, it means it is exempt from 115 BBC. It will be subject to tax. It is not exempt from income tax. This you will pay tax as per slab rates. This amount. And balance anonymous donation, you will pay tax at the rate of 30%. 11 subsection 6. I already mentioned this. If the cost of a fixed asset is treated as application of income, then depreciation on that will not be again treated as application of income. 11.7. A trust can enjoy exemption of agriculture income under section 10.1 unconditionally. But if this trust is also covered by 1023C or 1046, and since it is registered under 12AA, it will also be covered by section 11. Now, you can't take both the exemptions. Therefore, what does it mean? If you are approved under 1023C and also registered under 12AA, your registration will be deemed to be inoperative. That means automatically section 11 will not become applicable and you will claim exemption under 1023C or under 1046. If you want to come back to section 11, if you want to take exemption of section 11 once again, then you have to apply for registration under the new section 12AB. Then the inoperative registration will become active, will become operative again. And the consequence will be that 1023C and 1046 shall cease to have effect. Then you will be covered by section 11. So now it is either section 11 or 1023C, 1046. You can't claim both of them as exempt. Anonymous donation, I forgot to mention one thing. When will this whole thing apply? If you are a trust or institution created wholly for charitable purpose, and then this section of anonymous donation 115 BBC will apply. Second, if you are a trust or institution created for charitable as well as religious purpose, both, and the anonymous donation was made with a specific direction that it is for university, school, hospital, medical institution, then 115 BBC will apply. And if 115 BBC will apply, so section 11 is not applicable. If you are a trust created for religious purpose, fully for religious purpose, so 115 BBC shall not apply. And the moment you say 115 BBC will not apply, it means section 11 will now become applicable. If you are a trust and if you are a trust who is created for both purposes, charitable as well as religious, but your anonymous donation was not made with any specific direction that it is for hospital, university, medical institution, educational institution, then 115 BBC will not apply, 30% tax rate will not apply. This anonymous donation will be treated like any other normal income, and you will get all the benefits of section 11 for anonymous donations also. And anonymous donation will become taxable as per slab rates applicable to a trust. Trust will pay tax according to slab rate 2.5 lakhs ka basic exemption limit. Now, if a trust is operating for private religious purpose, if a trust is operating for a private religious purpose, so it is for religious purpose but only for private, for certain individuals, certain group of persons, then it is not eligible for any exemption. If it is a trust for charitable purpose, but it is benefiting only a particular religion or community, then exemption will not be available. Charitable trust should be open to all individuals of any religion, any community, any caste. But if you are working only for a particular religion, only for a particular caste, then no exemption will be given. If you are using the income for the benefit of specified person can be understood as a related party. And we know that when you do a transaction with related party, excess expenditure gets disallowed. Well, here with a related party, you can have a transaction of income also, or you can have a transaction of expense also. But if the property held under trust is used for the benefit of related party, then exemption is not available. If you invest into modes other than 11.5, then exemption is not available. If the provisions of the first proviso to section 215 become applicable. Half an hour ago we saw this. If you are doing advancement of any other objective of general public utility, your business should be in the course of that objective. Your business, second condition, your business receipts should not exceed 20% of the total receipts. So if your business receipt exceed 20% of the total receipt, section 11 benefit will not be available to you. If your business is in a different direction and your objective is different, section 11 will not be applicable to you. Who are these so-called related parties? The author, anybody who has made a substantial contribution till date. Your contribution has been greater than 50,000, not just for this year, all years put together. If the author, founder, or this substantial contributor is a HUF, then every member of the HUF, trustee, relative of the author, relative of the substantial contributor, relative of this member, any concern in which these people have substantial interest, then all these persons are specified persons. If the property if the income is used for the benefit of specified persons, section 11 exemption will not be allowed. Now, if you are a charitable trust who is running an educational institution or a medical institution, and you provide educational medical services to these specified persons, then the income from that particular event, providing educational medical services to specified person, income from that particular event, from providing those services, that will be taxable. Other incomes will continue to be exempt under section 11. And how will you calculate that income? The amount taxable will be the market value of such facilities provided. So section 11 exemption will not be snatched away from you just because you provided educational medical services to those specified persons. Other incomes which have no connection to this they will continue to be exempt under section 11. Income arising from this transaction will be taxable, and the market value will be deemed to be your income, and you'll have to pay tax on that market value. 11.4 and 11.4a. Can a trust do business? Yes, but the business should be incidental to the objectives of the trust, number one. Number two, separate books of account should be maintained for such business. If both these conditions get satisfied, business is incidental to the trust objectives and separate accounting books are maintained for business, then exemption will be available, otherwise exemption will not apply. If the trust claims that we are doing a business and we are entitled to exemption, business profit should also be exempt, then the assessing officer shall have the power to determine the income of such undertaking in accordance with assessment proceedings. And if he does that assessment proceedings and he finds that the assessed business income is greater than the accounting business income, the business income that is recorded in books of account, then this excess will be deemed not applied for charitable purpose, which means this excess will be chargeable to tax. Next point we already saw, trust is created with an advancement of advancement of objective of general public utility, 20% wala point. We've already discussed this. If your business receipts are more than 20%, then exemption under section 11 will not be allowed to you. I also mentioned this, that if you are doing the first 6 parts of the definition, then business receipts can be greater than 20%, less than 20%, it does not matter, exemption will be available to you. Now you have to satisfy only one condition. Such a trust will be eligible for exemption under section 11 for the business receipts as per 11.4 and 11.4a, meaning you have to satisfy number one, that the business should be incidental to the objectives of the trust, and number two, separate books of accounts have to be maintained. Even if your business receipt is more than 20%, that is fine for the first 6. Only for advancement of any other objective or general public utility, you will also have to check the 20% criteria. Coming to the registration aspect, section 12a talks about conditions for applicability of section 11. Number one, you have been granted registration. Number two, you have modified your objectives. You have applied to the CIT for registration of such modification and registration has been granted. Number three, your total income exceeds the basic exemption limit and you have got your books of account audited. Number four, if you have filed a return under 139.4a, which means you have filed a return on or before the due date under section 139.1. If all these conditions are satisfied, you are a trust registered with CIT, you have filed a return on or before due date, you've got your books of account audited. If you have modified your objectives, then for the modified objectives also you've got yourself registered, then exemption is available. Now last year, a new clause was introduced, clause number AC. This last year not only introduced a new clause, but then they also introduced a new section of registration, 12AB. To see what is all this. If you are a trust already registered under the old section, then on or before 30th June 2021, you have to make an application. You will be given registration for a span of 5 years. This is the new thing. Earlier, the registration was a perpetual registration. Now the registration will be restricted for 5 years. Every year you will have to get it renewed. If you are a trust already registered under the new section 12AB and your registration is due to expire, then you make an application. Sorry. Just 1 second. Yeah. If your registration is about to expire, then you make a fresh application and you'll be granted fresh registration again for a span of 5 years only. If a trust has been provisionally registered, a trust which is newly incorporated is granted provisional registration. Your provisional registration is about to expire, Then you make an application, you will be granted formal proper registration, and it will be valid for 5 years. If your registration has become inoperative, we saw this inoperative concept. Okay, if you are claiming an exemption under 1023C, 1046 and section 11, then section 11 will not apply because your registration will be inoperative. If you want, you can make it active once again, you can make it operative once again, for which you have to make an application. If you have undertaken modification or modification of your objectives, and you have made an application for the modified objectives. And lastly, if you are not following any of the 5 cases above, example a new trust, then you will be granted provisional registration for a span of 3 years. So if you are a trust which was registered under the old section, now you will be granted registration under the new section for 5 years. If you are a newly incorporated trust, you will be first granted provisional registration for 3 years, and then in those 3 years you have to make an application for formal fresh registration. If you are already registered under the new section 12AB and your 5 years ka period is getting over, make an application once again for another 5 years. If you modify your objectives, make an application for the modified objectives. If your registration has become inoperative, to make it active operative once again, make an application. Whenever you will make an application, it will be with the commissioner. The CIT will call for information documents. He will check the genuineness of the activities of the trust. He will check if any other law that is applicable to the trust has been complied with or not. If he is satisfied that both these things are done, he will pass an order in writing granting the registration for 5 years. If he is not satisfied, then also he has to pass an order in writing rejecting your application. But of course, opportunity of being heard has to be given, and against this order, you can file an appeal to Income Tax Appellate Tribunal. If you are granted provisional registration, then your exemption under section 11 will not be allowed from the time you get formal registration, will be allowed from the time you get provisional registration. So first you get provisional, then you get formal registration. Exemption will be available even for that period for which you were granted provisional registration. Situations in which the registration can be cancelled by CIT. Number 1, if after granting registration, subsequent to granting of registration, if the commissioner observes that the activities are not genuine, if the commissioner is satisfied that the activities of the trust are not genuine, if it is not carried out in accordance with the objectives of the trust, CIT shall pass an order in writing cancelling the registration of the trust after giving a reasonable opportunity of being heard. Shall pass an order, so this means this is mandatory in nature. Subsequent to granting of registration, if the commissioner observes K 13(1) gets attracted, private religious purpose, charitable trust but benefit of private community, particular religious community, benefit of specified persons, income not being invested in 11(5) modes, or the requirement of any other law is not complied with, against the trust a case has been filed and the order has been passed against the trust that yes, such non-compliance has occurred, then the CIT may pass an order. It is at the discretion of the CIT to cancel the registration. Discretion. If activities are not genuine, then he will compulsorily, mandatorily cancel your registration. If income is being misused as per 13(1), or if other law is not being complied with, he may cancel it, he may not cancel it. Depends. Then these case laws, these case laws come up quite a few times. When 80G ka registration is granted, you don't have to check whether 85% of income is applied or not. That is the act of assessing authority, assessing officer. Commissioner has to just ensure that the conditions are fulfilled 85% wala criteria is not for registration, is for exemption. Similarly, if there is a educational institution which is earning profits, but which is incidental to the main objective, it is making surplus which is incidental, then it is your main objective of spreading education. Assessee was engaged in imparting education. Profit was only incidental to the main objective. So this profit was allowed to be exempt. And if if within the stipulated period of 6 months CIT does not respond, then it is deemed that registration is allowed. Last topic to revise in charitable trust. You get questions based on this very frequently. The concept of accreted income. Event number 1, conversion. What is the meaning of conversion? This is the meaning of conversion. You have converted yourself, the trust has converted itself into a mode which is not eligible for registration. What does this mean? Your registration has been cancelled. We just saw that if activities of the trust are not carried out in a genuine way, objectives of the trust are not achieved, CIT will cancel your registration. Situation 2, you have modified your objectives, but you have not applied for fresh registration, or you have modified your objectives, but your application has been rejected. This is treated as a case of conversion. And if this happens, then you will have to pay this exit tax under 115 TD. Second, event of merger. If a trust which is registered gets merged with another entity which has dissimilar objectives, although that entity is registered, but you have merged into another trust which is a registered trust, but the objectives are not similar. Or second situation, you have merged into another trust where the objectives are similar, but it is an unregistered trust. Then such a merger is not acceptable. If this merger happens, then the merging trust will have to pay this exit tax. And dissolution, event number 3. If you fail to transfer all the assets within a period of 12 months from end of the month of dissolution, then you'll have to pay this tax. Obviously, you'll understand that whether this tax will be payable on dissolution or not, we will come to know only after the 12 months get over. If you fail to transfer all the assets to a trust registered under 12AA or 12AB or 1023C organization, and you fail to do it within the next 12 months, then 115 TD will get attracted and you will have to pay tax. So conversion, merger, dissolution. On what amount will you pay tax? You will pay tax on an amount of accreted income. This is what is asked in questions. What is the tax rate? 34.944%. Surcharge of 12% mandatory, 30% plus health education says 4%. What is the meaning of accreted income? Fair market value of total assets of the trust. Certain assets to be excluded. If asset is acquired out of agriculture income, excluded. From the date the trust was created to the date registration was granted, if any income was derived and exemption was not granted to that income, and from that income if any asset was acquired, that asset has to be excluded. From the date of creation to the date of registration, if income was not exempted, from that income whatever assets are acquired, those assets have to be excluded. Income tax paid, deferred revenue expenditure, they are not assets. We have seen that in every calculation of market value, these two are always excluded. Aggregate FMV of the total assets of the trust minus total liabilities of the trust. If any liability relates to an asset acquired out of agriculture income, liability should be excluded because asset is excluded. If an asset was acquired out of income which is from the date of creation to the date of registration and that income was taxable, now related to that asset, if there is any liability, obviously the liability also will be excluded since the asset is excluded. Sorry. corpus fund, contingent liability, provision for tax, reserve surplus, uncertain liability provision, all these liabilities are excluded. Normally also in market valuation formula, these things are excluded. Aggregate FMV of assets minus liabilities, this is accreted income. On that 34.944%, that is your tax payable. This is the same formula applicable for merger also. And in case of dissolution, same formula applies, but there is one extra thing. In those 12 months ka period, whatever assets you have transferred to a trust registered under 12A, A, B or 1023C, those assets will be excluded. If you have within 12 months transferred few assets to a registered trust, but not all, then the section will get attracted. Then you'll have to pay tax. But you will not pay tax on the FMV of those assets which you have transferred in those 12 months period. Liabilities relating to these assets to be excluded. Accreted income 34.944%. This is the tax payable. Okay, important stuff. Asset ka value. We just wrote aggregate FMV of asset. Now, how will you calculate this FMV? So this is given to you by rule number 17CB. Rule number 17CB tells you how to calculate the FMV of the asset. Many a times institute creates a question based on this also. If possible, remember this, read this once on the day of exam also. This is a slightly odd rule to remember, so you may not immediately remember it. On the day of exam, please go through this. If you get a question based on accreted income, there are chances that this rule 17CB will be tested based on past exam questions I'm telling you. And you'll be able to solve them very properly if you've read it on the day of exam. Immovable property, you will take SDV or open market value. Generally, we always take SDV. Here it says SDV or open market value, whichever is higher. Listed shares and securities, generally we take lowest price. Some places we take highest price. Here it says highest price plus lowest price divided by 2. FMV of unlisted shares. So valuation of that unlisted company is done. Assets of the company minus liabilities of the company. Net worth of that unlisted company divided by total paid up value multiplied by your paid up value of shares. Unlisted company means the company which has issued these unlisted shares to the trust. So this company ka market valuation is done, the one who has issued the unlisted shares. Unlisted securities value in open market, this is the same in normal FMV rules also. If a business is held by the trust, then the trust holds the business 100%. Then asset minus liability. That valuation of asset and liability shall be done in the same manner. Assets and liabilities will be valued like this only as given in 17CB. Liabilities also, those corpus fund, contingent liabilities, provision for uncertain liabilities, all those will be excluded. All of those will be excluded. Normally how you calculate liability value, you will take that liability value and you will calculate it. So accreted income, something that in the recent past has come up in your paper. So please ensure that you study this accreted income content very properly. In the description link of this YouTube video, you will find a Google Drive link for this PDF. This entire PDF you'll be able to download it, and if you feel it is worthy, if you feel it is very concise and it helps you in study, you can download this PDF and study it. Study the content from this. These are the chapters which we are expecting in the paper. We have revised income escaping assessment, which is an amendment, capital gains, which has amendments, PGBP is always part of your paper, trust is always part of your paper, TDS is always part of your paper, transfer pricing mostly comes up in your paper. So hopefully this video will help you to cover about 45 to 50 marks, which you should be able to attempt this properly. All the very best. Keep your calm. Attempt the best question first to give the best view to your examiner, so showing that you know the content. Attempt all your answers in a sequence, all sub questions to a question. Please put them together. If for a particular sub question you don't know the answer, leave out 2-3 sides, but please do not present it in a haphazard manner. Try to avoid as many cancellations and striking off in your solution as possible. Try to avoid them. MCQs are expected to be tough. Institute just the CA intermediate paper that it gave students gave me a reaction कि sir MCQs were a little tough, and the past trend also has been the same. If you feel dicey in MCQs, my honest suggestion that you attempt MCQs towards the end and first try to focus on the descriptive question of 70 marks and try to gain as much as marks as possible. Keep your calm, because only then you will be able to score, only then you will be able to think. One or two adjustments will be difficult, but not everything will be difficult. So please do not get bogged down by a difficult adjustment. Believe in yourself. You've come up to CA final, you've tackled 6 papers, you can tackle the 7th and the 8th paper also. A calm mind, a cool mind will help you to tackle up everything. All the very best, guys. Hope you do fantastically well. Hope this video helps you a great lot. Thank you. See you. Bye bye. All the best.